Hello. Yes, everyone. How are you all? Everyone fine? I hope everyone is doing great. First, let me ask you one question whether the audio and video is everything right? Is the voice audible? If everything is okay from your side, we can start the live session for today. Yes, sir. Yes, good morning, everyone. Ganesh, good morning. Yes, good morning. Kiran, good morning. Vishal, good morning. Yes, Shruti, Manish, good morning. Kishore, good morning. Great. Mahindra, good morning. Loganathan, good morning. Shruti, good morning. Very good. Avi, good morning. Chindana, what's I think is Chidandana. Good morning. Arushi, good morning. Pratik, good morning. Will it be English lecture? No, it will be in English, but very simple English. Don't worry about that. Okay. And whenever you are finding some difficulty, inform me. I'll translate that in Hindi also for you. Don't worry about that. Vanu, good morning. Hema, good morning. Yes, I think everything is set. Now, what is the objective of today's class? That will be covering almost all the small Indias. Small Indias means basically will be covering those Indias which does not require the revision of content much, because you all know the content. But what I have seen that if you will not do the questions, whatever has been given in ICS 30 material or RTP MTP which are expected, because normally questions will come of whatever question they ask from small Indias is of repeated basis. We know what type of question they may ask. Even though same question is not asked, similar question will be asked. And if you have done that questions before exam, you will be able to write it. And if you have not done, what will happen? A small confusion in exam hall, it is quite possible that you are not able to write correct answer. So if the question is of 5 marks or even MCQs, I will say you will not get any marks. If I will say all the big chapters means consolidation, business combination, financial instruments, share based payment, etc. From that, of course, a mandatory question will be asked, and you have done a lot of practice about that particular chapters. But when we come to small Indias, we don't practice much. Got this point? And of course, from tomorrow you will be giving 5 days for FR. Now, in these 5 days, if you are not able to manage time for these small Indias, it is quite possible that you will not be able to retain that particular point in exam hall. The objective is that today in one day we'll try to cover all the small India's questions, so that a quick revision is also done, practice is also done, which will help you in exam to score high marks. This is the basic objective. Got this point? Yes, sir. Now, if you permit me, we can start the Indias. Now, which Indias I'll be covering? That question you asking a lot. So there is no sequence I have made. I'll be starting with Indias 41. Got this point? Because from my point of view, I am expecting a question from Indias 41 this time. I'll be starting with Indias 41. Then after every Indias, if you ask me, I will take that particular Indias, or if you have no particular sequence, I can take any Indias. However, I have some sequence which I have already framed in my mind that I will be covering. For example, after Indias 41, I am thinking to start Indias 23, borrowing cost. Got this point? So if you do not have any particular sequence, just be with me. Today will be in this particular live session. We are starting in the morning 9 a.m. and till all the small Indias will be covered. I'll be with you. Means the target is from 9 a.m. to 9 p.m. and we'll be covering all the expected questions with concept also. Means I'll be taking concept also. For example, some concept is required, a revision for that particular question. That concept also I will take. Don't worry about that. Can we start? Yes, sir. One more particular point which I want from your side. Here I'll be asking a lot of questions from you. Whenever I'll be doing the questions, I'll be asking some question. So you need to repeat the answer with me. Means you need to write down in the chat box. Yes, sir. This is the particular answer. When you repeat it, so what will happen? It will help you to retain that point. Got this point? So I'll be asking some question. You need to repeat that particular point with me and write down in the chat box, so that I can understand that yes, you are with me and you are able to retain the point. So before I will answer, I will ask some question from you, and I will identify the area where normally students do mistake. So before I answer, I will ask question from you, and this will really help you to retain that point in exam hall. Got this point? Yes, sir. Can we start? Yes, sir. So we'll start with Indias 41. Indias 41. Can we start? Agriculture. Yes, sir. So we'll start, and the expected question, I think you have already downloaded from my Telegram channel. This all expected question already I have given in the PDF format. Got this? Now if you have my question bank, so question number is same. Question number 7 of my question bank 11th edition. So question number will remain same. 11th edition question number will remain same. So if you are following 11th edition question bank, don't worry about the question number. And if you have some other question bank, or you are following some ICS study material, then you can download the expected question from my Telegram channel. Got this point? Yes, sir. Now coming to first question of Indias 41, question number 7. XY Limited is a farming entity where cows are milked on a daily basis. Okay, sir. So of course from the question, when we read, you will be able to understand it is a question of Indias 41, because cow are biological asset. Now we all know that biological asset are initially measured at, everyone respond with me, biological asset are initially measured at what price? Biological asset are initially measured at fair value less cost to sale, correct? And it will be subsequently measured at fair value less cost to sale, and any difference in measurement will be transferred to profit and loss account. So very simple, initial measurement at fair value less cost to sale, subsequent measurement at fair value less cost to sale, any difference will be transferred to profit and loss account. If you know this point, it means almost all the question you can do it. Got this point? Now let us start. Milk is kept in a cold storage immediately after milking and sold to retail distributor on a weekly basis. Now milk become an agriculture produce. So agriculture produce at the point of harvesting will be also covered under Ind AS 41. Now as per Ind AS 41, this agriculture produce at the point of harvesting will be measured at what? Same fair value less cost to sale. So agriculture produce at the point of harvesting will be also measured at fair value less cost to sale. Got this point? Subsequent recognition will be covered under Ind AS 2. Means subsequently it will become what? Inventory, and if it become inventory, Ind AS 2 will be applicable. Now what Ind AS 41 says, what Ind AS 2 says, that this initial recognition has been done at fair value less cost to sale. For measurement principle as per Ind AS 2, this fair value less cost to sale will become cost price. Got this point? Yes sir. On 1st April 2001, XY Limited had a herd of 500 cows which were all 3-year old. So they have how many cows? 500 cows, and all are of which age? It is an age of 3-year old. All are 3-year old. Okay sir. During the year, some of the cow become sick, and on 30th September 2001, 20 cows died. So if 20 cows died, can you say we need to apply the derecognition principle? 20 cows, the carrying amount will be derecognized. Correct? Yes sir. On 1st October means next day, XY Limited purchased 20 replacement cow at a market for 21,000 each. So they purchased how many cows? 20 cows by payment of 21,000 each. Got this point? These 20 cows were all 1 year old when they were purchased. So the new cow, whatever they have purchased, they are of which age? 1 year. Got this point? On 31st March 2002, means year end, XY Limited had 1,000 liters of milk in cold storage which had not been sold to the retail distributor. The market price of the milk on 31st March 2002 was 20 per liter. Market price means, can I say, they have given fair value. This become fair value. When selling the milk to distributor, XY Limited incurs selling cost of ₹1 per liter. Selling cost means this, they have given cost to sale. So fair value less cost to sale become how much? 20 minus 1, that is 19 rupees. That is 19 rupees. This amount did not change during March 2002 and are not expected to change during April 2002. This information is not relevant because we want fair value less cost to sale on the date at the point of harvesting. So subsequent changes in the fair value is not relevant for initial recognition. Got this point? Information relating to fair value and cost to sale is given below. Now you can see they have given fair value of dairy cow and cost to sale, and they have given date wise. So can you say on 1st April 2001 they were having 500 cow, of which is 3 year. So can you say 3 year? So this information become relevant, 27,000. This information is not relevant, and cost to sale is 1,000. It will become 27 minus 1,000, that is 26,000 is the fair value less cost to sale. Got this point? Yes sir. Now 1st October they again purchased 20 cow, and all cows were of which is 1 year. So can you say 1 year means this information will be relevant. This information and this information will not be relevant. 21,000 minus 1,000 will become 20,000. So fair value less cost to sale become 20,000. Yes sir. On 31st March 2002 year end, now can you say out of 500, 20 cow died, means 480 cows are left. 480 cows. Now the age will become 3 plus 1 means 4 year. So 3 plus 1 4 year means 26,500. So for 480 cows, can I say it will become 26,500. 26,500 minus what? 1,100, that is equal to 25,400. 25,400. This point have you understood? Yes sir. And for balance 20 cow which was purchased. So initially when they were purchased, the age was 1 year. Now after 6 months the age will become 1.5 year. So 1.5 years means 23,500, means this information and this information is not at all relevant. Correct? So 23,500 minus 1,100, this will become 25,400. 400, 25,400. This information, if you have once understood, 1 minute, some wrong information I have written. So 23,500, 23,500 minus 1,100 is equal to 22,400. Yes, sir. Yes, sir. Once you have identified this information, now the question solution is very simple. Very simple. So first you need to identify this. Once identified, now solution become very easy. Now one more information they have given, equal assume that fair value of a 3.5-year-old cow on 1st October 2001 is 27,000. Means, can I say on the date when the new cows were purchased on 1st October, they have given fair value. Can I say we do subsequent recognition on reporting date? 1st October is not a reporting date, therefore this information is not at all relevant. This information they have given to confuse you, you need to ignore that. So because subsequent recognition is done at reporting date and reporting date will be year end, therefore this 27,000 information will not be relevant. Yes, sir. Pass necessary journal entry of the above transaction with respect to cow in the financial statement of XY Limited for the year ended 31st March 2002. Also show the amount lying in the inventory if any. They have asked what? Journal entry. They have asked journal entry only for the transaction in respect to cows. For inventory, they have not asked any journal entry. For inventory, they have asked only the amount, at what amount it will be shown in the financial statement. Correct. So first you need to prepare one working note. Working note key, what will be the fair value gain or loss on initial and subsequent measurement. This you need to find out. So you can see on 1st April 2001 we have how many cows? 500 cows. The measurement was done at what amount? The measurement will be done at 26,000. So 500 into 26,000, 500 into 26,000, it become what? 500 into 26,000, it become how much? 1 crore 30 lakh. This you have done. Then out of that 20 cows died, so we need to de-recognize it at the same carrying amount of 20 into 26,000 only, because this will be de-recognized at carrying amount. We will de-recognize and this amount will minus. Then again they purchased 20 cow and now we need to recognize that fair value less cost to sell on that date, and the fair value less cost to sell on that date is 20,000. You can see. So 20 into 20,000 how much? 20 into 20,000 how much? It is coming how much? 4 lakh. So this becomes the total at the time of initial recognition. Now I'll do subsequent recognition on 31st March. Subsequent recognition 31st March. So out of 520 cow out, now 480 left. So 480, what is the valuation? Fair value is less cost to sell how much? 25,400. Will multiply with 25,400 and this amount will come. Only you need to use calculator. Got this point? Yes, sir. Means you need to also see whether the same amount is coming or not. So don't only listen, just do the calculation part also, it will help you. So when you will do calculation by your own, so it will help you. Don't listen, use calculation and write down whatever you can write down also. So the practice bhi ho raha hai. Okay, sir? Yes, sir. Now 20 cow, it will be subsequently measured at 22,400. So it will be 22,400. The same amount will come. So this becomes subsequent recognition. Got this point? So if you find out a difference between this becomes gain or loss on subsequent measurement. However, as per ICA solution, they have calculated subsequent measurement gain or loss for 480 cows separately and 20 cows separately. What you can do? This 130 means what is the total of this? Find out. 130. Correct. 130 minus means 130 lakh. Yes, sir. 130 lakh minus 5.2. Correct. So this become 124.80. Then you'll do minus 121.92. It is coming 2.88. So 2.88, because you can see this has been what? This has been decreased, so they become loss of how much? 2,88,000. So they have calculated loss of 2,88,000 on 480 cows. And then subsequently for 20 cow, it was initially purchased at a fair value. At that time fair value was 4 lakh. Now it become 4,48,000. So increase of 48,000. So they have recorded 48,000 gain separately. Now what will be the journal entry? Journal entry very simple. Journal entry first. Can you see when you de-recognize 20 cow, because opening balance was 500. For that no journal entry will be done. Then on which date? On September na, 30th September 20 cow died. So you need to pass one journal entry. Loss on derecognition. Loss on derecognition to biological asset. Biological asset will be derecognized, it will be created. So loss on derecognition, and you will derecognize by carrying amount. Carrying amount is how much? 5,20,000. 5,20,000. The first journal entry has been done. Very simple. Then you purchase 20 cow. The biological asset account debit, you have initially measured at 4 lakh. The biological asset account debit 4 lakh. But how much payment you have done? Payment you have done at rupees 21,000. The payment you have done 20 into 21,000. Payment has been done 4,20,000. So you can see this, the measurement has been done at fair value less cost to sell. But this bank is what payment, how much payment you have done, how much payment you have done. Got this point? And any difference will be transferred to profit and loss account as loss on initial measurement. You can see loss on initial measurement become 20,000, which will be transferred to profit and loss account. Correct. Then subsequent measurement, they have done two journal entry. First for 480 ka have already calculated loss. There was a loss. So loss to biological asset 2,80,000. Then on 20 there is a gain. Gain is what biological asset account debit gain. Gain on subsequent measurement, that is 48,000. However, you can do also one compound journal entry for this. That is your choice. But ICA has done separate journal entry. Therefore, I have also explained separate journal entry. Got this point? Okay, sir. Yes, sir. Safi Muhammad, okay, after this I will take Ind AS 23, after that I will take Ind AS 21, then Ind AS 7. I will do as per your choice, don't worry. This question number 7 done. Come to question number 8. Question number 8. Whether speed is okay or can I increase the speed? Bolo, everyone respond. Is the speed okay? Or you want me to increase the speed? Everyone respond. Question number 7 you have understood. Initially I am thoda sa slow. Dheere dheere I will increase the speed. But if you want me to maintain the same speed, I will maintain the same speed. Everyone. Chalo. Dheere dheere I will increase, don't worry. Yes, sir. Chalo. Question number 8. Company X purchased 100 beef cattle at an auction for 1 lakh on 30th September 2001. Now they have purchased 100 beef cattle at an auction of 1 lakh on 30th September 2001. So this become what purchase price? Subsequent transportation cost was 1,000, that is similar to the cost X would have to incur to sell the cattle at the auction. Means from this point what is understood that transportation cost will be incurred both by buyer as well as seller. Means if the company X will sell the similar biological asset, same transportation cost will be incurred. Now just try to understand, whenever we pass the journal entry biological asset to bank, so this is what fair value less cost to sell. Whenever we calculate fair value less cost to sell, it is based on sale price. It is based on sale price. But whenever you are doing payment, payment is at a time of purchase. Payment is at the time of purchase. Means can I say whenever you are calculating whatever payment has been done, so that transportation cost has been paid, therefore it will be added. Therefore it will be added. But to find out fair value less cost to sell, correct, now from selling price the transportation cost will be deducted. From selling price the transportation cost will be deducted. Got this point? So this you need to keep in your mind. Yes sir. Yes sir. Additionally there would be 2% selling fee on the market price of the cattle to be incurred by the seller only. To be incurred by the seller. So you can see they have given 2% of selling fee will be only incurred by seller, not by the buyer. Means when they have purchased the cattle, that time no transaction cost has been incurred. Only when they will sell it, a transaction cost of 2% of selling fee will be incurred. So you can see there are two type of costs. One is known as transportation cost, one is known as transaction cost. Transaction cost means when you have purchased, how much transaction cost has been incurred. Whenever you have sold, how much transaction cost has been incurred. Got this point? Transportation cost and transaction costs are different. Transportation cost and transaction costs are different. Now this fair value measurement we do as per Ind AS 113. What Ind AS 113 says that to find out fair value, first find out market price. From market price, first we deduct transportation cost. Transportation cost. Once you deduct transportation cost, this become fair value. This become fair value. Means what do you mean by fair value? Fair value means market price at the time of sale. Market price at the time of sale means market price for selling the asset. Got this point? Minus transportation cost will be fair value. From these, if you deduct cost to sale, it become what? Fair value less cost to sale. So cost to sales means only at the time of sale. This you need to understand. This you need to understand. Correct? It means, can I say, from this 1 lakh, you need to deduct transportation cost as well as transaction cost to find out fair value less cost to sell. To find out fair value less cost to sell. But at a time of, to find out what amount has been paid on purchase of such cattle, only you need to add transportation cost. Only you need to add transportation cost. Got this point? Yes, sir. Now suppose in the question it is given 2% was incurred, but it is not given whether it is incurred by seller or it is incurred by buyer. It is not given. So in that case you need to take assumption. Whenever question is, best assumption is that transaction cost is incurred only by the seller. You can take that assumption, or you can take one more assumption that transaction cost is incurred by both buyer and seller. Both buyer and seller. Understood? So if the question is silent, transaction cost means I am saying about this other than transportation cost. So if the question is silent about transaction cost, two assumptions can be taken. I will say better assumption is what? Ki transaction cost is only incurred by seller. Correct? If one more assumption can be taken as per ICS solution, that transaction cost is also incurred by both buyer and seller. Both buyer and seller. But don't assume that transaction cost is only incurred by buyer. If the question is silent. If the question is silent. This you have understood? Okay? Yes, sir. Now, on 31st March 2002, the market value of cattle in the most relevant market increases to 1,10,000. So, you can see on subsequent date, means on 31st March, the market value has increased. This they have given for subsequent measurement. Transportation cost of 1,000 would have to be incurred by the seller to get the cattle to the relevant market. So 1,10,000, you need to deduct 1,000 to find out fair value less cost to sell. Transportation cost will be deducted, and also transaction cost of 2% of the market price of the cattle would be payable by the seller. So once again, 2% of the market price is the transaction cost. This information they have given for subsequent recognition. On 1st June 2002, X sold 18 cattle for 20,000 and incurred transportation charges of 150. Now they have actually sold how many cattle? They have sold 18 cattle out of how many cattle? 100 cattle at rupees 20,000. This becomes sale price. This becomes sale price. In addition, there was a 2% auctioneer fee on the market price of cattle paid by the seller, and they have also incurred 2% auctioneer fee. Correct. So transportation cost has been given, and auctioneer fee is also given. This is the actual expenses. Now this become the actual expenses. On 15 September 2002, the fair value of remaining cattle was 82,820. Now you only say on 15 September we never do subsequent recognition. So this fair value whatever has been given is not at all relevant. The fair value on 15 September whatever they have given to confuse you. This is not at all relevant because subsequent recognition will do at each reporting date. One more point, whenever company is preparing interim financial report, suppose they are preparing quarter report or half year report, then your subsequent reporting date will be either 4 reporting date or 2 reporting date based on quarterly or half yearly statement. Got this point? So in this question they will mention, if you read the question what they have given, ki reporting period are 30th September and 31st March. It means now subsequent recognition will be done on 30th September and 31st March. If the question is silent, then subsequent recognition will be done annually. Annually means on 31st March. Annually means on 31st March. Yes, sir. Yes, sir. Now 42 cattle were slaughtered on that day. Slaughter means the live process of that particular cattle has been ceased, slaughtered, and now once the slaughtering has been done, it will become inventory. It will become inventory. So can I say this become the point of harvesting? At point of harvesting, inventory will measure at fair value less cost to sell. With the total slaughtering cost of 4,200. This is a general expenses. I will say slaughtering expenses. Correct. Yes, sir. The total market price of the carcasses on that day, they have given a market price how much? 48,300, and expected transportation cost to sell the carcasses is 420, and no other costs are expected. Means they have not given any transaction cost. They have given only transportation cost. So we'll find out the fair value less cost to sell by calculating 48,300 minus 420 will do. Yes, sir. Then on 30th September means next reporting date as per the information given the question, the market price of remaining 40 cattle were 44,800. The expected transportation cost is 400. Also, there would be a 2% auctioneer fee on the market price of the cattle payable by the seller. So you can see the subsequent reporting that information has been given to find out a fair value less cost to sell. We need to find out gain or loss on subsequent measurement. Past journal entry, we need to pass journal entry on initial and subsequent measurement for all the above transaction. Interim reporting period is given. Let us do the journal entry. So first they have purchased how many cattle? 100 cattle. What will be journal entry? Biological asset account debit to bank. So you can see biological asset account debit to bank. First you will find out payment, how much payment has been done. So 1 lakh is the market price and transportation cost of 1000 has been paid. So 1 lakh plus 1000, 1 lakh 1000 is the total payment. 1 lakh plus 1000 total payment is 1 lakh 1000. Correct. Now we need to find out fair value less cost to sell. So market price is 1 lakh. Correct. Now on the date of purchase, if nothing is given, purchase price will be considered as market price. Got this point? The purchase price will be only the market price and that will be considered for to find out fair value less cost to sell. So 1 lakh from this 1000 will be deducted and 2% of 1 lakh, that is 2000 will be also deducted. This will become 97,000. So this become fair value less cost to sell on initial measurement. So biological asset has been debited at what? 97,000. Difference will be what? 4,000, which will be loss on initial measurement, which will be transferred to profit and loss account. First journal entry is very simple. Correct. Now subsequent recognition on 31st March, they have said the market price is how much. On 31st March the market price become 1,10,000. So now the market price will become 1,10,000. Once again the transportation cost is 1000 and once again the transaction cost means cost to sell is 2%. So 1,10,000 into 2%, how much it is coming? 2,200. 2,200. Correct. So it is coming how much? Batao. 1,10,000. Everyone respond with me. How much is coming? I am also calculating. You need to also calculate. Don't listen. Don't listen. Calculate it and just respond before me. If you are responding before me, then only high level of efficiency will come. Listening will not do. Calculation will do, because in exam you need to calculate it. Got this point? So don't listen. You need to calculate with me and just respond before me. So I am also calculating from your point of view. So you need to also calculate with me. Got this point? If you only listen, believe me, it will not help you. Okay. So 1,10,000 minus 1000 minus 2,200. How much it is coming? 1,06,800. It is coming 1,06,800. Initial measurement was done at 97,000. So just give me what is the gain or loss. So it is a gain because the value has increased. So gain is how much? Minus kar do 97,000. Gain is what? 9,800. You can see 9,800 is gain. What journal entry will do? Biological asset account debit to gain on subsequent measurement. So biological asset account debit to gain on subsequent measurement, which will be transferred to profit and loss account. Yes, sir. This is done. Now on the next date is what? 1st June. 18 cattle has been sold. On 1st June, 18 cattle has been sold. At what price it has been sold? At 20,000 it has been sold. So can I say, just try to understand. I'm just explaining the journal entry given by ICI. Correct. Now, so on this date, what they have done, first they have calculated the fair value less cost to sell of 18 cattle. On this date, it is coming how much? Batao. 20,000 is the 20,000 is the sale price. Transportation cost is 150 and 2% is the auctioneer fee. So minus kar do 150 and 20% is how much? 20,000 into 2% how much? 400. 400 minus kar do. So 20,000 minus 150 minus 400, it is coming 19,450. This become fair value less cost to sell. Can you say you need to compare with the carrying amount? Carrying amount of this. So can you say previous carrying amount was how much? 1,06,800 for 100 cattle. So you can find out what is the carrying amount of 18 cattle. So what will do? 1,06,800 into 18 divide by 100. So 1,06,800 into 18 divide by 100. It is coming how much? 19,224. So how much increase? Increase kitna hua? Minus ka do 19,450. It is coming 226. So once again gain is there. How much gain? 224. So what journal entry will do? What journal entry will do? Biological asset account debit to gain on this date. Gain on the date of sale, and that is what? 226. This journal entry, I hope you have understood. Correct? Yes, sir. Now we'll recognize the revenue. We'll recognize the revenue. So what? Bank account debit to revenue. Bank account debit to revenue. 20,000, 20,000. Correct. So they have done one compound journal entry कि bank account debit to revenue and selling expense account debit to bank. They have compounded it. We can also compound it bank account debit, selling expense account debit to revenue. The revenue is at 20,000. Selling expense, the total selling expense is what? 150 plus 400. That is 450. Sorry, 550. And the difference become the bank account. This journal entry, I think you have understood. Now, can you say we need to also de-recognize the biological asset because the sale has been done? Correct. So de-recognition will be done because already we have measured at fair value less cost to sell. So what is the fair value less cost to sell? 19,450. At this price it will be de-recognized. What journal entry will do? Batao. What journal entry will do? So it will become our cost to sale because sale has been done. So it become now expense. So cost to sale account debit to biological asset. Cost to sale account debit to biological asset 19,450. Yes, sir. This also you have understood. Correct. This question I am expecting in exam because this is the only question which is not yet asked in exam which can be really expected in exam. Then can I say then next date came 15 September when how many cattle were slaughtered? You can see 42 cattle were slaughtered. 42 cattle were slaughtered. So can I say once the slaughtering has been done, to will to recognize inventory, to will say inventory account debit at same fair value less cost to sell. So what is the fair market price has been given? Check karo. Market price has been given 48,300 and what is the transportation cost? 420. So 48,300 minus 420, that is coming 47,880. So you can see 47,880 inventory account debit. Inventory account debit. Can you see when to re-recognize biological asset for 42 cattle at the carrying amount only? So once again 1,06,800 was the carrying amount for 42 cattle. Divide by 100 करेंगे तो 1,06,800 into 42 divide by 100 is equal to 44,856. So you can see biological asset of this has been de-recognized. Correct. So what journal entry will do? Inventory account debit to biological asset. Inventory will increase and biological asset will decrease, and the difference will be transferred to profit and loss account as a gain or loss on initial measurement of inventory. Gain or loss on initial measurement of inventory. But ICA has compounded one more journal entry. They have also done slaughtering expense account debit to bank. That journal entry has been compounded. So you can see to bank slaughtering expense was 4,200 and the gain or loss on measurement means whatever loss is coming that has been compounded, means it is actually the sum total of what that initial measurement inventory gain or loss and slaughtering expense that has been compounded. You can pass two separate journal entry will what inventory account debit to biological asset, gain or loss will be transferred to PL, and then slaughtering expense account debit to bank, slaughtering expense account debit to bank, slaughtering expense will be transferred to PL, slaughtering expense will be also transferred to PL. These two journal entry you can pass or you can compound it also. Now let us come to on the last date means reporting date on 30th September. Now 40 cattle are left. Now once again we'll find out the fair value less cost to that is given 44,800 minus 400 minus 2%. So 44 what will do 44,800 minus 400 and 44,800 ka 2% how much, that is 896. It is coming how much 44,800 minus 400 minus 896, it is coming 43504. Correct. And 43504, this become the fair value less cost to sell on reporting date. Now we'll find out the carrying amount of remaining cattle, that is 40 cattle. So it is 1,06,800 into 40 divide by 100 कर दो तो 1,06,800 into 40 divide by 100 कर दो, it is coming 42,720. 42,720. Correct. So you can see it has increase means gain. How much gain? It is 43,504 minus कर दो, it is 784. So gain is coming 784. Understood? Have you understood? Muthu, your amount, I don't know, 19,224, what you have written. Understood? So journal entry will become biological asset account debit to gain on subsequent measurement. Yes, sir. Done. Okay, sir. Now let us come to next point. Question 9. Question number 8 you have understood? Respond fast. 8 you have understood? Yes, sir. If you have not understood any point, just you can write down. I will explain again. Because if you are listening and if, even though you are not able to understand, then I will say it will of no use. So if you are not able to understand, just stop me in between. I will explain that point again. Now question 9, this type of question can be asked in MCQs type, multiple choice question. On 1st November 2001, C Agro Limited purchased 100 goat of a special breed from a market for rupees 10 lakh with a transaction cost of 2%. Now you can see only transaction cost has been given, transportation cost has not been given this question. Goat fair value decreased from 10 lakh to 9 lakh on 31st March 2002. Determine the fair value on the date of purchase as on the financial year ended 31st March under the both the cases. Now you can see, suppose this is the only question. Now question is silent about transaction cost, whether it is incurred by seller or whether it is incurred by buyer. So whenever question is silent, either you can take assumption that it is incurred by seller or it is incurred by both buyer and seller. Don't assume that it is incurred by only buyer. Got this point? So you can see in the ICA question also they have given the first assumption is that transaction cost is incurred only by seller. Second assumption is transaction cost is incurred by both seller and purchaser. So in two situations it to work out. So first let us do when transaction cost is incurred only by seller. Only by seller. So only by seller, what is the market price? 10 lakh. What is the transaction cost? That is 2% means 20,000. What is the fair value less cost to sell? 9,80,000. So 9,80,000 become fair value less cost to the payment. Payment has been done only 10 lakh because transaction cost is not incurred by buyer. So 10 lakh, the difference will become loss. Loss will be transferred to profit and loss account. Correct. Subsequent measurement is will be done at fair value less cost to sell. So 9 lakh. Now, normally one doubt come in the exam. You can see what they have become. Gold fair value decreased from 10 lakh to 9 lakh as on 31st March 2002. And nothing has been mentioned about transaction cost. You can see. So sometime you need to understand the emotions of the question. Of course, nothing has been mentioned about transaction cost. But can I say this transaction cost was also one expectation that it will be incurred only at the time of sale. So till now no sale has been done. Means right now we are not calculating actual selling expense. This is the expected selling expense. And of course, whenever sale will be done, we'll assume same transaction cost will be incurred even though not mentioned in the question. Correct now. It means 9 lakh minus 2% will do. It is understood point. It is understood point. So 9 lakh minus 2% means 18,000. Here normally student do mistake. They will not deduct what transaction cost. I don't know what happened. Here you can do mistake. Have you understood this point? Have you understood this point? You can see gold fair value has been decreased from 10 lakh to 9 lakh, but nothing has been mentioned about transaction cost. So okay, same transaction cost will be incurred at the time of sale. So this is one expected transaction cost. This is not actual transaction cost. Have you understood this point? So this become 9 lakh minus 18,000. It become what? 8 lakh 82,000. Initial measurement was done at 9 lakh 80,000. 9 lakh 80,000. Correct. So 9 lakh 80 minus 8 lakh 80,000. How much loss? Loss become 98,000. You can see they have done one more journal entry. Loss on subsequent measurement which will be transferred to PL account to biological asset. This is the first situation. Second situation may only the first journal entry will change. Second journal entry will not change because the fair value less cost to sale will remain same in both the assumption. Yes, sir. So when transaction costs are incurred both by seller and buyer, so can you say it will be initially measured at 9,80,000, but payment will be done 10 lakh plus 20,000 because transaction cost in this case is also incurred by buyer. So 20,000 has been paid. So payment become 10 lakh 20,000 and loss become on initial measurement 40,000. This type of question can be asked in multiple choice question. I think you have understood. Can we proceed? Yes, sir. Question 10. Once again, this type of question can be expected in either in MCQs or as a 4 marks or 5 marks. You can see RTP, MTP have been given in previous RTP, MTP 3 times. So 100% expected. Analyze whether the following activities fall within the scope of Ind AS 41. For that you need to understand the meaning of agriculture activities. Means any biological assets which are related to agriculture activities are covered in this particular chapter, Ind AS 41. Now what do you mean by agriculture activity? Agriculture activity means any activity in which entity manage biological transformation and harvesting. Sunna, biological transformation and harvesting, both management of both biological transformation and harvesting of biological asset for three purpose: for sale, correct? For conversion into additional biological asset and for conversion into agriculture produce. So only for three purposes: for sale, for conversion into additional biological asset, for conversion into agriculture produce. So it is a management by entity for biological transformation and harvesting. If both are managed by the entity, the activities become agriculture activities if they are for three purpose. Yes, sir. Now, let us do one by one. Managing animal related recreational activity like zoo. Can you see it is for recreational purpose? It is not for sale, not for conversion into additional biological asset, not for conversion into agriculture, but is therefore it is not related to agriculture activity. It is not covered under Ind AS 41. Fishing in the ocean. Can I say whenever you are doing fishing in the ocean, only harvesting is involved. Harvesting means what? Detachment of agriculture produce from biological acid or to seize the life of any biological acid. That is known as harvesting. So you are right now seizing the life of fish. But in this case, there is no biological transformation involvement. That is a natural biological transformation. Entity is not engaged in any biological transformation. Therefore, this is also not agriculture activity outside the scope of Ind AS 41. Fish farming, yes, because whenever we do fish farming, also known as aquaculture, in that case, biological transformation and harvesting both are involved for sale and for the other two purpose also, and therefore it will be covered. Development of living organisms such as cells and bacteria viruses. Now, in this, the IC has given two answers. However, the better answer, because nothing has been given, so normally it is for scientific purpose. We normally develop the living organism like bacteria for scientific purpose. That is not for I will say scientific research. It is not for sale, etc. Correct? So initially I will say if nothing has been given, the answer is no, it is not related to agriculture activity and outside the scope of Ind AS 41. But if the organisms, what the next point they have given, if such living organisms are being developed for sale or used in dairy product, the activity will be considered as agriculture activities under the scope of Ind AS 41. So if suppose MCQ question asked, the first preference should be given to know if the same thing has been asked. But if it is descriptive question, I will say give both the answer. Give both the answer. Yes, sir. Chalega? Yes, sir. Now, growing a plant to be used in the production of drugs. Yes, of course, it is in agriculture activities. Purchase of 25 dog for security purpose. Security purpose. So, can you say if you are purchasing some dog only for security purpose, it is not related to agriculture activities. Therefore, outside the scope of Ind AS 41. Yes, sir. Now let us come to next point. Question number 11. As on 31st March 2017, a plantation consists of 100 pinus radiata tree that was planted 10 years earlier. Okay. So what they are saying, on 31st March 2017, a plantation consists of 100 pinus radiata tree that were planted 10 years earlier. Means right now the age is what, 10 years? Right now the age is 10 years. The tree takes 30 years to mature. So it will become matured only at the age of 30. So how many age is left? 20 years is left for maturing, and will ultimately be processed into building material for houses or furniture. For houses or furniture, so will be ultimately processed into building material for houses or furniture. Okay, sir. The enterprise weighted average cost of capital is 6% per annum. So they have given 6% per annum. So whenever they have given 6%, means some rate of interest given, yeah, weighted average cost of capital is given. One thing will come in mind, it is for discounting purpose. It is for discounting purpose. Only mature tree have established fair value by reference of quoted price in an active market. Well, only the mature tree will have the fair value. Okay, sir. The fair value inclusive of current transportation cost to get 100 log to the market from mature tree of the same grade as in the plantation as on 31st March 2017 is 171. Means right now, if any tree is matured, the fair value is 171. Correct? Means right now, if the age is 30, the fair value is what? 171. And as on 31st March 2018, the fair value become 165. Assume that there would be E-metric cash flow between now and the point of harvesting. The present value factor of rupees 1 at a rate of 6% for 19th year is 331 and 20 year is 0.312. State the value of such plantation as on 31st March 2017 and 18 and the gain or loss. This question I have taken because if suppose same question comes in exam, so you will not be, it is quite possible you are not able to understand what they want to ask. What they want to say, just try to understand. Right now it is 17 and after 1 year it will become 18. Right now the age is 10 and here the age will become 11. Correct? It means, can I say, to become mature tree it become 20 years is left and here 19 years is left. 19 years is left. This must you have understood. Means as on 31st March 2017, if the age is 10, how many years is left to become a mature tree? 20 year, correct? And as on 31st March 2018, the age will become 11. So remaining year for maturing, it is what, 19 year. Now they have given 171 is the fair value of a mature tree on this date and 165 is the fair value of mature tree on this date. Correct? This is of 30 year. So can you say we can apply the discounting factor to find out what can be the fair value if the age is 10 and 11 respectively. Means what will do? What will do? 171 into 20-year discounting factor you will take 0.312 into, because this is for one tree. Correct? Now you can the fair value for a mature tree of the same grade. This is for one tree. So how many total trees are there? 100. You will do into 100. Similarly, you will do 165 into 0.331 into 100. Yes, sir. Now what is the answer is coming, Bata? So it is coming 171 into 0.312 into 100. It's coming 5.335.2 and it's coming 165 into 0.331 into 100. It's coming 5461.5. Correct? And you can see the subsequent valuation has increased, so there will be gain. What is the gain? Minus ka to 533.5.2, so gain become 126.3. This is the answer. This type of question can be expected in what? MCQs. Can be expected in MCQs. Correct? You can see same answer has been given. So you can see the answer is very easy, but sometimes what happens, we are not able to understand the emotions of the question and therefore we are not able to write down the answer. Simple. Can we go to the other point? Question 12, this is also good question related to government grant. Now what Ind AS 21 says that any government grant related to biological asset other than bearer plant will be covered under Ind AS 41. Means any government grant related to bearer plant will be covered under Ind AS 20. So any government grant related to biological asset other than bearer plant will be covered under Ind AS 41. Now what Ind AS 41 says that, just try to understand what Ind AS 41 says, that initial measurement will be done at fair value less cost to sales. But sometimes what happens when you do initial measurement, fair value cannot be measured reliably. It is quite possible. Means you purchase some cow or there is some newly born biological asset. For newly born biological asset, quite possible we don't know the fair value. Correct? So what Ind AS 41 says that if initial measurement at a time of initial measurement fair value cannot be measured reliably, then you can use cost model for initial measurement. Cost model for initial measurement as per Ind AS 16, as per Ind AS 16. And if you are following cost model, then apply Ind AS 16, means same depreciation and impairment loss will be also calculated. But once the fair value can be measured reliably, from that point of time you need to shift from cost model to fair value model. Correct? Understood? Means it is quite possible that any biological asset other than bearer plant, initial measurement is done at fair value or initial measurement is done at cost model. Quite possible. If the initial measurement is done at cost model, then government grant related to biological asset in that case will be covered under Ind AS 20. But if initial measurement is done at fair value, then government grant related to that biological asset will be covered under Ind AS 41. Means there are 3 points. Have you understood? Any government grant related to bearer plant will be covered under Ind AS 20. Any government grant related to biological asset other than bearer plant and measured under cost model will be covered under Ind AS 20. But any government grant related to biological asset other than bearer plant which are initially measured at fair value will be covered under Ind AS 41. Now what Ind AS 41 says that if it is unconditional grant, then entire government grant will be transferred to profit and loss account immediately when the grant is received or receivable. But if it is conditional grant, the government grant will be transferred to profit and loss account only when condition is satisfied. Only when the condition is satisfied. Very simple. Accounting treatment is very simple. Now they have given Anu Limited is engaged in the sorry. Anu Limited is an entity engaged in the plantation and farming on a large scale and diversified across India. On 1st April 2018, the company has received a government grant for 20 lakhs subject to a condition that it will engage in the plantation of eucalyptus tree for coming period of 5 years. The management has a reasonable assurance that entity will comply with the condition of engaging the plantation of eucalyptus tree for a specified period of 5 years, and accordingly it recognized proportionate grant for 4 lakh in SOPL as income following the principle laid down in Ind AS 20. Accounting for government grant and disclosure means as per Ind AS 20 require evaluate whether the above accounting treatment made by the management is in compliance with the applicable Ind AS. Now just try to understand. It is entities engaged in plantation and farming. From this you have understood it is an agriculture activities. But one doubt will come about eucalyptus tree, whether this eucalyptus tree is a bearer plant or is not a bearer plant. Can you say even though we know the meaning of bearer plant, we know the meaning of bearer plant, but can I say from examination point of view it is quite possible we don't know that particular tree and we are not able to apply that condition. Now this eucalyptus tree is a bearer plant, is not a bearer plant, will be confused in exam hall. Whenever such a situation comes, so I will say answer in taking both the assumption. IC has also taken the same assumption. First they have assumed that it is not a bearer plant. If it is not a bearer plant, can I say the accounting of government grant related to that biological asset will be covered in the Ind AS 41, and because it is a conditional grant, it cannot be transferred to profit or loss account until the condition is satisfied. Then they have given one answer that if it is initially measured cost, then it will be then the government grant will be covered under Ind AS 20. In that case, can I say we can apply Ind AS 20? In that case also, can I say whenever it is covered under Ind AS 20, then the government grant will be transferred to profit and loss account only in the ratio of depreciation during the useful life of that particular asset. Then they have given one more assumption that last week they have given one note in case of eucalyptus tree is considered bearer plant, then Ind AS 20 will be applicable and not Ind AS 41. Means everything they have mentioned. So whenever you have a doubt about any trees, whether it is a bearer plant or not a bearer plant, correct? So first give answer as per Ind AS 41 and then also give an answer, an alternative answer. Suppose if it is a bearer plant, then it will be for recognition measurement will be covered under Ind AS 16, but for government grant it will be covered under Ind AS 20. That you can answer. Correct? It is an exam question, can be again repeated. Therefore, I have informed you. With this, we have covered all the points of Ind AS 41. All the question of Ind AS 41 has been covered. Ind AS 41, any more question you have a doubt? Just try to understand. Once I cover Ind AS 41, I will ask you if you have some other question in which you have doubt. So you can ask me, I will explain that also. Ind AS 41. After every Ind AS, we'll take a break of 5 minutes. Break of 5 minutes. Okay, sir. First, any more question about Ind AS 41 where you have doubt? One more point I will like to explain this. Sometime they will ask you about the price change and physical change. I will just explain that because that type of question can be also asked in exam. Suppose the initial fair value is 1000 and the age is 3 years. Here the fair value become 1500. So age is 4 year यहाँ पर. Correct. Now if the age is 3 year, then the fair value will be 1200. 1200. This type of information will be given. This is y0, this is y1. So they may ask you to calculate price change and physical change. Correct now. For the fair value changes. Correct. Now can I say this is what? This represent what? Price change. And this represent what? Physical change. Only this much. To write down increase due to price change is what? 200. And increase due to physical change is how much? 300. Total gain is what? 500. This will be transferred to PL account. So sometimes they ask you to calculate price change in physical change. So this is the way to calculate price change in physical change. Got this point? Yes, sir. We have covered Ind AS part 1. Now we'll do Ind AS 23. I'll take 5 minute break. So after every Ind AS, I will take 5 minute break. Chalega? Yes, sir. Now, everyone, ready everyone? Can we start one more Ind AS 23? Everyone, have you understood Ind AS 41? Just respond fast. Is the speed okay? Everything okay? Are you able to follow me? Whether this is beneficial or not, whatever we are doing, whether it is helping or not. Just respond me fast. Chali. We will start question Ind AS 23 with question number 7. Yes, sir. What is given? Alpha Limited on 1st April 2001 borrowed 9%, 30 lakh to finance the construction of two qualifying assets. So they have borrowed 30 lakh to finance the construction of two qualifying assets. One thing from the question we have understood is a specific borrowing. Now, whenever there is specific borrowing, the entire borrowing cost will be capitalized irrespective of expenditure. Normally, student यहीं पर mistake करते, they do mistake यहाँ पर. For specific borrowing, entire borrowing cost will be capitalized during the capitalization period. During the capitalization period, irrespective of expenditure. Suppose they have borrowed 10 lakh and expenditure is only 1 lakh, then also borrowing cost will be capitalized on 10 lakh, not on 1 lakh. Got this point? This is a special point which you need to keep in your mind. For general borrowing, borrowing cost will be capitalized only to the extent of expenditure incurred. Only to the extent of expenditure incurred. Yes, sir? Now, construction started on 1st April 2001. The loan facility was availed on 1st April 2001. So, you can say construction also started on 1st April and the loan was also taken on 1st April. Therefore, borrowing cost will be also capitalized from 1st April and was utilized as follow with remaining fund invested temporary at 70%. Now, for specific borrowing, if suppose the funds which are not utilized, so out of 10 lakh, suppose 1 lakh has the, suppose that loan amount is 10 lakh and 1 lakh is the expenditure incurred, so 9 lakh remain unused. So unused can be invested somewhere temporary, so any interest income earned on temporary investment will be deducted from borrowing cost and net amount will be capitalized, and the net amount will be capitalized. Yes, sir? So you can see 1st April 2001, on factory building 5 lakh was incurred, on office building 10 lakh was incurred. Means out of 30 lakh, you can see 15 lakh was incurred initially. So 15 lakh was not incurred initially. So that will be invested temporary somewhere. Yes, sir. Then that 15 lakh was incurred after 6 months. So 5 lakh, 10 lakh. Again 15 lakh was incurred after 6 months. So this 15 lakh which was incurred after 6 months, can you say was idle, was not used for the first 6 months. So for the first 6 months it will be invested temporary, and from where we can generate some interest income, and that interest income will be deducted from the borrowing cost, total borrowing cost, and that amount will be capitalized. Correct? So how to calculate? For factory building and office building, the borrowing cost on total loan amount. So you can see the total loan amount of factory building is 10 lakh and total loan amount of office building is 20 lakh. Total become 30 lakh. You can see 10 lakh into 9%, this is the borrowing cost. 20 lakh into 9%, this is the borrowing cost. From this we'll deduct what? Interest income. The interest income will be on 5 lakh, but the rate of interest 7%. You can see 5 lakh into 7% into 6 by 12 into 6 by 12. That is 17,500. The net amount will be capitalized. This net amount will be capitalized. Similarly, 10 lakh into 7% into 6 by 12, 35,000. This net amount will be capitalized. They also ask you to calculate the cost of the asset. So this become 10 lakh. This will be capitalized. This become 10 lakh 72,500. This is 20 lakh. This will be capitalized. This will become 21 lakh 45,000. Yes, sir. Very simple question. Of course, can be relevant for MCQs. This type of question now will be asked in MCQs. Yes, sir. Correct. This question 17 I will do at the end. Correct. Come to one more question. 21. This was recently given in RTP. What is the question? X Limited commenced the construction of a plant qualifying asset on 1st September 2001. Estimated to cost 10 crore. For this purpose, X has not raised any specific borrowing. Rather, it intends to use general borrowing, which have a weighted average cost of 11%. So they have given capitalization rate 11% is the weighted average cost, means capitalization rate is given. The total borrowing cost incurred during the period from 1st September 2001 to 31st March 2002 were 0.5 crore. So they have given total borrowing cost also. Total borrowing cost, what is the total borrowing cost? That information is also given. Okay. Now we need to find out of this borrowing cost how much will be capitalized and how much will be charged to profit and loss account. The other relevant details: cost of construction accrued and the cash outflow. Now just try to understand, we do accounting on accrual basis. Correct? We do accounting on accrual basis. Accrual basis means even though not paid, that will be accounted. That will be accounted. Correct? But the cash outflow paid in advance at the start of each month means this 3 crore was paid in advance in the month of September. Correct? However, the accrued was only 1.5. So one doubt will come कि whenever we apply capitalization rate will be applied on expenditure incurred. So that expenditure incurred will be calculated on accrual basis or on payment basis for the purpose of Ind AS 23. So it is on payment basis, not on accrual basis. Accounting will be done on accrual basis. But borrowing cost capitalization, when you do, so can I say it should be on payment basis only, because the borrowing will be used only when the amount is paid. Only when the amount is, whenever the expenditure has been paid. Therefore, this information relevant to find out borrowing cost to be capitalized. This information not at all relevant for calculation of borrowing cost to be capitalized. Got this point? Based on above information, discuss the treatment of borrowing cost as per cash outflow basis on accrual basis. First, they have asked how much borrowing cost will be capitalized on cash outflow basis and on accrual basis. Means first they have asked calculate on both basis. Calculate on both basis, okay. And also suggest the appropriate amount of interest that should be capitalized the cost of the plant in the financial statement for the year ended 31st March 2002. So you need to calculate first on both basis. So what you'll do? Batao. So can you say what you'll do? 1.50 you'll do in this way. 1.50 into what? Into 11%. 11%. Then for how many months? You can see 1, 2, 3, 4, 5, 6, 7. So you'll do into 7 by 12. Into 7 by 12. You can easily calculate now. What they have done, they have calculated first average expenditure and then they have multiplied by 11%. You can also do in that basis. Or you can do directly do 1.50 into 7 by 12 into 11%. Both will give same answer. Here you'll do into 11% into 6 by 12, then 5 by 12, then 3 by 12, like this. This is the borrowing cost on accrual basis. Then here you will do what? Into 11% into 7 by 12, like this you can do. You can find out this. So they have calculated first average expenditure. You can see this is the average expenditure on accrual basis. This is the average expenditure on payment basis. Understood? This much you can calculate. Now on this, on 2.74, you can see they have applied 11%. This is the borrowing cost to be capitalized if you have taken expenditure on accrual basis. And on 4.02, you can see 4.02 into 11% is coming 0.44. This is the borrowing cost which is eligible for capitalization when the expenditure is taken on payment basis. Understood? Now they have given, as per Ind AS 23, expenditure on qualifying asset include only those expenditure that have resulted in payment of cash. And therefore borrowing cost eligible for capitalization will be 0.44 crore, not 0.30 crore. This you need to mention. Correct? Now out of the total borrowing cost was how much? Total borrowing cost was 0.5 crore. How much will be capitalized? 0.44. The balance will be transferred to profit and loss account. So you can see this will be capitalized and the balance will be transferred to profit and loss account. This is the answer. Good question. But normally what happens, whenever we don't read this type of question, exam will be confused. One more good question. What is given? Harish Construction Company is constructing a huge building project consisting of 4 phases. It is expected that the full building will be constructed over several years, but phase 1 and phase 2 of building will be operational as soon as they are completed. Now, whenever a borrowing is taken for a particular project in which some of the project has been completed, the question arises, the project which has been completed, can we seize the capitalization of borrowing cost for that particular project? So what Ind AS 23 says that if that particular portion can be used separately or can be sold separately without the completion of other portion, then yes, borrowing cost capitalization can be seized for that particular project. So in this case, you can see phase 1 and phase 2 of the building will be operational as soon as they are completed. It means, can I say, once it will become ready for use, we can seize the capitalization of phase 1 and phase 2. Following is the details of the work done on a different phase of the building during current year. You can see cash expenditure, okay sir. Building purchase, okay sir. Total expenditure has been given. This is relevant. Total expenditure is relevant. Loan taken at the rate of 15% at the beginning of the year is how much? 200. Yes. After taking substantial period of construction at the mid of current year, phase 1 and phase 2 have become operation in the mid of the year. Means can is a 6-month borrowing cost will be capitalized for phase 1 and phase 2. Find out total amount to be capitalized, to be expense during capitalized, and to be expense means how much will be capitalized and how much will be the expense. Now be careful. Whenever expenditure is more than what? The amount of loan. Whenever expenditure is more than the amount of loan, in that case borrowing cost to be capitalized cannot exceed the actual borrowing cost. Actual borrowing cost. So in this case you need to be careful. So what we'll do? What is the total interest expense? So this is 200 lakhs. So on 200 lakh at 15% you have calculated total borrowing cost. Yes sir. Now what is the total expenditure on phase 1? That is 34 lakh and 64 lakh. So 34 lakh plus 64 lakh is 98 lakh. What is the total expenditure on phase 3 and phase 4? 55 plus 68, that is 123 lakh. The total expenditure become 221 lakh. 221 lakh. Now what we'll do? This 30 lakh will be allocated, because this 30 lakh is for the entire year. So this will be allocated to phase 1 and phase 2 and phase 3 and phase 4 in this ratio only. So you can see they have done ki interest on loan used for phase 1 and phase 2 is allocated on that ratio basis. 30 lakh into 98 divided by 221 will do. This amount will come. So this is allocated to phase 1, phase 2, and the balance will be allocated to phase 3 and phase 4. Now phase 1, phase 2, this is for 12 months. So 6 months will be capitalized and 6 months will be charged to profit and loss account. So 13 lakh 30,000, you can see 6 months half will be capitalized and half will be charged to profit and loss account as an expense. But for this, because it is not yet ready for use, the entire amount will be capitalized. So 16 lakh 69,683 will be the entire amount which will be capitalized, and this will be added to the work in progress, capital WIP of that building. Capital WIP of that building. Understood? Simple but good question. Chalega. One more question. This is highly expected in exam and lot of doubt is coming for this particular question. LT Limited is in the process of constructing a building. The construction process is expected to take about 18 months from 1st Jan 2001 to 30th June 2002. You can see the period 1st Jan 2001 to 30th June. So in this particular period, 18 months, there are actually 3 years. From 1st Jan 2001 to 31st March 2001. Then 1st April 2001 to 31st March 2002. Then from 1st April 2002 to 30th June 2002. Means 3 months, 12 months. 3 months, 12 months. Then 3 months. The building meet the definition of qualifying asset. Thank you very much. LT Limited incur the expenditure. So on 1st Jan, this is the expenditure. On 30th June, this is the expenditure. On 31st March, this is the expenditure. On 30th June, this is the expenditure. On 1st July 2001, LT Limited issued 10% redeemable debenture of 50 crore. The proceed from the debenture from the part of company's general borrowing, it form part of company's general borrowing. Okay, sir. Which it uses to finance the construction of qualifying asset. Correct. So this general borrowing will be used for the construction of qualifying asset, that is the building. LT Limited has no other borrowing before 1st July 2001 and did not incur any borrowing cost before that. Well, before 1st July there was no borrowing. LT Limited incurred 25 crore of construction cost before obtaining general borrowing on 1st July and 25 crore after obtaining the general borrowing. You can see this is the 1st July. 1st July. So before 1st July 25 crore was incurred and after 1st July 25 crore was incurred. This is already informed you, but once again given in the question. For each of the financial year 31st March 2001, 2 and 3. I say 3 year. Calculate borrowing cost to be capitalized as permitted under IND AS 23. Good question. Let me explain this particular point with calculation. I will explain this particular point with calculation. Can I explain? See, whenever this type of questions come now, I will always say prepare one timeline. Because once you prepare the timeline, you know the date. When you read the question, you are not able to identify the date. Correct now. So first write on date. 1st Jan, 30th June, 31st March. So 1st Jan, then 30th June, then 31st March 2002, then 30th June 2002. These are the date. Correct. So here it is 31st March 2001. This is 3 months. This is 12 months. And this is 3 months. And on first, what are the expenditure incurred? It is 5/20/25. Year 5/20/25. On 1st July, they have taken one loan of 50 crore. They have taken one loan for 50 crore. So of course, can I say borrowing cost will be incurred from this date? So can I say capitalization will begin from this year? Capitalization will begin from this date. Capitalization. Now the question arises, what will be the expenditure on which the capitalization rate will be applied? On which the capitalization rate will be applied? One thing is clear that for the first year, means for the year ended 31st March 2001, there was no borrowing cost, so there is no capitalization. So for this year, no capitalization. For this year, there is no capitalization. Correct. Now for year end 31st March 2002. Correct. Just try to understand. Now the question arises whether any expenditure which was incurred on 1st Jan 2001, whether that will be eligible, means expenditure incurred on that, whether you will calculate borrowing cost to be capitalized. Yes, yes. Just try to understand. The loan was taken at this point of time, but this was for the construction of this particular building, means there is quite possible that there was some delay in taking the loan. Understood now? And till the time being the loan was not availed, we have used our own resources. And once the loan was availed, can I say that loan fund will once again will be given back to the entity? Means the purpose of this loan is the construction of this what building only. You can see the total amount is 50 crore, even though it is not a specific borrowing. It is not a specific borrowing, but just try to understand this 5 crore was incurred before availment of loan, but can I say it will be part of, from this date it will be eligible for capitalization? Means I'm not saying will capitalize for this particular period. This 5 crore will be eligible for capitalization from this date. From this date means once the borrowing cost is incurred. Once the borrowing cost is incurred. So you can see on this 5 crore, what was the rate of interest? 10%. On this 5 crore, 10%. But for how many months? Month will be from 30th June to 31st March. 30th June, 31st March means 9 months. 9 by 12. 9 by 12. This will be capitalized. Then on this 20 crore, also what? 10% into 9 by 12. And on this 20 crore, it will be 10%, but it will be 0 by 12. Correct? This will be the borrowing cost to be capitalized for the second year. Borrowing cost to be capitalized for second year. This you have understood. So you can see, refer the answer. First year nil. Second year you can see 5 crore 9 by 12. 20 crore 9 by 12, 20 crore 0 by 12, and then they have first calculated average expenditure and then multiply by 10%. You can do directly also, that is your choice. 1.875 means for second year 1.875 will be the amount of borrowing cost which will be capitalized. Now coming to the third year. Third year is more interesting. For the year ended 31st March 2003. Correct. Now can you say on this 5 crore? Yes. So from this date to this date means 3 months. So on 5 crore into 10% into 3 by 12. Then again 20 crore into 10% into 3 by 12. Then again 20 crore into 10% into 3 by 12. Then on 30th June was what was incurred? 5 crore. So on this 5 crore, nothing will be capitalized because it will be 0 by 12. But the question is that whether on this 1.875 whatever interest which we calculated for the previous year, whether that will be considered as an expenditure on which capitalization rate will be applied for the next year. But yes, because this is the borrowing cost which has been capitalized in the previous year, so now it also become a part of expenditure. Correct. Now so 1.875, this will be also considered. This is the interesting point. For the first time they have given any question of this nature in ICI resource, so very relevant, can be asked in exam. Into 10%, this will be 3 by 12. This will be 3 by 12. Have you understood? Calculation you can do. Calculation you can do. Have you understood this point? Respond fast. बोलिए. You can see what they have done. 5 crore 3 by 12, 20 crore 3 by 12, 20 crore 3 by 12, 1.875 3 by 12, 5 crore 0 by 12. This is the average expenditure multiplied by 10%, this amount came. Have you understood this point fast? This is 100% expected in exam. Means I am expecting this question in exam. Have you understood or not? Please respond fast. Okay. Can we come to next question? This is also a good question. Asked in recent RTP. PQL Limited is engaged in the tourism business in India. The company has planned to construct a holiday resort qualifying asset at Simla. The cost of project has been made out of borrowed fund of 100 lakh at a rate of 12% per annum. At a rate of 12% per annum. Okay. 40 lakh were disbursed on 1st April 2002. Well, 40 lakh has been disbursed on which date on 1st April 2002, and the balance 60 lakh were disbursed on 1st June 2002. Okay. The site planning work commenced on 1st June 2002 since the chief engineer of the project was on medical leave. So site planning work was commenced on 1st June. So on the 1st June entire loan amount was received. On 1st June entire loan amount was received. The company commenced physical construction on 1st July 2002 and the work of construction continued till 30th September 2002. The physical construction was started on 1st July 2002 and the work of construction continued till 30th September 2002. Thereafter, the construction activity stopped due to landslide on the road which lead to the construction site. So the development was interrupted due to some landslide. Okay. So this will result in suspension of capitalization. I hope you remember when to suspend capitalization. The road blockades have been cleared by the government machinery by 31st December 2002. Means from 30th September, correct now, means in the month of October, November, December, there was no development. Construction activity have resumed on 1st Jan and has completed on 20th Feb. The date of opening has been scheduled for 1st March, but unfortunately, the district admin give permission for opening on 16th March due to lack of safety measure like fire extinguisher which had not been installed by them. Determine the amount of borrowing cost to be capitalized toward the construction of resort when. First, they have given two cases. Landslide is not common in Simla. Landslide is not common in Simla. And delay in approval from district admin office is minor administrative work. Now just try to understand what India 23 says that whenever active development is interrupted, whenever active development is interrupted, correct now, then of course borrowing cost capitalization should be suspended. But whenever active development is interrupted due to some necessary activities, then it should not be suspended. Got this point? Now, what they have given, landslide is not common in Simla. When I am saying landslide is not common in Simla, so it means in this case, whenever it is not common, are you getting what I am saying? So it means it is one type of unnecessary activities. So in this case, what we'll do, we'll suspend borrowing cost capitalization. The second point, they have given delay in approval from district administrative office is minor. So what India 23 says that we need to cease capitalization when substantially all the activities has been performed due to which the asset is asset is now ready for use or ready for sale. So can you say because it is a minor administrative work, this should not be considered and we should cease capitalization at that point of time only when we need to cease capitalization on 28th Feb. So we'll ignore the minor administrative work. Minor administrative work. So there are 2 points. Can you say date of cessation will be 28/5? Date of suspension will be 30th September 2002. Now the question is that what is the date of commencement of capitalization? Two date are there. 1st June 2002 and 1st July 2002. One doubt will come here. Means we need to find out what is the date of commencement. Are you able to understand? Means if I draw, just try to understand. This is 1st June. This is 1st July. This is 30th September. This is 28th Feb. And what is the last date? 16th March, na? 16th March. 16th March. So can I say this will be the date of suspension? Means from this date to this date, no capitalization. Sorry. Achha, when it was recommence? Recommence on 1st Jan. 1st Jan. It was recommence on 1st Jan. So this is the date of suspension. You can see October, November, December. 3 months suspended. Here it will cease. Cease. Means we'll do capitalization for what? Jan. 2 month capitalization will be done. Now the question is that we need to commence capitalization from 1st June ki 1st July. What do you think? We should commence capitalization from 1st June ki 1st July. I think there is no doubt about suspension and there is no doubt about the cessation of borrowing cost capitalization. Am I right or not? Correct. On this date it will be ceased because minor administrative work will not be taken into consideration. And can you say, of course, because landslide is not common. Landslide is not common. So can you say this become, whenever landslide came, it become unnecessary activities. Means we are not aware about that. So active development is interrupted. Active development is interrupted, so we'll suspend capitalization. Now the question is that we should commence capitalization from 16 की 17. Borrowing cost incurred यहाँ पर. Physical construction started यहाँ पर. Correct ना? Physical construction started यहाँ पर, and on 1st June the site planning work commences. Means site planning work. So site planning work has commenced यहाँ पर. But from your point of view, we should commence from 1st June की 1st 7. Everyone. Why I am explaining this point? Because here only you can do mistake in exam. Respond fast. From your point of view, it is 1st June ki 1st July. Madhu, what you have written? YSL means what? First June. Everyone saying 1st June? Now, if we read Ind AS 23, what Ind AS 23 has mentioned, let me explain that first point. What they are saying? As per Ind AS 23 borrowing cost, the commencement date for capitalization of borrowing cost on qualifying as is date when the entity first meets all the following conditions. All the following conditions. With the point of time when all these following conditions are satisfied, that become the commencement date. Correct now? Means the point of time when cumulatively all these three conditions are satisfied, from that point of time will commence capitalization. Correct? Now it incur expenditure for the asset. It incur expenditure. Can I say 1st July? It incur borrowing cost 1st June. It undertake activities, means site planning work, that are necessary to prepare the asset. This is 1st June. My question to you all, when, at which point of time all the three conditions are satisfied? You only say, at which point of time all these three conditions are satisfied? 1 June ki 1 7. Everyone. Everyone. At which point of time all these three conditions are satisfied? on a cumulative basis. Because physical construction started on 1st July. Correct. So can I say at this point of time, actually all these three conditions are satisfied? Because site planning work commenced on 1st June, but that time expenditure was not incurred. That time expenditure was not incurred. Got this point? You can read the question. If you read, the site planning work commenced on 1st June 2002. Since the chief engineer of the project was on medical leave, the company commenced the physical construction on 1st July. So from your point of view, at which point of time all the three conditions are satisfied, at which point of time 1st July, but the answer given by ICI is 1st June. So I will say, देखो, if you are conceptually strong, you will give some answer which is different from ICI. Then also I am just explaining this point. If the same to same questions come in exam, if the same to same question come in exam, your answer should be of 1st June also. 1st June only. Means you have also given 1st June. I don't know why you have given 1st June, because you might happen, you know this question solution, means you have done this question previously, and because that is then you are saying 1st June. Correct now. But from my point of view, answer should be 1st July. But remember this point. Now in this particular question, what assumption they have taken, I don't know whether this assumption is correct or not. Ki site planning work also some expenditure will be involved. The expenditure is generated from 1st June only. That is the assumption might have been taken by ICI. Correct. So in this case, since the site planning work started, but site planning work started, there is no expenditure incurred on qualifying asset. Are you able to understand now? Are you able to understand? So from my point of view, the commencement date should be 1st July, but from ICI point of view, the commencement date is 1st June. We'll also take 1st June from examination point of view. Don't do mistake यहाँ पर. Correct. So from 1st June we'll take. So this is the commencement date. So this is how many months? But 1st June, June, July, August, September. So 4 months and plus 2 months, 6 month capitalization. So we'll do 6 month capitalization. So you can see what the answer they have given. 6 month capitalization they have given. Check karo. So 10 lakh, it is 1 crore into 6 by 12 into 12%. 6 month capitalization has been done. But you write down careful, you write down all the points. What is the commencement date? What is the point of suspension? What is the point of seizing of what? Borrowing cost to be capitalized. If you write down clearly, then only they will give mark. One more question was there. Landslide is common in Simla. Now, whenever landslide is common in Simla, whenever it is common, can you see we are aware of the fact that landslide is going to come? So, if you are aware of the fact, can I say, then can I say there is no suspension? There is no suspension. It means in this no suspension will be there, but they have given delay in approval from district admin is a major admin work left over. So if it is a major work, so can substantially the asset is not ready. Substantially, if the asset is not ready, it will be ready only when the major administrative work has been done. That is on 16th March. So it means from 1st June to 16th March, this becomes the period of capitalization. It will be June, July, August, September, October, November, December, January, February. Means it becomes 9.5 months. 9.5 months. So you can see they have done 9.5 months only. Check karo. 9.5 months. Understood. Good question. Good question. Are you able to follow me? Yes, sir. One more question. Come to this particular point. However, from this particular para, last time MCQ have been asked, I think so. An entity can borrow fund in its functional currency at 12%. Means if they borrow fund in INR, the rate of interest is 12%. However, they borrowed $1,000 at 4% on 1st April 2001 when the rate was $1 is equal to 40. The equivalent amount in functional currency is 40,000. Interest payable on 31st March 2002. On 31st March 2002, the exchange rate become 50. The loan is not due for repayment. Compute the exchange loss and borrowing cost to be capitalized as on 31st March 2002. Now what Ind AS 23 says that if we have taken any foreign currency borrowing, then exchange difference to the extent it is regarded as an adjustment to interest cost will be covered under Ind AS 23. So how much exchange difference, exchange loss, which will be adjusted as an interest cost, that we need to calculate. Correct? So in this case, what we need to find out? First, we need to find out borrowing cost. In funds foreign currency and funds the currency. FUC means funds the currency means rupees and this is dollar. So what is the amount of loan? $1,000. What is the rate of interest? 4%. So 1,000 into 4%, that becomes $40. Now 40 into what is the date of payment of interest? 31st March 2002. At the time it was 50. So into 50 will do, into 50. So 40 into 50 is equal to how much? 2,000. If the loan would have been taken in functional currency, then the amount of loan will be 40,000. It is given 1,000 and the exchange rate on that date when we have taken loan was 40 into the rate of interest was 12%. So 40,000 into 12% is how much? 4,800. Correct. Now what is the exchange loss? Exchange loss is 1,000 into 10 because 40 now become 50. Correct. It become 10,000. Now out of these we need to find out how much will be covered under 23 and how much will be covered under 21. This we need to find out. So what our Ind AS 23 says that the lower of these two will be covered under Ind AS 23. So lower of these two means what? Actual exchange loss. Exchange loss is how much? 10,000. And second, the difference between these two interests. Difference between these two interests, that is 2,800. So what is the lower? Lower is this. So 2,800 will be covered under Ind AS 23 and balance. Balance means 10,000 minus 2,800. So 10,000 minus 2,800, 7,200 will be covered under Ind AS 21. This will be transferred to profit and loss account and this can be capitalized if all the condition of Ind AS 23 is satisfied. If all the condition of Ind AS 23 will be satisfied. So what you need to find out how much exchange loss will be covered under Ind AS 23 will be lower of two amount. Lower of two amount means first is what? Exchange loss. Second is difference between the interest which you have calculated based on functional currency borrowing and foreign currency borrowing. Sir, will you take other than small India's practice expected to like Arya? That I will decide because what happened that I will decide depending upon everything. Sure, Arya, I will answer your point at the end of the class. Okay? Okay, sir? Yes, sir. Have you understood this? One more question they have asked in this. What will be the exchange loss and borrowing cost to be capitalized as on 31st March 2002 if the exchange rate become 41? So if that is the case, तो check करेंगे if it become 41 now. So in that case, your borrowing cost under foreign currency will be what? 1,000 into 4% into 41. That is coming 1640. And this will be 40,000 into 12%. That is 4,800. Exchange loss will be 1,000 into 1. That is 1,000. Now how much will be covered in 23 and 21? This will be lower of A. A is what? 1,000. B will be difference between these two. That is 4,800 minus 1640. That is 3,160. So 1,000, the entire will be covered under Ind AS 23 and nothing will be covered under Ind AS 21. Understood? Good question. Already I think it was asked in last attempt. MCQs can be also repeated. Now this type of question become relevant for MCQs. Yes, sir. One more question I have already left. Let us do that also. This question. Expected. This is a question of group consolidated financial statement. In that case, how the borrowing cost will be capitalized. In a group with parent company P, there are three subsidiaries with the following business. A, real estate company, B, construction company, C, finance company. So parent company is P, there are three subsidiaries. Parent company has no operating activities of its own but perform management function for its subsidiaries. Financing activities and cash management in the group are coordinated centrally. Finance company is a vehicle used by the group solely for raising finance. Means finance company only raise finance. All the entities in the group prepare Ind AS. All the companies Ind AS is followed. The following information relevant for current reporting period 1 and 2. Real estate company. Borrowing is how much? 10 lakh with an interest of 7%. Expenditure on qualifying asset during that period is 15 lakh 40,000. All the construction work were performed by construction company. Means real estate company, the for real estate company, construction is done by a group company, that is construction company. Means this 15 lakh 40,000 include profit of construction company, which will be eliminated in CFS. But in the standalone financial statement, that elimination is not required. Means the expenditure for real estate company is 15 lakh 40,000. Amount invoiced to real estate company included 10% profit margin. So this will be eliminated in CFS. Correct? Yes, sir. Now just try to understand this borrowing. Of course, borrowing is 10 lakh. Nothing has been given. So it is general borrowing. It is a general borrowing. Now here, because the expenditure is more than borrowing, the entire borrowing cost will be capitalized. So can you say 7% to 10 lakh, 70,000 will be capitalized. 70,000 borrowing cost will be capitalized because for real estate company, there is a borrowing as well as expenditure on qualifying asset. I think no doubt about real estate company. Construction company, no borrowing. If there is no borrowing, the question of capitalization will not arise. So therefore, no borrowing cost will be capitalized. However, finance 10 lakh of expenditure on qualifying asset using its own cash resource. So they have used their own cash resource for construction of some qualifying asset. But there is no borrowing, no capitalization will be, no capitalization is required. Finance company, once again, finance company, they will take loan and they will transfer the loan. So they have raised 20 lakh loan at 7% externally, issued a loan to parent company for general corporate purpose at a rate of 8%. So can I say in this case also there is no qualifying asset, the question of capitalization will not arise. Correct. So here also no capitalization. Parent company use loan from finance company to acquire new subsidiary. So this loan will be used to acquire subsidiary. No qualifying asset apart from those in real estate company and construction company. Parent company did not issue any loan to any other entity during the period. Now coming to parent company, I need to explain. For a parent company, when I am saying parent company and question is silent, always think from consolidation point of view. Don't think from standalone point of view. Got this point? So there are two borrowing. One is borrowing one, that is 10 lakh, 10%, sorry, 7%, which was in real estate company. Second borrowing two of finance company. Now, finance company has taken one loan which has been transferred to parent company. So can I say that become one, whatever has been transferred to parent company, that become intra-group transaction, that will be eliminated. Means the borrowing amount will be how much? Borrowing amount is 20 lakh and 7% will be considered, 8% will not be considered in consolidated financial statement. Got this point? So 20 lakh, 7%. Correct. And there are two qualifying assets. One is qualifying asset 1, that is 15 lakh 40,000. But this include profit margin of construction company at a rate of 10%. So 15 lakh 40,000 into 10 divided by 110 you will do. So into 10 divided by 110, this is coming 1 lakh 40,000. So 1 lakh 40,000 will be eliminated. The cost will be only 14 lakh. 14 lakh for consolidated financial statement. And this one qualifying asset 2. Qualifying asset 2 is what? You can see it was finance 10 lakh of expenditure. So this is 10 lakh. So you can see whenever you are in CFS, so from exam, I will not discuss much. You just try to understand from consolidation point of view. Means now consider this as a single entity. This consider it as a single entity. So there are two borrowing and there are two qualifying assets. Therefore, this borrowing cost will be capitalized. This borrowing cost will be capitalized because they are general borrowing. We need to first calculate capitalization rate because these both are 7%. Capitalization rate will be also 7%. So into 7% will be capitalized. Into 7% will be capitalized. Understood? Because in this case the expenditure is less than the total loan. So entire borrowing cost, whatever you have calculated यहाँ पे into 7%, 7% will be capitalized. Correct? So borrowing cost capitalized is less than the actual borrowing cost. The difference whatever is there borrowing cost, that will be charged to profit and loss account as an expense. Got this point? Have you understood? This question can be asked in exam because till now not asked. Till now not asked. IND AS 23 done. Now IND AS 23 from my point of view I have done. Do you have any question which you want me to take from ICA resource? Any other question? Bolo fast. 1 to 1 with you. 1 to 1 with you. What's your name? Sir, I became CA in May 24. Just came here to thank you for your guidance. Still following you. Still refer your videos for interview preparation. Just came to thank you. Thank you 1 to 1. But what's your name 1 to 1? Mention your name always. Why you hiding your name? Don't change your name because I think your name is your face value. So don't change your name. You are identified by your name. Correct now. So when you change your name, so you are actually not disclosing your identity, and your identity CA is known by their name only. Yes, sir. Any other question? If you have understood India's 23, can you respond yes, sir, so that I can go to other Indias? Second question once, please tell sir. Second question means this last one only. Second question means question 17 you are saying? The last one, na? Second question means what you are saying. Write down fully so that I can understand. Because right now I will understand your emotions only by your message. Second question means you are saying about this 21. Question number, please. I think you are saying about 23. 23. This is correct. 23. 23. Once again. So what I have explained, just listen me. This was the question. Just what happened in this question? On 1st Jan, they have incurred an expenditure of 5 crore. On 30th June, they have incurred an expenditure of 20 crore. On 31st March 2002, they again incurred an expenditure of 20 crore. And on 30th June, they have incurred an expenditure of 5 crore. So you can see in this, there are 3 years. In this, there are 3 years. Correct. Now they have taken up debenture, they have issued debenture on 1st July 2001. Means from this date, means one thing is clear that expenditure was incurred and as well as borrowing cost was incurred from this date. So this is the date when the borrowing cost will commence. Borrowing cost capitalization will commence. This must you have understood. Means borrowing cost can be capitalized from first. Borrowing cost can be capitalized from 1st July. This much you have understood. Now just try to understand what Ind AS 23 says, that expenditure on which capitalization rate will be applied is the expenditure which has been incurred, not from this date, which may be incurred from prior date also. Just try to understand 5 crore was incurred on this date. So when this 5 crore was incurred, you have no borrowing. So it means you have used your own resources. Just try to understand. You have used your own resources. But can I say, now you have received the loan, so out of this 50 crore, 5 crore, you will give back to the entity now. Whatever you have used for the from own resources. Means now out of this 5 crore, this has been taken into consideration from this date or not. Therefore, this 5 crore will be eligible for capitalization from 1st July. From 1st July 2001. It means for the first year, means from 1st Jan 2001 to 31st March 2001, there was no borrowing, has no capitalization. This is clear. I think no borrowing, no capitalization. I think in this no doubt. But can I say for this particular year, for the second year, borrowing cost will be capitalized for the from 1st July, means for 9 months. Whether this 5 crore which has been incurred before the availment of loan will be considered for capitalization. Yes, it will be considered because this is the expenditure already incurred on qualifying asset only, and therefore that will be taken into consideration. But for how many months? 9 months. But for how many months? 9 months. So you can see on this 5 crore, we have done capitalization, but for 9 months. On this 20 crore, this was incurred on this date, 9 months. But on this 20 crore, which was incurred on 31st March, can you say, which was incurred on 31st March, no capitalization because it was not incurred during this 9 months. Understood. Therefore, you can see 9 by 12, 9 by 12, and 0 by 12. And this will come 1.875. Now, coming to the next last year, so can you say once again 3 month borrowing cost will be capitalized for this 5 crore, yes, for this 20 crore, yes, for this 20 crore, yes, but for this 5 crore, no, because this was incurred on the last date. But this 5 crore, 20 crore, 20 crore, 3 month capitalization will be done. Now the question arises, what about the previous year borrowing cost capitalized 1.875? Yes, because that is also part of expenditure. Now that will be included in the carrying amount of asset. Correct. So that 1.875 will be also considered for capitalization for how many month? 3 months. For how many month? 3 months. Understood? Have you understood now? You can see 3 by 12, 3 by 12, 3 by 12. This 5 crore 0 by 12 and 1.875 3 by 12. Understood? Now understood? Any other question? No? Yes, sir. So we have done this. We'll take 5 minute break. After 5 minute break, we'll start one more Indias. Which Indias you want? Respond fast. Let us take Indias 21. We'll take Indias 21. Okay? Yes, sir. No. Now, everyone, can we start India as 21? Yes, sir. Let us start with the question number 8. Now, question number 8 is one of the favorite from institute point of view, have been asked many times in exam. I don't know what is the reason behind that, but have been asked three, I think at least three times in exam. Can be again repeated. Can be again repeated. M Limited is engaged in the business of manufacturing a bottle of pharmaceutical company and non-pharmaceutical company. It is a wholly owned subsidiary G Limited which is engaged in the business of pharmaceutical. G Limited purchased the pharmaceutical bottle from its parent company. Means in the first para it is given M Limited is a parent company, correct? And G Limited is a subsidiary company. This first para you can read. Now M Limited sold pharmaceutical bottle to G Limited for euro 12 lakh, correct? On 1st Feb 2001, and the cost of this bottle was 830 lakh in the books of M Limited. Now it is given in the question that euro is the functional currency of G Limited and Indian rupee is the functional currency of M Limited. So for M Limited, can I say it become a foreign currency transaction because the transaction is denominated in euro. So for M Limited, it become a foreign currency transaction. For G Limited, it is a functional currency transaction. This much you have understood? Yes, sir. At year end, that is on 31st March 2021, all these bottles were lying as closing stock with G Limited. Exchange rate on the date of transaction they have given 83. Exchange rate on 31st March they have given 85. Provide the accounting treatment for the above in the books of M Limited and G Limited. Also show its impact on consolidated financial statement. Support your answer by journal entry wherever necessary in the books of M Limited. Now can you say first we'll do in the books of M Limited. M Limited has done a sale transaction. So what journal entry? Journal entry will be what? Receivable account debit to sales. Or you can say G Limited account debit to sales or revenue. So G Limited account debit to sales. What is the amount of euro? It is 12 lakh. So 12 lakh into what? 83 you'll do? Into 83. Low. So 12 into 83 is equal to how much? 996. Correct. One more journal entry you can do that they have not done. They have not done. They have given the cost of this bottle is 830 lakh. So once the revenue is recognized, the inventory will be de-recognized. It will become expense. So you can pass one more journal entry. Cost of sales to inventory. Cost of sales to inventory. Cost of sales account debit to inventory 830 lakh. This also you can do. Now can you see because it is a foreign, because this receivable, this M Limited, this is receivable, this is a foreign currency monetary item. So on 31st March, it will be translated by using closing exchange rate. The closing exchange rate become what? 85. So of course the receivable will increase and increase will be gain. Gain means exchange gain. That exchange gain will be transferred to profit and loss account. So that gain will be how much? 12 into 2, that is 24. So what journal entry will do? Receivable account debit to exchange gain and exchange gain will be transferred to profit and loss account. They have done G Limited account debit to exchange difference and that will be transferred to profit and loss account. This is the journal entry in the books of M Limited. Now let us come to G Limited. Now can you say for G Limited they have not done any journal entry, but can you say they have done the journal entry, but the journal entry will be done in euro. The journal entry will be done in the euro. The journal entry will be what? Purchase account debit to payable. Purchase account debit to payable 12 lakh euro. Purchase account debit to payable. Now can you say because their financial statement will be prepared in their functional currency for consolidation purpose, their financial statement of any foreign operation will be translated in the functional currency of parent company. Means this need to be translated in rupees for consolidation purpose. Now what India is 21 says that all the assets and liability will be translated by using closing exchange rate. So can this purchase means inventory. Purchase means inventory. This inventory and this payable both will be translated by using closing exchange rate. So we'll do into 85 into 85, correct. Now so 12 into 85, how much it is coming? 1020, and this will come also 1020, correct. Understood. So this point they have not mentioned here. You can mention that for consolidation purpose, this inventory and payable will be translated by using closing exchange rate as per India's 21. As per India's 21. Correct. Now coming to consolidated financial statement, you can see the receivable in the books of M Limited was 996 plus 24, that is 1020, and the payable in the books of G Limited is also 1020. That will be cancelled. That will be cancelled. So you can pass one journal entry payable account debit to receivable in consolidated books of account. The accounting treatment, they have not done journal entry, but you can pass one journal entry receivable account, payable account debit to receivable. How much? 1020. That will be eliminated. Now this inventory is not yet sold, to that include the profit of what parent company, that need to be also eliminated, because that profit is unrealized profit. That profit is unrealized profit. So how much profit is included? That is simple. Can the cost price was how much? It was 830. So 996 minus 830, 996 minus 830 is equal to how much? 166. That is the unrealized profit which is included in the stock of subsidiary company. That will be eliminated. That will be eliminated. So that they have given one consolidation journal entry they have done ki consolidated profit and loss account, or you can say retained earning account debit to inventory, or you can say consolidated profit and loss account to inventory. How much? 166. But they have given one information like this is not relevant, I will say, because if the question is silent about NRV of inventory, we'll always assume that NRV is more than the cost price and no write down will be done. But what they have done ki cost price is 996, NRV assumed same. Assume means what? 1020. This assume same. The cost price will be translated as per the rate using what? Transaction date rate. And NRB assume same. That will be translated by using what? The exchange rate on the date of valuation. So you can see there is no write down. Correct now. So this, if you want to work out. However, just try to. It is quite possible. In that case, suppose this become 81, then of course write down is required. But till now, whatever question has came in exam, there was no write down. Understood this point? Therefore, no write off is required. This also give as a working note. Have you understood? Bolo. Have you understood this point? Yes, sir. One more question. This is also super important question, have been asked, I think 2 times in exam and given in RTP, MTP many times. On 30th Jan 2001, A Limited purchased a machinery for $5,000 from USA supplier on credit basis. A Limited functional currency is rupees. The exchange rate on the date of transaction, that is on the date of transaction means on 30th Jan, it is $1 is equal to 60. So again, they have purchased one machinery on credit basis. What journal entry will do? Machinery account debit to payable. Machinery account debit to payable on 30th Jan. It is 5,000 into 60. 5,000 into 60 means 3 lakh. The first journal entry you can see they have them machinery account debit to payable 3 lakh. Now this machinery is foreign currency non-monetary item, and this creditor is foreign currency monetary item. Now what Ind AS 21 says that any foreign currency monetary item will be translated by using closing exchange rate. But any foreign currency non-monetary item will not be translated if they are carried at cost. But if they are carried at fair value, then it will be translated as per the exchange rate when the fair value was determined. Correct? Means if this machinery is carried at cost price, no translation. But if it is carried at fair value, then we'll need to translate by using the rate, exchange rate when that fair value is determined. Correct? So in this, of course, revaluation model has been given, so that translation wala point will come for foreign currency non-monetary item also. Yes, sir. Now the fair value machinery determined on 31st March 2001 is 5,500. The exchange rate on 31st March 2001 is 65. The payment to overseas supplier was done on 31st March 2002 next year, and the exchange rate on that date is 67. The fair value of machinery remain unchanged for the year ended 31st March 2002. Means on 31st March 2002 the fair value remains same, means 5,500. Prepare the journal entries. Okay. Now what we'll do for the subsequent reporting date. So on 31st March 2001, first for payable, can you say 60 becomes 65? So there is an increase in liability that become exchange loss. So what journal entry will do? Exchange loss account debit to payable increase by 5 per dollar. So 5,000 into 5, that is 5,000 into 5, that is 25,000. So what journal entry will do? Profit and loss account directly or exchange loss account debit to payable. This too I hope you have understood. Correct. Now just try to understand one more point. For this particular question, they have not given rate of depreciation for machinery. Of course, in your examination, it is quite possible they have given rate of depreciation. So you think about depreciation of machinery also. But if the rate of depreciation not given, ignore depreciation wala point for this particular question. So directly we'll do revaluation. Directly we'll do revaluation. Correct now. Now for machinery, what is the revalued amount? 5,500. What is the exchange rate on that date? The 5,500 into 65, that is coming 3,57,500. And what is the carrying amount? Carrying amount, because we have ignored depreciation, it is coming 3 lakh. If suppose depreciation is there, so this carrying amount will be after depreciation. After depreciation, be careful about that particular point. Chalega? So it is coming 57,500. Now out of this, there is some revaluation gain and there is some exchange gain. So how much revaluation gain, how much exchange gain, that you need to calculate. So guys, the revaluation gain, because increase is $500 into 65, into 60, into 60 you'll do, into 60. So 30,000 is revaluation gain, and you can see it become 5,500 and the difference in the rate is 5. So 5,500 into 5 is equal to 27,500. That is exchange gain. Now what Ind AS 21 says that if any exchange difference of foreign currency monetary item, it will be transferred to PL. But for foreign currency non-monetary item, if the revaluation gain or loss is transferred to PL, then exchange gain or loss will be also transferred to PL. But if revaluation gain or loss is transferred to OCI, then exchange gain or loss will be also transferred to OCI. So in this case, revaluation gain is transferred to OCI and accumulated in revaluation surplus. So this exchange gain will be also transferred to OCI and accumulated in revaluation surplus. This is the concept. Have you understood? So you can see they have done two journal entry for 30,000 and 27,500, two separate journal entry. However, in exam you can pass one journal entry also because the journal entry remains same. Machinery account debit to OCI revaluation surplus. Machinery account debit to OCI revaluation surplus. Now because they have given tax rate, you can see they have given tax rate 30%. So tax rate, can you say on that OCI component you need to also find out deferred tax as per Ind AS 12. Correct. So because the total gain was how much? 57,500, which will be taxable in future. So it will become a taxable temporary difference on which DTL will be calculated. So 57,500 into 30%, it is coming what? 17,250. So one journal entry will do OCI account debit to DTL. So now Ind AS 12 says that deferred tax will be transferred to PL or OCI as per the transaction. If the transaction has been transferred to PL, deferred tax will be also transferred to PL. If the transaction has been transferred to OCI, deferred tax will be also transferred to OCI. This you have understood. You can see revaluation surplus OCI to DTL. This you have understood. Come on, next reporting date, 31st March 2002. Now the payment has been done. The payment has been done at when the rate was 67. So 65 now becomes 67. The 2 rupees difference, 2 rupees per dollar difference, that become exchange loss. So creditor account debit to bank and the difference will be transferred to loss. Loss will be transferred to profit and loss account. So creditor, it was initially previously measured at 65, but payment will be done at 67. Payment will be done at 67. Means 5,000 into 67. The difference up to 5,000 into that will be transferred to PL. Correct. Now once again we'll come to 31st March 2002, but there is no changes in revaluation. Means can I say it is still 5,500? But now what has been changed? The exchange rate now becomes 67. So 2 rupees difference will come. 5,502, that is what? 11,000. So once again this gain will be transferred to OCI. The journal entry will be what? Machinery account debit to revaluation surplus 11,000, and on this 11,000 once again DTL will be created. And once again the same journal entry revaluation surplus OCI to DTL. Good question, can be asked again. Can be asked again. Can we proceed? Yes sir. 14, this I am expecting till now not asked in exam, but you can see RTP, MTP 2 times they have given. Recently also MTP May 2023 is given. This is based on Appendix B to Ind AS. This question is totally based on Appendix B to Ind AS 21. What is the question? Let me explain. Supply A enter into contract with customer B on 1st Jan 2018 to deliver goods in exchange for the total consideration of 50 million and receive an upfront payment of 20 million on this date. Means the contract price was $50 million, but on advance they have received $20 million. The functional currency of the supplier is INR. The goods are delivered and revenue recognized on 31st March 18. The control was transferred on 31st March 2018, means revenue will be recognized on 31st March 2018. US dollar 30 million received on 1st April 2018 in full and final settlement on the purchase consideration. Now they have given on 1st Jan the rate is 72, on 31st March the rate is 75. Now what they want to ask, what is the date of transaction for advance consideration recognition revenue? So again, date of transaction for from the point of India's 21 when the transaction occurred. So you have received advance on 1st Jan. So date of transaction for advance consideration will be 1st Jan and the date of transaction for recognition revenue will be 31st March. This you can write down. Also take the amount, also state the amount of revenue to be recognized on the date of recognition. This I need to explain. So just try to understand. On 1st Jan, what journal entry will do? On 1st Jan, you have received advance. So bank account, debit to advance. How much? $20 million. That time rate was 72. So 20 into 72, that is 1440. Can you say this you have understood? Now on 31st March, you have recognized revenue. So advance account debit, receivable because the amount was received in the next day. So right now receivable, true revenue. Now you will say me, this 20 million, this 30 million, this $50 million. So this will be translated by using which rate? Here only you can do mistake. So you will say me advance, which rate will come? Means there are two rates, 72 and 75. For receivable which rate and for revenue which rate? Batao. Everyone, here only you can do mistake. Everyone please respond fast. Have you understood my question? Now just try to understand. Advance is a foreign currency non-monetary item. So whenever there is a foreign currency non-monetary item, can I say, no translation required because that is carried cost. So this will be at 72 only. But receivable, right now you are recognizing that will be based on transaction rate, exchange rate, that will be 75. So this is coming what, 20 into 72, that is 1440, and 30 into 75, that is 2250, and this 50 into, no, you will not do 50 into multiply by 75. If you are doing that, that is wrong. Your total revenue will be what? 1440 plus 2250, that is what? 3690. So your revenue to be recognized will be 3690. Understood? यहाँ पर ना Veligula, you are saying wrong. Receivable 75 correct, but revenue not by using average rate. You will do sum total of this and that will be 3690. Got this point? Means out of this much already received. Whatever already received, for that you will not do any translation. This is not a received, that will be receivable. For that you will take transaction exchange rate. And on 1st April when it is received, can I say again you will use the closing exchange rate of that day. For example, suppose $1 now become, suppose it becomes 76. So you will use this rate for translation because this is foreign currency monetary item. So receivable is foreign currency monetary item. Advance is not foreign currency monetary item. This you have understood. This is given under appendix B to Ind AS 21. Chalega. This question is not yet asked, super important, can be asked in exam. And you will do mistake. Okay sir, can we proceed? Yes sir. Come to question number 15. This also normally have been asked in exam, can be again asked. I have seen this type of question now they are asking in MCQs. Global Limited, an Indian company, acquired on 30th September 2001 70% of share capital of Mark Limited. There is a question of what? Business combination. Entity registered as a company in Germany. Correct. So they have acquired share capital of Mark Limited. Mark Limited is a company registered in Germany. The functional currency of Global Limited is rupees and its financial year end is 31st March 2002. The fair value of net asset of Mark Limited is 23 million euro and the purchase consideration paid is 17.5 million euro on 30th September. The exchange rate on 30th September is 82 and on 31st March is 84. What is the value at which goodwill has to be recognized in the financial statement of Global Limited on 31st March 2002? Now, whenever there is a foreign operation, means there is a foreign subsidiary, so goodwill will be calculated as in the functional currency of subsidiary company. Means first we need to calculate goodwill in euro and then translate in Indian currency. Got this point? So here don't calculate goodwill in functional currency of parent company. First calculate goodwill in the functional currency of subsidiary company. Correct? So what is the purchase consideration? 17.5 million. Can I say NCI will be 30%? So 23 is the fair value of net asset given. So 23, if nothing has been given about NCI, will always measure by proportionate share in INA method. So 23 into 30%, how much? That is coming 6.9. Total become how much? That is 24.7. Sorry, 24.4. From this minus कर दो कितना? 23. It is 1.4. 1.4 euro. Correct. Now, because they have asked goodwill on to be recorded in the financial statement also on 31st March 2002. If suppose they have asked on the date of acquisition, you are multiplied by 82. But they have asked on the date of consolidation, then multiply by 84. So multiply by 84. So 1.4 multiply by 84. The goodwill amount is 117.6. 117.6. You can pass the journal entry if they require. Chalega? Yes, sir. Good question. So here you can do mistake if you are calculating goodwill in rupees. Don't calculate goodwill in rupees. Calculate goodwill in first in euro, then translate it. Then translate it. Chalega? Yes, sir. Now one more question. This is also good question only. Mark Limited sold good costing rupees 2.4 million euro to Global Limited for 4.2 million euro. So Mark Limited sold goods in 2.4 million euro. So this become foreign currency transaction for Mark Limited and first it is a functional currency transaction for Global Limited. The exchange rate on the date of purchase was 83 and on 31st March 2002 it was 84. The entire goods purchased from Mark Limited are unsold. Correct. Now let me explain you what will be journal entry in the books of Mark Limited. In the books of Mark Limited, journal entry what? Inventory or you can say purchase. Inventory account debit to payable. Inventory account debit to payable. Inventory how much? It is 2.4. 2.4 into 83. This is the transaction rate, exchange rate. So this is the cost price. Was sold for rupees 4.2 million. So 4.2 into 83. That is 348.6. Correct now? 4.2 into 83. That is 348.6. 340. Achha, they have sold. 1 minute. Mark Limited sold. So Global Limited has purchased. Global Limited has purchased na. So in the books of Global Limited will become purchase. Purchase means okay, sir. So it is I am doing correct only 348.6. 348.6. And in the books of this is the books of Global Limited. In the books of Mark Limited, the journal entry will what? Receivable account debit to sales. That is 4 point. What is the amount? 4.2 million. 4.2 million in euro. This you have understood. This is in rupees. This is in euro. This you have understood. Correct. Now, of course, this payable will be translated by using closing exchange rate. Then this will be, because this is receivable, and as I said, this will be translated by using closing exchange rate for consolidation purpose. Then this payable and receivable will be cancelled in what? In consolidated financial statement. But in this question, they have not asked that. In this question, they have asked unrealized profit. To determine the unrealized profit. So unrealized profit will be what? What is the profit? 4.2 minus 4.2 minus 2.4. That is 1.8 is the profit in euro, and that will be included in the inventory as per the transaction reduction rate, that is into 83. So multiply करना into 83, that is 149.4. So you can see 149.4, that will become the annualized profit that need to be eliminated. That need to be eliminated. Understood? So this is the annualized profit that we should eliminate it. This much you have understood? These are all 2 marks question, can be asked in MCQs. One more question. Question 16. On 1st April 2001, Mecca Limited raised a long-term loan from foreign investor. The investor subscribed for 6 million. The investor subscribed for 6 million, means 60 lakhs foreign currency loan notes at par. It incurred an incremental issue cost of FCY, that is 2 lakh. So this become transaction cost. Transaction cost will be reduced from the loan proceed only. Correct? So okay, 60 minus 2, it become 58 lakh. Yes, sir. Interest of FCY is 6 lakh payable annually on 31st March, starting from 31st March 2022. So this become contractual interest. This become contractual interest. The loan is repayable in FCY on 31st March 2007 at a premium, and the effective annual rate of interest is 12%. They have given effective rate of interest. The appropriate measurement basis for this loan is amortized cost. The relevant exchange rate on 1st April is 2.5, on 31st March 2.75, and average rate they have given 2.42. Whenever they have given average rate, means any income and expense will be translated by using average rate. If they have given average rate, got this point? Correct. But any payment or any receipt will be based on what? Transaction rate, exchange rate. This you need to be careful. So average rate they have given means any income and expense will be translated by using average rate. Got this point? Correct. So in this case, what we'll do, just try to understand. On 1st April 2001, on 1st April 2001, I'm writing in FCY, then exchange rate, then INR. So it is 60 lakh minus 2 lakh, means 58 lakh. On that date, what was the exchange rate? That is 1 FCY is 2.5, so multiply by 2.5, 2.5 multiply. So 58 lakh into 2.5. It become 145 lakh. It become 145 lakh. Then can it on 31st March, we'll add interest at effective rate of interest 12%. So 58 lakh into 12%, that is 6 lakh 96,000. 6 lakh 96,000, because this is interest expense. We'll use average rate. Average rate is what? 2.42. So multiply by 2.42. So 6 lakh 96,000 into 2.42 is equal to how much? It is 16 lakh 84,320. Then on 31st March, there is one payment contractual cash outflow. As per the contractual, it is 6 lakh. The payment was done on 31st March. Payment was done on 31st March. The rate is 2.75. So 2.75 multiply करेंगे 2.75. Are you able to understand? Means here you will do mistake. I mean, right now you think it is simple, but both are on 31st March. समझ रहे हो? Where you will do mistake? This is interest expense calculated by effective rate of interest, that will be calculated by using average rate. And this is a payment as per the transaction reduction rate. Here only you will do mistake. Means when you are listening, you think that it is easy, but in exam it will be difficult. Have you understood this point? Bol. So it is coming how much? 16 lakh 50,000. Now can you give me the total of this? It is 58 lakh plus 6 lakh 96,000 and minus 6 lakh. This is minus, huh? This is coming how much? 58 lakh 96,000. This is coming how much? 145 lakh plus 16 lakh 84,320 minus 16 lakh 50,000. Are you doing with me? It become 145 34 320. Chalega. Are you doing with solve with me? I am only solving. You are, if you are not solving, it is not correct. And why I am solving? Because practice is required. So some question I will solve also. You also solve it. If you are not solving, believe me, it will not work. Now can you see this become closing balance, but because it is a foreign currency monetary item, it will be translated by using closing exchange rate. So 5 lakh 58 lakh 96,000. What is the closing rate? 2.75. Multiply kar do. 58 lakh 96,000 into 2.75. This is coming how much? 162 14,000. So the liability increases, so that become loss. So this become exchange loss, which will be transferred to PL. Why it will be transferred to PL? Because this is foreign currency monetary item. Any difference will be transferred to PL. How much? 1453 145 34 320. It is coming how much? 167 9680. This will be transferred to PL. Understood? This is the answer. Have you understood that this is the danger area? Danger area, have you understood? Here only you will do mistake. Yes, sir. Just check whether the answer is correct or not. You can see they have given such a long answer that is not required. You can see our answer is also matching. So match. Don't write down this way. This is what I will say. It will take more time. This will save your time and you will not do mistake also. Okay, chalega. One more question is there. Similar question. This till now not asked in exam, but RTP, MTP is super expected. From my point of super expected. Super. In this exam it is going to ask also. An Indian entity whose functional currency rupees purchase US dollar dominated, not denominated, bond at its fair value of 1000. Means they have purchased at fair value. This is fair value. The bond carries stated interest rate of 4.7% per annum on its face value. Can you see, even though it is not given face value, contractual rate of interest is always applied on face value. And this is contractual rate of interest. The said interest received at year end, the bond has a maturity period of 5 years and it is redeemable at its face value. So 1250 is face value. Good question. Means they have designed the question interestingly. Means in an interesting way. If you will not read the question carefully, you will do mistake in exam. So you will read question carefully. This 1250 is face value. This 1000 is fair value. Chalega. The fair value bond at year end is the fair value they have given 1060. The exchange on the date of transaction at year end is 40 and 45. The weighted average rate is 42. But the 42, the average rate will be used for interest income. Chalega. The entity has determined that it is holding the bond as a part of investment portfolio whose objective is made by holding the asset to collect contractual cash flow and sell the asset. If you remember, if there is any financial asset which is hold to collect contractual cash flow and sale whenever required, it will be always measured FBTOCI. So it is given the question is classified under FBTOCI category. Even though not given, it will be FBTOCI only. Chalega. The bond result in effective interest rate of 10% per annum. Calculate gain or loss to be recognized in PL and OCI. Now, first, just inform me. I am asking one question. This bond is a monetary item or non-monetary item? First, everyone. Here only you will do mistake. Bond, this foreign currency bond, foreign currency denominated bond is a monetary item or non-monetary item? Everyone respond. Monetary or non-monetary? Everyone? Non-monetary. I said you will do mistake, you have done mistake. It is not non-monetary, it is monetary. This is a bond. Just try what is monetary and non-monetary. I will just give a simple meaning. Don't go into the meaning. Monetary means what? Simple to understand. Any receivable, any payable, which is receivable and which will be settled in cash. Any receivable payable which is settled in cash. Cash means currency. Currency means which is if it will be settled by delivery or receipt of goods and services, these are not monetary items. So any receivable or payable which will be settled in cash. Cash means currency. Any receivable or payable which will be settled in cash, not in goods or services, that will be what? Monetary item. Otherwise all items are non-monetary. Otherwise all items are non-monetary. Correct? Just repeat with me. Any receivable, any payable which will be settled means which will be received or paid in cash. Cash means currency, not cash equivalent. I am saying cash, not cash equivalent. That will become what? Monetary. Now here bond will be settled in cash only now, because it is given contractual cash outflow that will be settled in cash. It become monetary item, not a non-monetary item. It is a monetary item. Got this point? So there is a contractual cash inflow which is received in cash, so that become monetary item. Got this point? This is the rule. Rule have you understood? Yes sir. Now coming to the solution. So what they have given? Check karenge. On which date? First they have purchased. They have not given date now. So we can start with year beginning Y0 like this. Okay na. So initial date, what was the amount? So you write on US dollar, then exchange rate, then INR. So you have purchased at what? 1000. At that time what was the rate? Rate was how much? It was 40. So into 40 it become 40,000. Then we'll add interest income. Interest income will be by applying effective rate of interest. Effective rate of interest is how much? That is given. How much they have given? 10%. Effective rate of interest is always applied on this, on the opening balance. It is 10% of 1000, that is 100. And this is interest income, so we'll use average rate. Average rate is how much? It is, oh, average rate is 42. 42, it become 4200. Then contractual cash inflow, that will be calculated by using contractual rate of interest, and that is how much? 4.7% of face value. Here only you will do mistake. 4.7% of 1250. Understood now? So 1250 into 4.7%. 1250 into 4 into 4.7%. That is coming 58.75. For this you will use what? Closing rate, that is 45. 45. So you will use 45. 45. So into 45 how much? Is 2643.75. 2643.75, because they have said ignore decimal, I think so. At the end they have said rounding off to the figure, so you can round, you could do rounding off also. I have not done in solution, they have done rounding off. Chalega na? Okay sir, that is okay, chalega. So now what is the total of this? 1000 plus 100 minus 58.75. This is coming 1041.25, and this is coming 40,000 plus 4200 minus 2643.75. That is coming how much? 41556.25. Understood? Correct. Now can you say, first we will translate by using what? First translate by using closing exchange rate. Yes sir. So translate by using closing exchange rate to 1041.25. What is the closing exchange rate? 45. So 1041.25 into 45, coming 46856.25. What is the difference? 41556.25 0.25 is 5,300. So this is exchange gain. Exchange gain because it is increased. So any exchange gain of foreign currency monetary item will be transferred to PL. Will be transferred to PL. This will be transferred to PL. Understood? Correct. But can I say the fair value, because it is measured at FBTOCI, so we need to report it fair value. This is the amortized cost. So fair value is given how much? How much fair value is given? Fair value bond is 1060. 1060. So now we'll come to 1060. So 1060 multiplied by 45. So 1060 multiplied by 45 is coming 47,700. Now the difference between these two, how much? Check karo. Minus 46,856.25. That is coming how much? 843.75. 843 it is coming. Check karo answer. Yeah. My answer is coming 843. They have given 855 because of rounding up. I think the difference is coming. Chalega na? The rounding of difference coming. Okay, sir. 843. This become fair value gain, and fair value gain will be transferred to OCI because this is FBT OCI. This is the answer. Have you understood? Here, I think very simple because it is foreign currency monetary item. If it is suppose foreign currency non-monetary item, suppose this is investment in equity shares. If it is investment in equity shares, same question about investment in equity shares, of course then you will not do this interest wala capitalization. But suppose it is in foreign currency non-monetary item, then exchange gain will be also transferred to OCI because revaluation gain has been transferred to OCI. But because it is foreign currency monetary item, any exchange difference will be transferred to PL, and fair value gain or loss will be transferred to OCI because it is measured at what? FBTOCI. Have you understood this point? This is also very good question. Till now not asked in exam, can be asked in exam. Then they have asked one journal entry. So they have given one compound journal entry. You can do it by your own. Compound journal entry. I will explain. Ki bond, you can see bond. What they have done one compound journal entry. So initially the bond was how much? 40,000. Correct. And now it become 47,700, increase in bond by 7,700. We can see 7,700. Correct. Understood. Then can I say some amount has been received about interest to bank account debit? How much interest received? Interest received is what? Our 2643 as per my, but they have done rounding up to 2655. Correct. Then there is some interest income that will be transferred to PL, interest income. Then there is an exchange gain that will be transferred to PL, so exchange gain. And then there is a OCI, means that OCI that will be accumulated in fair value reserve account. So OCI 855. This compound journal entry we can do. Okay, sir. Yes, sir. Then come to question 19. This is very good question. Still not asked. I don't know whether this question will be asked or not, but can be asked for 10 marks. Can be asked for 10 marks. If this question come, it will be of 10 marks. Can we do? PQR Limited Holding Limited is based on London and has a pound sterling GBP and is functional presentation currency. So PQR Holding, whose functional currency and presentation currency is GBP. On 1st April 2000, PQR Holding Limited incorporated PQR India Limited as its wholly owned subsidiary in India. So there is a foreign operation in India. Means for PQR Holding, there is a foreign operation in India. चलेगा उसका नाम क्या है? PQR India Limited. PQR India Limited will engage in the trading. This you can see. The shares of PQR India having a face value of 10 each amounting to a total of 500 crore which were issued on 1st April 2001. Okay, sir. PQR India has adopted Ind AS. Okay, sir. In accordance with the Ind AS, management of PQR India has concluded that functional currency of is Indian rupee. So for that Indian company, of course, the functional currency will be Indian rupee. Following the summarized trial balance of PQR India on 31st March 2002, being reported date of PQR India and PQR Holding. All amount as given crore. So they have given this trial balance. Okay. Now, where you can do mistake? Now, because this is PQR India Limited is a subsidiary of some foreign company, so PQR India Limited need to translate their trial balance from rupees to GBP. So this is a translation of foreign operation. Now, whenever we translate any foreign operation, what India has 21 says that for all the assets and liability, that translation rate will be closing exchange rate. So now all asset, all liability, whether monetary, whether non-monetary, all asset, all liability, whether monetary or non-monetary, all asset, all liability will be translated by using closing exchange rate. Closing exchange rate on reporting date only. Now, what do you mean by closing exchange rate? Closing exchange rate does not mean closing exchange rate is of closing exchange rate does not mean of reporting rate. Closing exchange rate means what? For that particular day when you are doing translation, what is the closing rate? Because for every day there is one opening rate, one closing rate. You will take closing exchange rate of reporting date. Understood? Closing exchange rate of reporting date. Chalega? Yes, sir. Understood. Now, what they have given to confuse you, they have given computer, you can see inventory purchase on 15th March, and there is no indicator impairment. Means NRB of that inventory is more than what cost price. So this is the purchase on 15th March. Then they have given property, plant and equipment purchase on 30th April, computer software purchase on 5th May. Share capital securities premium to be translated by using historical exchange rate. Historical exchange rate means when it was issued. It was issued on 1/4 at the beginning of the year. Retained earning, because the first year only, it means retained earning only consists of the profit of that year, and profit of that year will be nothing is given, so it will be always used by average, translated by using average rate. Average rate, you can see average rate. Normally for this question will inform. Question will inform. Now you can see they have given the presentation, since the presentation currency of PQI holding is GBP, PQI India required to translate its trial balance from INR to GBP. Following table provide relevant foreign exchange rate. You can see closing spot rate of 1st April, closing spot rate of 30th April, 5th May. 5th May में क्या हुआ? 5th May में we purchase computer software. 30th April में we purchase PP. And 15th March may we purchase inventory. 31st March is the closing exchange rate. Average rate is given what this. As the accountant of PQI India, you are required to do following. Explain the principle of monetary and non-monetary item as per India's 21. You should write down monetary item, non-monetary item. You should give the definition. Then you should write down India's 21 as per India's 21 foreign currency monetary item will be translated by using closing exchange rate. Foreign currency non-monetary item, if they are carried at cost price, no translation required. If they are carried at fair value, then translate by using the exchange rate on the date when the fair value is determined. This much you should write down. Based on the principle, bifurcate the line item of trial balance and monetary and non-monetary. So now you should find out whether these are monetary or non-monetary. Of course, you can do only in one area you can do mistake. I don't know whether you can do mistake in some other area or not. From my point of view, only one point you can do mistake. Let me explain. Share capital, non-monetary item. If any doubt, you can ask me. Securities premium, non-monetary item. Retained earning, non-monetary item. Long-term borrowing, monetary item. Deferred tax liability, non-monetary item. Income tax payable, monetary item. Import duty payable, monetary item. Employee benefit payable, monetary item. Sundry rate payable, monetary item. PP, non-monetary item. Computer software, non-monetary item. Up to this, any doubt? Respond fast. Up to this, any doubt? No doubt? Now, you'll explain me. Inventory, monetary or non-monetary? I'm asking you a question. Inventory, monetary or non-monetary? Everyone respond. If you are not responding, means believe me, whatever you are doing mistake, here same mistake will be repeated in exam. Bolo. Inventory, monetary or non-monetary? Very good. Non-monetary item. Excellent. Correct only. So I was expecting correct only. You have given correct. Cash and bank balance monetary. Sundry trade receivable monetary. Now allowance for doubtful trade receivable. But the allowance means for trade receivable there was some allowance means some allowance for bad debt has been created. This will be monetary or non-monetary. Here you can do mistake. But the allowance for doubtful trade receivable monetary non-monetary. Here you can do mistake. I'm coming for detail first. Point number 15, allowance for doubtful trade receivable. Everyone respond. Good. Excellent. If the asset for which allowance is created is monetary, then that allowance will be also monetary. Correct? Got this point? If the asset for which allowance is created non-monetary, then the allowance will be also non-monetary. Very good. Excellent. You have done correct. This much is correct. Now, you give me the rate. I'm asking some rate of translation. But for you have the question with you for property, plant and equipment, for computer software, and for inventory. Which rate will be used for translation? I'm just identifying the area where you can do mistake. For PP, what are the rate? Which rate will you use? The rate is given like this. Correct? Understood. For property, plant and equipment, which rate will be used? I'm just identifying the area where you can do mistake. For PP, which rate will be used? Excellent. Very good. Means can I say this rate, this rate are given to confuse you? Excellent. Correct. So it will be translated by using closing exchange rate. Means can I say for share capital will take the rate of 1/4. For share capital and for securities premium will take this rate. Will because we'll use the historical date exchange rate. Chalega. So we will use the rate of 1/4. For securities premium 1/4. For retained earning will use average rate. And for long term borrowing, for deferred tax liability, for income tax payable, for import duty payable, for every now for every information will take closing exchange rate. And any difference in this trial balance, any difference in this trial balance due to translation will be transferred to FCTR through OCI, foreign currency translation reserve. The difference transferred to FCTR, very simple question but interesting question can be asked in exam. I hope you have understood. Correct. Now only one thing, the detail why it is a detail. Just a deferred tax liability, whether it is an actual liability or imaginary liability. It is one imaginary liability which will not be settled. Current tax liability will be settled, but deferred tax liability will not be settled. It will be reversed. It will be reversed. Means it is never settled in cash and therefore it is a non-monetary item. Got this point? Understood? Yes, sir. आगे चलते हैं. This you have understood? I think the balance you can do. You have understood. One newly inserted question, question number 21. I don't know whether it will be asked or not because such a big question. Now from this chapter, we don't expect more than 5 to 6 marks question. But if this question will come, it will be 10 to 12 marks question. But you don't know. Always in exam, unexpected become expected. So just do it now. What is wrong in that? Infotech Global Limited as standalone entity has a functional currency of US dollar and need to translate its financial statement into presentation currency. The following is a draft financial statement of Infotech Limited. You can see they have given two balance sheet 31st March 2003 and 31st March 2002. So they have given the balance sheet. They have given the statement of PL. The statement of PL is for which year? 2002 2003. Means they have given opening balance sheet and closing balance sheet. extract of a statement of changes in equity, you can see opening retained earning, then profit for the year is this profit for the year, then dividend paid, and then closing retained earning. Share capital was issued when the rate was 70. So share capital will be translated by using this rate. Okay. Retained earning on 1st April means, can you say opening in means this has been given, this 4 lakh has been given, so there is no need to translate. At 31st March 2002, a cumulative gain of 4,92,000 has been recognized in the foreign exchange reserve, which is due to the translation. Means, can you say for the previous year they have given the FCTR balance. Means if you will translate this balance sheet, FCTR should be how much? How much? 4,92,000. If it is not coming 4,92,000, it means you are doing mistake. Entity paid dividend of $3,000 when the rate was 73.5. So can you say for dividend we'll use the rate 73.5. Profit for the year for 2001-2002, 8,000 should be translated by using this. And profit for the current year, the translation has been given 10,72,985. Means, can you say this has been given 10,72,985. This has been given. This has been given. So can you see from this you can easily calculate closing retained earning. From this you can easily calculate closing retained earning. This you can find out. So first what we'll do, and then they have given this for the sake of simplicity, income and expense by using weighted average monthly rate. This you can read. Then they have given 31st March 2002 means the closing exchange rate of last year is 73 and closing exchange rate of current year is 75. Prepare finance statement. So first you can see they have calculated retained earning, closing balance. So that only they have given for the current year. This has been given. This has been given. This we can find out. This is the closing. Can you say for the previous year, because they have given opening retained earning 4 lakh was given. This was given. Profit was given. No information about dividend. This becomes, so this is the only opening balance. You can do it like this. Correct now? Yes, sir. Now we'll do the translation part. Translation part very easy. Can you say for this balance sheet 75 closing exchange rate for all asset or liability? All asset or liability. But can you say equity share capital by using historical rate and retained earning already you have calculated this 18,24,485. Again, difference will be transferred to FCTR. So they have transferred a difference to FCTR. Similarly, for the previous year balance sheet, you can see the closing exchange rate has been taken. For share capital 70 only. For liability closing exchange rate, and this already we calculated as a working note. As per working note 9,72,000. And you can see here the FCTR balance coming the same whatever has been given in the question 4,92,000. Means the difference between these two will be the OCI which will be transferred in current year. Means this is the difference will be transferred to as statement of PL current year OCI. Current year OCI. Means now they have prepared one, so you can see OCI of current year is the difference between these two only. Difference between these two. Okay. Now they have also created one statement of changes in equity. So retained earning means I will what to show. This is the opening balance of share capital, opening balance retained earning, opening balance of FCTR. Correct. Then this is a dividend payment during the year, profit for the year, and exchange difference transferred to FCTR. This is the closing balance. This you can prepare. Means solution is nothing but replica of question, but it will be thoda time taking. Too fast. If it is a question of, it can be of 10 marks, 8 marks, 12 marks as given by ICI. But good question. Because one mistake, entire solution will be wrong. With this we have covered IND AS 21. I hope IND AS 21 also you have understood. Any doubt in IND AS 21? Any other question which you want me to do for IND AS 21? Respond. Are you able to follow me? Are you able to understand? So IND AS 21 also I have done. Next IND AS which we want. Let us do IND AS 7. We'll do IND AS 7, next IND AS. But first let me ask you, have you understood IND AS 21? Any question of IND AS 21 which I have not covered in expected question but you want me to explain? Goodwill point. Question 15. Goodwill was the very easy day. What was the doubt in that? I said in this question, goodwill, whenever there is a business combination and you have acquired a foreign company, in that case, first calculate goodwill in the functional currency of subsidiary company. So here, what was the functional currency? It was euro. So first we calculated goodwill in euro. Means don't translate 23 million euro. First calculate this 23 million euro, 17.5 million euro. Don't translate this. First calculate goodwill in euro. So what we have taken, because 17.5 million was in euro, it was purchase consideration. Then NCI measure by using proportionate share in INA method in euro. Then net asset in euro. So this 1.4 million euro become the goodwill in functional currency of subsidiary company. Then translate in INR. So because they have asked goodwill on the date of consolidation, we have translated by using 84. Suppose they have asked goodwill on the date of acquisition, then multiply by 82. Multiply by 82. Understood? Have you understood? Sir, under India 16 PP building given for rent which comes as a finance lease. Explain this treatment. Thank you, sir. Under India 16 PP building given for rent. PP given on rent. Just a PP, if it is given for rent, it is not finance lease, it become operating lease. Are you able to understand? And any PP given on operating lease that is not covered under India 16, that is covered under India's 40, because that is held for earning rental income. Kiran Kumar, your question is not correct. Means any property, just you are asking about property. You are asking about property. If any property is given on operating lease, first it is not finance lease, it is given on rent. Rent means operating lease. Finance lease is not rent. Understood now? So any property which is given on rent means operating lease will be covered under Ind AS 40 for classification purpose. But for measurement purpose, Ind AS 116. For measurement purpose, Ind AS 116. Similarly, any plant and equipment which is given on operating lease, it is Ind AS 16. Means that will be property, plant and equipment. But their measurement will be also done as per. Are you getting? Now, the question arises, given on means you are talking about lesser point of view. First, you are asking from lesser point of view or lessee point of view. I have not understood your question, Kiran Kumar. Explain your doubt clearly. Means I am thoda confused with your question. You are asking from lesser point of view, lessee point of view. I am not able to understand that. Okay, Kiran Kumar, I am waiting for your question again. Okay. So we'll take 5-minute break. After 5-minute break, we'll start Ind AS 7. Then we'll take Ind AS 12 if you want. Ind AS 12 we'll take after Ind AS 7. Okay, sir. We'll take 5-minute break. Yes, everyone ready? Yes, sir. Now we'll start India 7. Questions may be expected from this particular topic also, India 7. Let us do the discussion fast. Question 12 I will take at the end. It will require to us explanation. Come to question 16 first. What they have given? Question 16. Jet Limited has no foreign currency cash flow for the year 2017. Okay, sir. It holds some deposit in a bank in the USA. The balance as on 31st 12 2017 and 31st 12 2018 was US dollar 1 lakh. So they have a bank deposit, correct? So on 31st 12 2017 the balance was 1 lakh. On 31st 12 2018 the balance was 1 lakh 2000. The exchange rate on the same date means on 17 45 and 18 it becomes 50. Okay, opening rate was 45 and closing rate was 50, you can say in this way. The increase in the balance means 1 lakh become 1 lakh 2000. 2000 was due to what? The increase in the balance was an account of interest created on 31st 12 2018. So some interest was created. Thus the deposit was reported at 45 lakh in the balance sheet as on 31st December 2017. It was reported at 51 lakh in the balance sheet as on 31st 12 2018. How this transaction should be presented in cash flow for the year ended 31st 12 2018 as per India 7. Now, one thing is clear that this, can I say, the bank deposit is a cash and cash equivalent. Is a cash and cash equivalent. So, what they want to say? Ki on 31st 12 2017 and 31st 12 2018, it was 1 lakh and this is 1 lakh 2000. Here the rate was 45, here the rate was 50. So, it become 45 lakh and this become 51 lakh. So, you can see the increase is 6 lakh, correct? So this is due to two reasons. One is interest income. Interest income is what? 2000, and because the interest was created on 31st 12 2018, so we'll use the that date rate only. So we'll do into 51. So 2 lakh 2000 into 51, it is coming how much? 1 lakh 2000. Sorry, into 50. Into 50 will be 1 lakh, and the difference of 5 lakh means 6 lakh minus 1 lakh, 5 lakh is due to exchange gain. Because 1 lakh was initially recorded 45, now it become 50, so there is an exchange gain. So what is the exchange gain? Is equal to 1 lakh into 5, that is 5 lakh. 1 lakh into 5 is equal to 5 lakh. Understood? Now how it will be reported in cash flow statement, that I need to explain. Got this point? Now you can see, the if you say the total profit as per SOPL, if suppose ignoring other transactions, suppose this is the only transaction in the company, the total profit before tax will be 6 lakh. Total profit before tax will be 6 lakh, correct? Now if you want to calculate cash flow from operating activities, we'll start with profit before tax 6 lakh. Can you say, but this is unrealized exchange gain which is not yet realized, so that should be eliminated because it's not a cash flow. So unrealized exchange gain, will write down unrealized exchange gain. How much will be eliminated? Will be eliminated. So this become cash flow from operating activities. 1 lakh will be cash flow from operating activities. There is no other transaction given. So 1 lakh is the cash flow from operating activities. Can I say investing activity is nil? Financing activity is nil. So this is the net increase in cash and cash equivalent during the year. That is 1 lakh. 1 lakh. In this we'll add opening cash and cash equivalent. So opening cash and cash equivalent will be 45 lakh and closing will become 46 lakh. 46 lakh. Understood? So this is the cash flow statement. But just try to understand, closing cash and cash equivalent as per statement of cash flow will be 46 lakh, but as per balance sheet it will be 51 lakh. Why it happens? Because we eliminated exchange gain, because of that reason this difference arises. So what our India 7 says that whenever there is a difference between cash and cash equivalent as per statement of cash flow and cash and cash equivalent as per balance sheet, a reconciliation required. So a reconciliation will be prepared. Either you can add exchange gain yahin par for reconciliation purpose, or you can prepare a separate reconciliation statement. So what is the cash and cash equivalent as per statement of cash flow? That is 46 lakh. In this you'll add exchange gain unrealized, 5 lakh you'll add, and this will become 51 lakh as per balance sheet. This will be 51 lakh as per balance sheet. This is a reconciliation statement. So a reconciliation statement is required. Understood? In the solution they have given in the para format. However, the same thing you can do in the statement format also. That is also okay. But if you want to write down in para format. Correct? Understood? So what you should write down, that for reconciliation purpose, unrealized exchange gain will be added to the cash and cash equivalent as per statement of cash flow to find out cash and cash equivalent as per balance sheet. As per balance sheet. Understood this point? Have you understood this point? Good question. Till now not asked in exam, but good question. Coming to question 17. Company acquires 70% of equity stake in Company B on July 2001. The consideration for this transaction is as below. Cash consideration paid 15 lakh, 2 lakh equity shares having a face value of 10 and fair value of 15 per share. On the date of acquisition, Company B has a cash and cash equivalent balance of 2,50,000 in his books of account. So again, it is a point of business combination. So they have acquired 70% by paying this much cash and by issuing equity shares. Can I say whatever equity shares are issued that become non-cash transaction? So this will not be considered in cash flow statement. But how much cash consideration paid? 15 lakh. So whatever cash consideration paid, that will be for acquisition of subsidiary, that will become investing activities. So acquisition of subsidiary will be an investing activities. And how much acquisition, what is the cash outflow? 15 lakh. But can I say during this business combination they have also received cash and cash equivalent from acquiring company, means Company B, amounting to rupees 2,50,000. So they have paid 15 lakh, they have received 2,50,000. So what our India 7 says, the net amount will be considered as investing activities. So your investing activity will be 15 lakh minus 2,50,000, minus 2,50,000. Understood? Have you understood this first part? So your acquisition of subsidiary will be disclosed under cash flow from investing activities at a net amount. Net amount is 15 lakh minus 2,50,000. Got this point? Now one more point is given. Let me explain that. Suppose this is the date when the control is obtained. So whatever consideration you have paid for obtaining control will be investing activities. But suppose again you purchase 10% or you disposed of 10%. Can I say this will not result in any increase or decrease of decreasing control? So this is considered as financing transaction, because this will be considered as changes in proportion of NCI. So what our India 7 says, that further acquisition of shares or disposal of shares without loss of control will only result in changes in proportion NCI. NCI means equity. Whenever equity changes, that become a financing activities. So any subsequent purchase or subsequent disposal of shares without loss of control will be considered as financing activities. But suppose you disposed of entire shares which will result in loss of control, that will be investing activities. That will be investing activities. Got this point? So what they have said, let's see. On 10 October, company have further acquired 10% stake in Company B for a cash consideration of 8 lakh. This will be considered as financing activities in consolidated financial statement, in consolidated cash flow statement, in consolidated cash flow statement. Chalega. Good question. Till now not asked. Can be asked in exam. Can be asked in exam. Okay, sir. 17 also done. 21. This is also newly inserted question. They have asked to inform whether the given inflow and outflow will be operating, investing or financing activities for financial institution and other entity. Means for financial company and for other company which are not financial company, what is the nature of this inflow and outflow? So let me explain one by one. Correct. Only one point or 2 point you will have doubt. Let me explain each and every point. The bank and financial institution and other entity. Interest received on loan and advance given. So for bank it is an operating activity. For other entity it will become, because interest received on loan. Loan is an investing activity for other entities. So it become investing activity. I think no doubt. Interest paid on deposit and other borrowing, for here operating, here financing. I think no doubt. Interest paid for other entity will be always financing. Interest and dividend received on investment in subsidiaries, associate and other entity. Here you may doubt. Can I say for banking company also they have done investment in subsidiaries, in associate or joint venture, it is just like an investment only. So here both, in both cases it will be investing activities. Here you may do some mistake. Dividend paid on preference share capital, equity share capital, including dividend tax. Correct now. Whatever dividend paid by any company will be on share capital. So that will be always financing activity. That will be always financing activities. Okay, sir. Yes, sir. Then finance charges paid by lessee under finance lease. However, question is only long. For lessee now there is no finance lease, there is no operating lease. So I will say it will finance charges paid by lessee under lease. Correct. Now for this Ind AS 116 says, what Ind AS 116 says, that whatever 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 lease payment you are paying, whatever, suppose lease payment is 1 lakh. So it consists of two parts. One is finance charges, one is the reduction of lease liability. Reduction of lease liability. So both will be considered as financing activities. So any finance charges paid by lessee, any payment towards reduction of outstanding lease liability, both will be financing activities under both category. Under both category. Here, this is also a good point. I think good point. But this is informed by Ind AS 116. What need to be done under cash flow statement? Yes, sir. However, in 7 and 8 you will have doubt. Now you know that we have done under Ind AS 16 purchase of PP on deferred payment basis. Whenever we purchase any PP on deferred payment basis, in that case also cost price will be equal to present value of future payment and interest will be difference between future value and present value. In that case, interest payment will be financing activity, but whatever you are paying for reduction liability, that will be investing activities. So what's the difference? 5 and 6 you can see both are what financing activities, but any interest paid to vendor for acquiring fixed asset under deferred payment basis, this is financing. But principal sum payment under deferred payment basis, this will be investing activities. Be careful. Here you can do mistake. Here you can do mistake. This type of question can be asked for 2 marks in MCQs. Then penal interest received from customer, operating. Penal interest paid to supplier, operating, because this is operation, a customer, supply. Interest paid on delayed tax payment, interest received on tax payment, all are operating activities. I think in this no doubt. चलेगा आगे चलते हैं. Question 24, this was asked in one of the exam. Good question, let me explain. Jet Limited India has an overseas branch in USA. It has a bank account having a balance of $7,000 on 1st April 2019. Opening balance is $7,000. During the financial year 1920, J Limited acquired computer from USA for its USA office for $280, which was paid on the same date. There was no other transaction reported in USA or India. Exchange rate on 1st April 70, on 30th November means on the date of purchase of computer 71, and on 31st March 2020 it was 71.5. Average rate is 70.5. Prepare an extract of cash flow statement. They have asked you to prepare extract of cash flow statement. And so the foreign exchange profitability from this transaction. So foreign exchange profitability means exchange gain or loss as per Ind AS 21 will calculate. Got this point? Yes, sir. So what they have done? So there are 2 points. First, let us calculate exchange gain or loss. So US dollar, INR, and exchange rate. So what is the opening balance? $7,000. What was the rate at that point of time? It was 70. So 70. So 7,000 into 70 is equal to 4 lakh 90,000. Then they purchase computer. Computer they purchase at $280, not $280. $280. At that point of time, what is the rate? It becomes 71. So 71 to 280 into 71, it is what? 19,880. Only these two transactions. So this becomes 7,000 minus 280. How much? 6720. And this becomes 4,90,000 minus 19,880. This becomes 4,70,120. Now because this is a foreign currency monetary item, so it will be 6720 by using closing exchange rate. So what is the closing exchange rate? It is 71.5. So 71.5. So 6720 into 71.5 is coming how much? 4,80,480. Correct. So what is the difference? Minus 4,70,120. That is coming 10,360. This is the exchange gain will be transferred to profit and loss account. Exchange gain will be transferred to profit and loss account. Got this point? So you can see there is only one exchange gain that will be transferred to PL account. This become calculation. Now because they have asked you to prepare extract of cash flow statement. Extract of cash flow statement. So first we'll do cash flow from operating activity. So there is only profit before tax. How much? 10,360. Only one item. Can you see it is realized, unrealized? This is unrealized exchange gain which will be eliminated. 10,360 will be eliminated and cash flow from operating activity will be nil. They will add on cash flow from investing activity which is already calculated 19,880. So 19,880 will be negative and cash flow from financing activity will be nil. So this will be net decrease in cash and cash equivalent, that is 19,880. In this we'll add opening cash and cash equivalent. Opening cash and cash equivalent is how much? 4,90,000. 4,90,000. Correct. So what is coming? 4,90,000 plus 19,880. It is coming. Sorry, minus. It is minus 4,90,000 minus 19,880. It is coming 4,70,120, which will match with this. Correct. But this is as per cash flow statement, because as per balance sheet this will come. So for this you need to prepare one reconciliation statement. Either you can add this only here, this add 10,360 here, and this will be as per balance sheet. Or you can prepare one separate reconciliation statement. This is as per cash flow statement. Add kar do 10,360. This will be what as per balance sheet, that you can prepare separate reconciliation statement. This is a question which have been asked in exam for how many marks? 5 marks. Simple. But it's very simple now. Bolo. Have you understood this? This type of question can be expected in exam. Means from my point of view, if I am also preparing one question paper, from my point of view, from this chapter, this is a perfect question. Yes, sir. Now let me take one question about cash flow statement preparation. Following is the balance sheet of Mars Limited. Again, the same question have been given in RTP May 2024. So can be asked because May 2024 exam में आया था. In RTP it was given. So you can see non-current asset PP. Can I say investing activity? Intangible asset investing activity. Deferred tax asset. So there is no change. You can ignore. Understood? Yes, sir. Other non-current asset, if the question is silent about other non-current asset, it will be always operating item. Always operating item. Then financial asset, investment, can I say investing activity, trade receivable, operating activity, cash and cash equivalent, that will go to cash flow statement, inventory, operating item, other current asset. If the question is silent, other current asset, operating item. Got this point? Equity and equity, share capital, it is a financing activity. Other equity, nothing. Non-current liability, borrowing, financing activity. Other non-current liability, once again question silent, always operating. Always operating. Current liability, financial liability, trade payable, operating, bank overdraft, Bank overdraft if question is silent. This is very interesting point. Bank overdraft if question is silent. So bank overdraft are of two types. One is the current account balance which is overdraft, and one is bank overdraft facility. So what our India 7 says that current account overdraft balance is a part of cash and cash equivalent. Therefore, it will be deducted to find out the component of cash and cash equivalent. But if there is some bank overdraft facility or cash credit facility, that is a financing activity, that will not be deducted from cash and cash equivalent. So now question is silent whether it is current account overdraft balance or what is. So if nothing is given, always consider this as cash and cash equivalent and deduct from what? Cash and cash equivalent from examination point of view. If the question is silent, understood? Here also you can do mistake. Other current liability, if question is silent, operating item, total liability, everything is given. Profit before tax for the year is 200 lakh and provision for tax is 40 lakh. So can you say, if profit before tax is given, so we'll start from this only. And provision for tax means what has been charged to profit and loss account, correct? But you can see there is no current tax liability has been given. So current tax liability has not been given. So we can assume कि other current liability, whatever this has been given, other current liability is what? Current tax liability. This is assumption we'll take. Assumption we have taken. Understood? So when current tax liability, this is other, we have assumed this is current tax liability. So prepare one account. So what is the opening balance? Always see this date. This is opening, this is closing. So what is the opening balance? 90. What is the closing balance? 45. And how much provision for tax? 40. It become 90 plus 40 minus 45. So how much paid? So income tax paid will be 85. Income tax payment is 85. Understood? First point you have understood. Income tax paid during the year is 45. So because provision for tax is given, so we have assumed that other current liability is what? Current tax liability. That assumption we have taken. Chalega. Then property and plant and equipment purchased during the year. So prepare one PP account. So opening balance given how much? 410. Closing balance given how much? 450. And how much purchased during the year? 100 lakh. What is the depreciation? So 410 plus 100 minus 450. So your depreciation 60. Whatever purchase, that become investing activity. Okay, sir. Then current liability include capital creditor of 25 lakh. Current liability include. They have given current. So it means other current liability include. So it means थोड़ा सा यहाँ पर we need to be careful about other current liability. So what they have given? Current liability include capital creditor, but they have not written other current liability, or that they have not written. 25 lakh as on 31st March 2003 and nil on 31st March 2002. Current liability. So it means थोड़ा सा यहाँ doubt आएगा कि whether this trade payable include or other current liability include. Let's see what institute has done. Means I know the answer, but I'm just informing that they have assumed in trade payable. देखो in exam doubt will come. Correct ना? So they have assumed this is included in trade payable. Now doubt will come ना? They have said current liability include. But can you say they have written capital creditor? Okay, capital creditor will be included in trade payable. So what is the mean by capital creditor? Capital creditor means amount payable on purchase of PP, etc. The amount payable on purchase of PP is not related to operating. Understood? That is amount payable for purchase of PP. Got this point? Whatever I am saying. So they have purchased. यहाँ पर they have purchased ना 100. So they have purchased 100. Out of these, how much is payable? That we need to identify. So out of 100, entire amount is not paid. Good question, I will say. Only in this point you will do mistake. It means, can I say, when you will say trade payable, so trade payable में this 455 include what? 455 include 25. This be careful. This be careful. Okay, sir. Chalo. Long term borrowing raised during the year. So long term borrowing raised, long term borrowing का है borrowing. So if you see, if you prepare one long term borrowing account, opening balance 300, closing balance 360, and how much raised? Raised means newly issued 120. So how much paid? So 300 plus 120 minus 360. So how much paid? 60 has been paid. So this is the payment of long term borrowing. Yes sir, ये भी हो गया. Chalo. Now we can prepare statement of cash flow. We'll start with profit before tax. There's only one non-cash expense, depreciation. Depreciation already we calculated. How much we calculate? 60. So depreciation is added back. Correct. Now can you say whatever operating item for that will do changes in working capital? So changes in working capital will do. Means this become operating profit before working capital changes. Now changes in what? Working capital. Let me start with the asset. So asset में कहाँ पर? Trade receivable. Can you say, you can see there is a decrease in trade receivable, 600 minus 580. So decrease in trade receivable, you say it will be plus minus. आप बताओगे. You will say me decrease in trade receivable will do plus minus. देखो, in this also if you will do mistake, then the पूरा solution will become wrong. So in cash flow statement, decrease in asset and increase in asset and decrease in liability and increase in liability will do plus minus. So decrease in asset, यहाँ पर 600 become 580. To decrease one, decrease will do plus की minus. You will say. Everyone. RS, you 100% correct. Plus means कुछ you are remembering from CA enter ना. Very good. It will be plus. Plus how much? 20 plus. Check करो. Decrease in trade receivable plus 20. ये right हो गया. Then what is given? ठीक है. Then inventory, increase in inventory minus करेंगे 100. Increase in inventory minus 100. This is also correct. Okay sir. Then other current asset, it is once again increasing 40. 40 minus कर दो. 40 minus. तो 40 देखो minus हुआ. Yes sir, this is also we have done 40 correct. Then there was one other current, you can see I have written here operating item, other non-current asset. 85 become 95. Once again increase. Increase will minus 10. Increase in other non-current asset minus 10. Yes sir, this also done. I think asset side completed. Now come to liability side. Other non-current liability, 80 become 90. Increase. Increase in liability what will do? Increase in liability what will do bata? Of course plus sir. So increase in liability, other non-current liability check करो. Increase in other non-current liability 10 plus. This is also done correct. Then increase in trade payable. Here be careful. 450, but it will be 455 minus 25. It is actually 430. You can see decrease in trade payable. Decrease in trade payable by what? 20 only. So decrease in trade payable to minus 20. So decrease in trade payable minus 20. This is thoda sa interesting. Here you can do mistake. Then other current liability, from my point of view, this should not be shown as increase decrease. This should be shown as income tax paid. So at the end we write on income tax paid. Already we calculate 85. So this should be shown as an income tax paid, because what Ind AS 7 says, Ind AS 7 says that any income tax paid during the year should be disclosed as a separate item in cash flow statement. So after calculating cash generated from operating activities, cash generated from operation, write down minus income tax paid separately and then write on this. So all points we have done correct. Okay. Now we'll come to investing activities. Investing activities may only there is one item, that is what? Purchase of PP. Purchase of PP 100, but can 25 is payable, because they have written 25 included in trade payable was capital creditor. So you can see 100 minus 25, that become cash paid to acquire PP. But just check some other investing activities also. You can see here we have done. Here intangible asset, no changes. DTA, no changes. DTA, if there is some changes, that will be expense item, means that is either DTA creation or DTL creation or reversal, correct now. So that will also affect the tax expense. So that should not be considered, I will say. Means that should be considered only to find out expense, tax expense. Correct. There is some investment purchase कितना क्या 40, तो there is one investment purchase 40 minus करेंगे investment purchase 40, this become investing activities. Then let us come to financing activities. Equity share capital how much check करो, equity share capital it is 250 become 280 30, तो 30 plus करेंगे equity share capital 30. Then long term capital issued received 120 given in the information, and how much paid 60 has been paid, that has been calculated as a working note. Yes sir, this become financing activity, this is become net increase. You can see component of cash and cash equivalent, they have deducted bank overdraft, so this become opening, this become closing, and this will match. Understood? Have you understood this point? Any doubt in this? So always this you need to understand, whenever question is silent about, just write down if you want to write down other non-current asset. Correct. Question is silent about other current asset, other current liability, other non-current liability. Always assume they are operating item. They are operating item. Okay, sir? Yes, sir. One more question is pending from my side. I will do. But up to this, any doubt? No doubt? Let us come to that question. First question. This question also expected, can be asked for 10 marks in exam. Good question, I will say. In this question, they have given a consolidated financial statement. You need to only calculate cash flow from operating activities. So again, they are given only the extract of consolidated balance sheet. This is opening, this is closing. PP they have given. Investment in associate they have given. Okay. Financial asset they have given. Now, whenever for non-current asset, they have given financial asset, means they have not given the bifurcation. So always assume this is what? Investment or loan, means investing activity. Correct. And for current asset, they have given only financial asset. Only financial asset. Then assume what? Operating, because that will be trade receivable. Okay, na? These are the assumption. But under non-current asset, if they are given other financial asset, other means under financial asset, they have given other financial asset. Nothing has been given. So other financial asset will be always assumed to be operating item from examination point of view. So other financial asset, whether non-current or current. Similarly, other financial liability, whether current or non-current, will be always operating item. Always operating item. This you have understood? Bolo. Yes, sir. Then they give inventory, trade receivable, cash and cash equivalent. Then trade payable. They have given a combined statement of PL account, revenue, cost of goods sold, other income, operating expense, other expense, interest expense is a financing activity. Share of profit from associate. Now, if you know India is 28, any share of profit from associate and joint venture will be transferred to the consolidated SOPL of parent company. So, what journal entry will do? Investment account debit to sharing profit. So, again, this is non-cash. This is non-cash. This is a new item. Chalega. Then they have given some information. A Limited spent rupees 30 lakh on renovation of building. A Limited charge the entire renovation cost to PL account. This is error. So can you say what we should do? We should rectify this error before preparing the cash flow statement. So what journal entry will do? Batao. Can you say your building will increase and your expense will decrease? So you have charged it to what? Profit and loss account. So what journal entry will do? Building account debit to profit and loss account. Means increase the profit by 30 lakh. Means this will be corrected and we increase by 30 lakh. So it means we need to find out correct profit. We need to find out correct profit. Yes, sir. On 1st April 2001, A Limited acquired 100% shares in S Limited for a cash consideration of 300 lakh. Means this is the investing activities. Fair value of assets and liability acquired assume. So this much PP acquired, inventory acquired, trade receivable acquired, cash and cash equivalent acquired, trade payable acquired. Correct? Understood? This much you understood? Now you can see, Abhi, right now we have discussed that if this is the paid for acquisition and this much cash and cash equivalent received, so 300 minus 20, so your investing activities for acquisition of subsidiary will be 280. But can you see this is related to investing activities, therefore will not be relevant for this particular question because they have asked only cash flow from operating activities. But if they ask entire point, this become acquisition of subsidiary and the net amount will be 280. But I need to explain what we'll do about this. What we'll do about all this. This I need to explain. This I need to explain. Okay. And can you say, you can see PC is 300 and INA is 200. So your goodwill become 100. This goodwill will come in the balance sheet, but because they have given extract of balance sheet, therefore goodwill is not shown. But goodwill is somewhere in the balance sheet. That has not been shown because this is what? I hope you understand. It's a extract of balance sheet. A limited property, plant and equipment. They have given opening balance. This opening balance is what? 4650. Addition purchased during the year 800, but out of 800 lakh, something purchased from subsidiary can be 140 lakh. So 800 minus 140, can I say balance 800 minus 140, that is equal to 660. This is cash payment. So this will become investing activity. This will become investing activities. I'm just explaining the entire thing. Revaluation surplus, nothing to do in cash flow statement. Disposal. So this is a carrying amount of investment, carrying amount of PP sold, carrying amount of PP sold. Now in one of the para it is given, PP was actually sold for 630 lakh. So minus 630. So what become gain? 630 minus 490 is equal to what? 140. So this gain on sale will be transferred to PL, will be eliminated from PL to find out cash flow from operating activity. This need to be considered when you are calculating cash flow from operating activities by using indirect method. Chalega? And can this 630 will be investing activity? Depreciation is non-cash item. Be careful. This will be considered when you will calculate cash flow from operating activities. Carrying amount, closing balance given. Then A Limited constructed a machine that is a qualifying asset, incurred construction cost of 40 lakh that has been charged to other expense. Again, this is also an error. This should be capitalized. So what will be your rectification entry? Building account or machinery account debit to PL. So your PL will increase by 40 lakh. So your PL should be increased by 40 lakh. So you need to increase the PL by 40 lakh. Got this point? I'm adding to find out rectified profit. Similarly, of the interest cost of 110 lakh charged to PL statement, 10 lakh include interest cost on a specific one that need to be capitalized. Means you can see the total interest expense 110. Well, out of this 10 lakhs will be capitalized. Means the journal entry for this will be machinery account debit, rectification entry will be machinery account debit to PL. Means with this also PL will increase. Correct. Means your interest expense which has been transferred to PL is not 110, it will be 110 minus 10, that is 100 lakh, that is 100 lakh after rectification, This have you understood? Got this fine? This much have you understood? Yes sir. Then what is given? A Limited purchased 30% interest in an associate for cash on 1st April 2001. But what is the amount paid? That is not given in the question. The associate reported a profit after tax of 400 lakh and paid a dividend of 100 lakh for the year. So you can see 400 ka 30% is 120, that is already transferred to PL, share of profit, and 100 they have received dividend 30%. So 30 lakh they have received dividend. Now as per India's 28, whenever we receive dividend from associate, journal entry will be bank account debit to investment. So that will be created to investment account, that will not be transferred to PL account. So this has not been transferred to PL account. Correct. This I will explain again. Point number 6 I will explain again. Don't worry. Then impairment test was conducted and goodwill impairment loss 265 lakh. Intangible asset impairment loss is 900 lakh. Okay. This is also non-cash item. Goodwill impairment loss relate to 100% subsidiary. Assume that interest costs all paid in cash. You are required to determine cash generated from operation. Now we can do. So now you can see we have started cash flow from operating activities by taking rectified profit. What is our rectified profit? Check karo. Rectified profit will be 1840 plus 30 plus 40 plus 10. You can do one working note for this 1920. 1920. Then we'll do adjustment for non-operating and non-cash item. So there was one gain on sale already calculated. Gain on sale will be minus 140. Correct. Then there was the interest expense which has been charged to PL. Initially it was given 110, but from that we have rectified 10, so it remained 100. So interest expense you can see we have added back 100. Then depreciation given, depreciation will be added back 290. Impairment loss will be added back. Impairment loss will be added back. Then there is one sharing profit from associate. I said that was non-cash. That will be also eliminated. So eliminated means minus karo, income will be minus. So 120 has been deducted. So this become what? Profit before working capital changes. Before working capital changes. Up to this any doubt? Up to this any doubt? Bolo. Up to this any doubt? Understood? Now, let us come to the now changes in working capital. In this, I need to explain. Just try to understand. When we purchase one subsidiary, so can you say inventory was acquired, trade receivable was acquired, and trade payable was acquired, but this is actually related to investing activities. Got this point? So in that case, what we'll do is that should be adjusted from the inventory, whatever has been given in the balance sheet, from the closing balance. I'll just come to the working note directly. We working note. You can see trade receivable. Correct now. Trade receivable. They have done in some other way. We can do in some other way. Means what you will do? We can do in this way. The inventory. What is the closing balance? 1550. 1550. Out of this, how much acquired? 60 lakh. So 60 lakh minus from inventory. 60 lakh na inventory. So it is 1550 minus 60. How much? It is 1490. Now compare with the opening balance. Opening balance is 1900. 1900. So you can see there is a decrease in inventory by how much? Decrease in inventory by 410. Decrease in inventory by 410. Similarly, you can do for trade receivable. What is given closing balance 1250. How much acquired from subsidiary company 30? So minus 30 kar do. So this become 1220. Then compare with the opening. Opening is 1800. So how much decrease? Decrease kitna hua? 1800 minus 1220. That is coming 50. This is decrease. Similarly, you can do for current liability. What is 1550? How much acquired from subsidiary company? 50 lakh. So minus 50 kar do. It is become 1500. And this is 3610. So how much decrease in trade payable? So it is 3610 minus 1500, that is 2690. 2690. So decrease in trade payable will be minus, but decrease in trade receivable and decrease in inventory will be plus. That only they have done. Check karo. Check karo answer mein. You can see decrease in trade receivable 580, 410 and 2110. We have to calculate that only now. 580, 410 and what I have done. 550. Yeah, this My mistake. This 2110. 2110. So 2110 same amount came. Same amount came. This become cash generated from operation. This is the answer. This is the point where be careful. This is very interesting point. This working note, be careful. Be careful. Means normally I will say you'll do mistake in this particular point. Have you understood the last point? Have you understood the last point? Bolo. If you understood last point, then my job done. Now I'll just only explain the investment in associate. What they have given? Investment in associate. They have said that they have purchased one investment during the year, but this amount has not been given. But they have given how much is sharing profit. Sharing profit is 120, and dividend receipt by bank will do 30. And they have given closing balance. Closing balance, how much they have given? Closing balance from the balance sheet. If you go to balance sheet, the closing balance is given 800. The closing balance given 800. So can you see, you can easily find out this 800 plus 30 minus 120. Correct? 830 minus 120. That is 710. It means investment was acquired during the year by payment of 710. This is investing activities. And what is dividend received 30? That is also investing activities. So if suppose they ask full-fledged question, you should know what is this account. This account have you understood? This account have you understood? I hope this good question can be asked in exam. I have done my job. So with this IND AS 7, all the expected question which I have taken into consideration has been explained. Any question which you want me to explain? From cash flow statement chapter point of view? Which we want, that's do this question also, I will do that also. No sir? Chalo. So after this we'll take IND AS 12. IND AS 12 will take, but we'll take a 5-minute break. At what time you want lunch break? Bolo. I'll give lunch break as per your point of view. Let us fix lunch break at 2. Means after IND AS 12 we'll take lunch break. Okay sir? Are you able to follow me? Are you enjoying everything? Bol. Is this entire class helpful or not? Respond Baba. थोड़ा बात भी कर लेते ना. I know I need to complete use portion. Therefore, I am not discussing इधर उधर की बातें. Correct now. But I know now you may be tired. Are you tired now? Tired or not tired? Speed is okay. Everything is okay. This time, everyone should target exemption in FR. Okay, exemption लाना है. I will say more than 70 marks. You have 5 days more to prepare. 5 days more. In 5 days, you can easily prepare the entire syllabus and you can easily score more than 70 or more than 75 marks. Chalo, we'll take 5-minute break and then after with that we'll start IND AS 12. Okay. Yes, everyone. Ready, everyone? Can we start? Okay, sir. So now we'll start India's 12. Now, India's 12, I hope you know all the concept. I just give a brief concept that first we need to calculate a carrying amount of assets and liability. Carrying amount of asset and liability. Correct. Then we'll need to find out tax base for asset and liability. This will become the temporary difference. Temporary difference. Now for asset, if the carrying amount is more than tax base, it becomes taxable temporary difference. For asset, if carrying amount is less than tax base, it is deductible temporary difference. For liability, it is reverse. If carrying amount is more than tax base, it is deductible temporary difference, and carrying amount is more than tax base, it is taxable temporary. Sorry, it is less. Carrying amount is less than tax base, it is taxable temporary difference. On taxable temporary difference, we calculate DTL, and on deductible temporary difference, we recognize DTA. Understood? For recognition of DTL, there is no condition. There is no condition. For recognition DTA, there is one condition, that DTA can be recognized only when there is a sufficient future taxable profit is available against which the DTD can be recognized. Means if we do not have sufficient future taxable income from which that deductible temporary difference can be deducted, then we will not recognize in DTTA. Got this point, that condition? However, DTA is also recognized for unused tax losses which can be carried forward. Means any tax losses which can be carried forwarded, for that also we recognize DTA. And if we have some tax credit which can be carried forwarded, for that also DTA are recognized. Got this point? Have you understood? Yes, sir. No doubt. This is about deferred tax. For current tax, nothing is to be said. Ki first calculate taxable income, multiply by rate of tax, that will become current tax. So current tax is calculated as per taxable income, which is calculated as per Income Tax Act. As per Income Tax Act. This was just a brief discussion about India's 12. Okay, sir. Now let us start. I will do question number 1 at the end. First, let us do small question. Then I will come to the question number 1 at the end. First question 5. An asset with a cost of rupees 100 and a carrying amount of rupees 80 is revalued to 150. So 150 is the carrying amount after revaluation, and you can see 80 is the carrying amount before revaluation. It means revaluation gain is how much? 150 minus 80, that is equal to what? 70. Revaluation gain is 70. No equivalent adjustment is made for tax purpose. Means for tax purpose there is no revaluation. Cumulative depreciation for tax purpose is 30, and the tax rate is 30% if the asset is sold for more than cost. But if the asset is sold more than the cost price, the cumulative tax depreciation of 30 will be included in taxable income, but the sale proceed in excess of cost will not be taxable. Sale proceed in excess of cost will not be taxable. Means can I say sale proceed in excess of cost? So if I am saying revalued amount is 150, so that become the expected sale price, and the cost by 100, so that 50, the difference 50 is not taxable. Calculate deferred tax in the following cases. If the entity expect to recover the carrying amount by using the asset, Can you see if the entity is expected to recover the carrying amount by using the asset, then the question of sale will not arise. Correct now. Then this point is not relevant. Any sale proceed in excess of cost will not be taxable. That is not relevant. Got this point? Whatever I am saying. In that case, carrying amount is 150 and tax base will be how much depreciation for tax base 30. So 100 minus 30 means 70. 70 is the tax base. The difference become what? 80 become the taxable temporary difference. So this because carrying amount is more than tax base, so it become taxable temporary difference. On that, what is the rate of tax? The rate of tax given 30%. So 80 into 30% means 24 will be deferred tax liability. So I think point number A is very clear. Point number B, what they are saying is the entity expect to recover the carrying amount by selling the asset. By selling the asset. In that case also 150 is what? The carrying amount. And 70 is what? The tax base. So what is the taxable temporary difference? 80. But out of 80, can 50 is not taxable. That is a 50 is non-taxable. Means that is permanently disallowed. If that is permanently disallowed, so on that no deferred tax will be created. So it means only on 30 deferred tax will be created. So 30 into 30% means 9 will be what? Your deferred tax liability in the second situation. In the second situation. Got this point? Got this point? Suppose in the question they have said, one more point I am just adding to the question. Suppose in the question they have said ki regular tax rate is 30%, but if you sell the asset, then any taxable any if you sell the asset, then it will be taxable at 20%. So in point number B, then the tax rate will become 20%. In point number B, then the tax rate will become 20%. Got this point? Have you understood? Yes, sir. Correct. Chalo आगे. Question 7. On 1st April 2001, S Limited leased a machine over 5-year period. The present value of lease liability is 120 crore. Discount rate is 8% and recognized as lease liability and corresponding ROU asset. Means they have applied IND AS 116. They have applied IND AS 116 on this. Okay, sir. Okay, sir. Yes, sir. The ROU asset is depreciated and is straight line method over 5 years. Okay. The annual lease rent is 30 crore payable starting on 31st March 2002. The tax law permit tax deduction on the basis of payment of rent. Just try to understand this point. Normally students do not able to understand this particular point. Means as per Income Tax Act, there will be no asset, there will be no liability. Whatever payment is made, that will be recognized as an expense under Income Tax Act. Means can I say the tax base for the asset and liability will be zero under Income Tax Act. Under Income Tax Act. Got this point? It means first we need to find out what is the carrying amount of assets and liability. So if I am saying what is ROU asset, that you need to find out, and what is the lease liability, that you need to find out, the carrying amount, lease liability and ROU asset. So what is the opening balance given for lease liability? It is given 120 crore. 120 crore. In this will add interest. Interest expense will be calculated by using discount rate. Discount rate is what? That is 8%. The interest 120 into 8%, that is 9.6 will be added. Then 30 crore is lease payment, that will be minus. So this will become how much? Check karo. This will become 99.6. The closing balance become 99.6. Similarly, ROU asset is 120 crore opening balance will be depreciated over 5 years. So 120 divided by 5 is equal to what? 24. So closing balance is what? Closing balance will be how much? That is 96. The closing balance is 96. This become carrying amount. Then tax base is nil nil. Tax base is nil nil. You can also find out net amount. Net amount is what? Means lease liability minus ROU asset. Means net amount. Also we can find out the deferred tax asset and deferred tax liability. So you can see 99.6 minus 96. It is coming 3.6 net amount, and this is also 0. So either you do on gross amount or net amount. So you can see this is net liability. So net liability carrying amount is more than tax base. For liability, if carrying amount is more than tax base, so okay, this become deductible temporary difference. this become deductible temporary difference on which DTA will be recognized. DTA will be recognized. Or what you can do, you can first calculate DTA on this and create DTL on this and then calculate net amount. Both will give same answer. Both will give same answer. IC has used the net wala point, therefore I have also taken net wala point. Chalega? Yes sir. So in this DTA will be recognized. You can see they have created DTA of how much? 1.08 crore. Chalega? Yes sir. Coming to question 9. On 1st Jan 2020, entity H acquired 100% share capital of entity S for rupees 15 lakh. That is purchase consideration. The book value of the fair value, the book value and the fair value of identifiable assets and liability of entity S on the date of acquisition are given below. You can see book value is given, tax base is given, and fair value has been given. Understood? Yes, sir. Together with their tax base in the entity S tax jurisdiction. So this tax base is from subsidiary S point of view. Got this point? Yes, sir. We want tax base from acquiring company point of view only. Any goodwill arising on the acquisition is not deductible for tax purpose. Whenever they have given any goodwill arising on acquisition is not deductible for tax purpose, it means no DTA, it means no DTL will recognize on goodwill. No DTL will recognize on goodwill. So therefore, this point is relevant in Indian context. Therefore, this point will be given the question, even though not given the question, always will assume that goodwill will not be deductible for tax purpose. The tax rate in the entity H and entity S jurisdiction is 30%, 40%. This will be doubt कि deferred tax will be calculated based on 30% or 40%. First thing this we are doing, just try to understand. I'll ask one question. कि this we are doing, DTL we are calculating in consolidated financial statement. Means we are preparing in the books of H Limited, means in the consolidated books of H Limited. My question to you all, DTA or DTL will be calculated by using 30% or 40%. Here only you may do mistake. But the deferred tax will be calculated by using 30% or 40%. Everyone respond fast. I was expecting you will give me wrong answer. You have given wrong answer. This why this for this purpose this class is useful. Means identify the point where I'm asking question and you respond whenever I'm asking question, because if you are doing mistake, not only you can rectify in exam. Just try to understand. Even though we are doing the calculation in the consolidated financial statement of H Limited, but we are doing from subsidiary company point of view. Correct now. Means what differs? Means this all calculation we are doing from subsidiaries company's point of view. This is the INA of which company? Subsidiary company. Recognized in the books of what? Parent company. So tax will be calculated as per the tax jurisdiction of what? Subsidiary company. Therefore deferred tax will be calculated 40%, not 30%. देखो यहीं पे everyone is saying 30%. Believe me, in only this question they have given two tax rate. If they have given only 30%, no doubt will come. Only 30% no doubt. Ha, if it is a question of what? This is a question of subsidiary company. This is a question of subsidiary company. I hope you are understanding. Correct. If it is a question of business combination apart from formation of subsidiary company, then doubt will not come, because in that case the acquiring company is liquidated. If acquiring company is already liquidated, then we'll take the tax rate of what? Acquirer. Means if suppose it is an amalgamation, absorption, in that case we'll take the tax rate of what? Acquirer. But in this case though it is a consolidation question, means in this case parent company has acquired subsidiary company, but subsidiary company is not liquidated. So in that case the tax rate of subsidiary company is relevant. 40% is relevant. First point, have you understood? Now just try to understand. In this case tax base and book value both are given. So what is the formula? Formula is that first write down fair value of INA. Fair value of INA is given. Can you give me fair value of INA? This is fair value of INA. So give me I think the total has been done. I'm taking this amount 1070. 1070. You can find out fair value of INA. Correct. Then tax base of INA, find out tax base of INA. I'm just taking this amount 920. 920. Tax base of INA is 920. Correct. Now, if the fair value is more than tax base, means fair value is nothing but initial carrying amount in the books of acquirer company. This will become initial carrying amount. The carrying amount is more than tax base, so it will become taxable temporary difference. That is 1070 minus 920. That is coming 150. 150 is the taxable temporary difference into what? 40%? Into 40%. So 150 into 40%, that is coming 60. So 60 become deferred tax liability. You can see we have recognized a deferred tax liability of 60. Deferred tax liability of 60. Understood? Now, sometime in the question the tax base is not given. Whenever tax base is not given, we'll assume carrying amount of INA is equal to tax base. So for this purpose, if the tax base of INA of acquiring company is not given, we'll assume carrying amount of INA is equal to tax base of INA. I hope you understood this point. So whenever fair value of INA is more than tax base, is it taxable? Reverse case means fair value of INA is less than tax base, then it become deductible temporary difference, then recognize DTA, then recognize DTA. It means 60 is DTL. Now what is the fair value of INA? 1070. Okay, DTL whatever you have calculated that is deducted from INA, तो minus 60 कर देंगे. तो what is the total INA? Total INA become 1010. Total INA become 1010. Now they have asked you to calculate goodwill also. So what is the purchase consideration? 1500 minus 1010, because 100% they have acquired, so NCI is 0. So 1500 minus 1010. So 1500 minus 1010. Goodwill will become 490. Goodwill will become 490. Understood? Bolo. Have you understood this point? Got this point? Sometime in the question they ask you calculate separate DTA and separate DTL. In that case, now what you'll do, you'll find out individual difference. Suppose they have said calculate DTA and DTL separately. So in this case, for this, for example, land and building, you can see fair value is more than tax base. So 200 is the taxable temporary difference. On this DTL you recognize. Then once again 270 is more than 200. So it is 70 taxable temporary difference, on this also DTL. 80 means in this case fair value is less than tax base. So here 20 become deductible temporary difference. On this DTA will be recognized. So can you say on individual assets and liability you can find out taxable and deductible, then calculate DTA and DTL respectively. Then find out total DTA and total DTL. So if they ask you to calculate separate DTA, separate DTL, do separate calculation. Understood this point? Yes sir. Yes sir. Chalega. This also you have understood. Come to question number 2. This super doubtful question from every student point of view. Correct. Till now not asked in exam, can be asked in exam. Till now not asked in exam. On 1st April 2001, P Limited granted 1 crore share option worth rupees 4 crore subject to 2-year vesting period. Means it is a question of ESOP, share based payment. The income tax law permitted tax deduction at an exercise date of the intrinsic value of option. What income tax law says? He will allow the tax deduction during exercise period, means at the time of exercise, based on the intrinsic value on exercise date. Based on the intrinsic value on exercise date. Okay. The intrinsic value of option on 31st March 2002 was 1.60 and on 31st March 2003 is 4.60. The increase in the fair value of option on 31st March 2003 was not foreseeable on 31st March 2002. The options were exercised on 31st March 2003. Give the accounting treatment for the above transaction for deferred tax for the period ended. Assume that there is sufficient taxable profit available, means if there is a DTA, create DTA on the assumption that future taxable profit are available. Even though this point is not given, always recognize DTA on the assumption that yes, that condition will be satisfied. Yes, that condition will be satisfied. Got this point? Now let me explain what they have given. They have given 2 years. This is 31st March 2002. This is 31st March 2003. Okay. Yes, sir. Now they have given option was granted on this day. This is grant day. How many options were granted? 1 crore options were granted. 1 crore options were granted and fair value on grant date was 4 crore. Means fair value on grant date was 4 crore. So as per Ind AS 102, can this fair value on grant date is relevant? Correct. So if we assume that there is no, the options whatever has been granted, they all were vested on vesting day. So can I say this will be recognized as 2 crore and 2 crore expense for these 2 years? If all the options were vested, there is no cancellation, there is no unvested options are not cancelled, let us assume. So this 2 crore will be recognized as an expense as per Ind AS 102. As per Ind AS 102 I am saying. Chalega. Means what journal entry will do? EB expense account debit to SBP reserve, EB expense account debit to SBP reserve. Okay. This is a fair value. Now they have given intrinsic value 1.60 and here 4.60. Understood? 1.6 and 4.6. Now what do you mean by intrinsic value? Intrinsic value means market price of this date minus exercise price. So if you take market price on this date minus exercise price, that become intrinsic value. And the question says that vesting day and exercise they are same. Vesting day and exercise they are same. So as per income tax law, what they are saying, the expense will not be based on the fair value of option on grant day, means that is giving some contrary point as per Ind AS 102. As per Ind AS 102, this is the expense allowed. But as per Income Tax Act, expense is allowed not on vesting period. Expense will be allowed under income tax on exercise day, means in the year when it will be exercised, means on 31st March 2003, and based on what? Intrinsic value. Based on intrinsic value. Understood? Based on intrinsic value. Got this point? Correct? Have you understood this point? So it means, can I say, we need to find out carrying amount and the tax base. Carrying amount and tax base. Just try to understand what journal entry we have done. Journal entry is what? EB expense account debit to SBP reserve. First, can you see there is no asset, no liability. There is no asset, no liability. Are you able to understand? Are you able to understand? Correct? Or just try to understand in this way. Under Income Tax Act, this 2 lakh is not allowed in this year. This 2 crore will not be allowed in this year. 2 crore will be allowed as a deduction in future. So can you say any expenses which are deductible in future, that is nothing but deductible temporary difference. So we need to estimate, because we are standing at this point of time and we don't know this intrinsic value as on this date. So what our Ind AS 102 says, we need to estimate this. But it is already given in the question. What is given in the question? The increase in the fair value option on 31st March 2003 was not foreseeable on 31st March 2002. Means this 4.60 cannot be estimated on this date. Practically not possible. Therefore, estimation will be based on the current intrinsic value. So we'll assume this is the intrinsic value for which deduction will be allowed in future. Therefore, for 31st March 2002, carrying amount will be nil. And tax base, what will be the amount which is deductible in future? That will become the tax base. Any amount which is deductible in future under Income Tax Act, that is only the tax base now. Understood? It is as simple as, suppose you purchase a machinery and the entire cost is deductible in future, so that become the tax base. That become the tax base. So 1.60 is for 2 years, but we are here right now standing for 1 year. So 1.60 divided by 2, so the tax base will be 0.80, and that will become deductible temporary difference of 0.80. Now coming to 31st March 2003, once again this will be nil. But can I say on this date, so all expenses will be allowed under Income Tax Act, because now it has been exercised. It means nothing is allowed in future now, because this will be allowed as an expense in this year only. So nothing will be allowed in future. Therefore, tax base also will become nil and this will become nil. Understood? Now we recognize DTA at what rate? At what rate? DTA at 30%. It is given 30%. So 0.8 into 30% is equal to 0.24. And this will become nil. So this is DTA created and this will be reversed in the next year. 0.24 will be reversed in next year. Means what journal entry will do for this DTA account debit to PL 0.24, and here PL account debit to DTA 0.24. These two journal entry will be done. Have you understood this point? Have you understood? Fast. Everyone respond. This is the most doubtful question in ICS study material for which every student have a doubt. If you have understood, I will proceed. Otherwise, I will explain again. But I think you have understood. First, have you understood? Please, everyone respond. First, have you understood why carrying amount is nil? Carrying amount is nil. Tax base portion. Now, just try to understand. Tax base. Just try to understand. What is the tax base of an asset? Whatever amount is deductible in future under Income Tax Act is the tax base. Achha, let me ask you one question. Let me ask you one question. Let me ask you one question. छोड़ दो इसको छोड़ दो. Suppose everyone. Suppose you have done an expenditure of rupees 1 lakh, which is charged to profit and loss account as an expense in books, but it will be allowed as an expense in next year under Income Tax Act. ठीक है ना? This is the question. I'm asking some question. Leave it, whatever I am saying. There is an expenditure of 1 lakh which has been charged to PL as an expense in books of account. However, it will be allowed as an expense in the next year. My question to your carrying amount is how much? Carrying amount will be what? Everyone respond. Carrying amount will be what? And the tax base will be what? For the first year. Year 1. Everyone respond fast. Chalo. Everyone is saying correct. Means carrying amount is 0 and the tax base 1 lakh na. That only I am saying. Just try to understand. But in this case, what is the expense which has been charged to PL? 2 crore. And what will be allowed? What is the expense allowed under Income Tax Act? This 1.60 is the total value of option, intrinsic value of option for 2 years. So first year, what is allowed in future? That is 0.8. 0.8. So I think nil and 0.8, this you have understood. Nil and 0.8, this you have understood. Bolo. First, but the first year, have you understood? Then I will ask you next question. Bolo. Have you understood this? If you are saying 0 and 1 lakh, then you have understood this also 0 and 0.80, because 0.80 is the relevant expenses which is allowed under Income Tax Act for the first year in future is 0.80. Have you understood this much? Fast. Now, my next question is that in the next year, year 2, in the same question, because expense will be already allowed in next year. Expense will be allowed in next year under Income Tax Act. So what is the carrying amount? Carrying amount will be 0, and this will be also 0 now. Both will become 0. Both will become 0. Understood? Because the next year in this particular question, 31st March 2003 is the date when it was exercised. So this is the date when entire expense will be allowed under Income Tax Act. If entire expense will be allowed under Income Tax Act, so nothing will be allowed in future. So this 4.60 will be allowed as an expense under Income Tax Act, already allowed. So there is no future reduction. Therefore, it will become 0 and 0. Now have you understood? Now have you understood? Bolo. Let everyone say, have you understood or not? Because this already I say the most doubtful question in ICS study material where every student have doubt. Everyone understood now. So let me ask you one question if you have understood. Now you will do, everyone will do by your own. I am changing the question, okay? So this is the vesting period, and this is the exercise period, and this is the exercise day. Means now I am saying vesting period, vesting day and exercise day are different. Same question I am giving. 1 crore option. Payer value of option is 4 crore initially. Then intrinsic value is given 1.6. Then 4 point how much? 4.6 crore and 5 crore. This become Y1, Y2, Y3. Tax rate 30%. Calculate deferred tax for Y1, Y2, Y3. Everyone do. If you can do this correctly, means you have understood. Do it. Have you written the question? Just write down because the screen was disturbed. Now, I said the same question. I have only changed what? The vesting day and exercise day I have changed. And now I have given this is 5 crore. 5 crore. Same information. Now this is the format y1, y2, y3. You need to find out carrying amount tax base. If you can do it by your own, means you have understood. Can you do it by your own? Means let me understand my ability whether I can explain you one concept in a very short span of time. Because in regular class we do detailed discussion. If I can explain you in short span of time, means gajab, maja aa raha hai. Yes or no? Maja aa raha hai na? And from my point of view, if you have understood previous question, this also you can do if you have understood conceptually. Because what question they asking exam that we don't know. So once you need to understand thoda conceptually also. Don't do keep for this particular question you have understood. Then if they will change the question, you will not be able to understand. Do it fast. Means you need to also think about the India's 102 also. अच्छा बता. First year one. Year one what you have done? Year one, so I think it is nil. It is 0.80 crore. So this become deductible temporary difference of 0.80. So DTA how much? 0.24. It is same only. 2 second year. Fast. Year 2. Rosni, year 1 is correct. I want year 2. If you can do year 2 correctly, means you have understood. No, no, both are not nil. It means you have not understood. If you are saying both are nil, what is the difference between this and this? Now in this case, you can see this is the vesting day and this is the exercise day. Means now expense will be allowed in the third year. It will be allowed in third year now. Till now, this is not allowed under Income Tax Act. Under Income Tax Act, 4 point means under Income Tax Act, year 3 is the date, means on this date, expense will be allowed under Income Tax Act based on this intrinsic value. Understood? Are you able to follow me? So this will be nil and this will be 4.6 crore based on 2 year, because future deduction to be allowed for the 2 year is 4.6 now. So 4.6 into this become deductible temporary difference, and into 24.6 into 30% how much? 1.38. And now year 3 it will become nil nil. So this will become nil and this will be nil. Means how much DTA created? 0.24. Then DTA created minus 2 minus 0.24 crore. So this is DTA created is 1.14, and here DTA reverse will be 1.38. DTA reverse will be 1.38. Understood? Yes, Giri, you are correct. Giri, you are correct. Now everyone have understood? I think this question will give better clarification. Whatever question was given ICS study matter, there was a lot of doubt. This will give better clarification if you do this question. Now I think I have given a lot of time for this. Can we proceed? Can we proceed? Yes, sir. Chalo. Come to next question. Now, 14. A Limited prepare financial statement for 31st March. Tax rate is 20%. They have given two information. First, A Limited is a 40% shareholding in L Limited. A Limited purchased this shareholding for rupees 45 crore. Means the cost price 45 crore. The shareholding give A Limited significant influence. बोला कि there is a significant influence means associate means Ind AS 28 will be applicable. Therefore, equity method will be applied. Now, as per equity method, the carrying value of A Limited investment is 70 crore on 31st March 2001 and 75 crore on 31st March 2002. In the tax jurisdiction in which A Limited operate, of course, profit recognized under equity method are not taxable, and that will be taxable only when distributed dividend or when relevant investment are disposed of. Means under income tax act, that fair value gain or loss means whatever profit we are recognizing under Ind AS 28, that will not be taxable. This will become taxable deductible only when the profit are distributed or when the relevant investment are disposed of. Got this point? It means tax base will be cost price only. It's simple. Investment, there are 2 years, 31st March 2002 na, 31st March 2001 and 2. 31st March 2001 and 2. So what is the carrying amount? Carrying amount is 70 and 75. Tax base is 45. Very simple. 70 and 75, 45. So this become taxable temporary difference of how much? 70 minus 45. That is 25. This is 30. We will create DTL. DTL at a rate of 20%. This is 5 and 6. Correct. In this question, they have asked 2 points. What is the DTL of current year? This is a DTL. DTL is 6. Because for this year, DTL closing balance deal and how much DTL will be recognized in SOPL. DTL recognized in SOPL. So how much DTL created? 5 becomes 6. So DTL recognized in PL will be 1. PL will be 1. So these are two answers. So if they ask DTL in balance sheet, you answer 6. How much deferred tax expense in SOPL will be 1. Because 6, 5. So difference is 1. 5 becomes 6 now. How much DTL created is 1. Chalega. This was one simple question. I hope you understood. Next question, what they have asked. A Limited measure is head office building using the revaluation model. The building is revalued every year on 31st March. On 31st March. On 31st March 2001, the carrying value of building after revaluation was 40 crore and its tax base was 22 crore. Means building, what they have given, year 1 and year 2 I am writing. So what is the carrying amount? Carrying amount is 40 crore and the tax base is 25 crore. ये दिया हुआ है. This only has been given. Oh sorry, 22 crore. 22 crore. Okay sir. Then what is given? During the year ended 31st March 2002, A Limited charged depreciation in SOPL of 2 crore and claim a tax deduction of 1.25 crore. On 31st March 2002, the building was revalued to 45 crore. In the tax jurisdiction in which A Limited operate, revaluation of property, plant and equipment does not affect the taxable income because revaluation is not allowed under Income Tax Act. So what is the carrying amount after revaluation? 45 crore. This becomes 45 crore. And can you see in this 1.25 is depreciation under Income Tax Act. So this is 22 minus 1.25, that is coming 20.75. This is the information. How it become 45? Let's see. 45 mean what is the depreciation? Means depreciation is given under books. It is given how much? 2 crore. So 40 minus 2, it become 38. So what is the revaluation gain? Revaluation gain is what? 38 minus 45. So plus 7 is what? Revaluation gain. Plus 7 is the revaluation gain. I hope this much you have understood. Correct. Now coming to the taxable temporary difference. So what is the taxable temporary difference? 40 minus 22, that is 18. And here 45 minus 20.75, that is 24.25. Okay. So DTL will be created. So 18 into 20%, it is 3.6 and 24.25 into 20% is what? 4.85. 4.85. Got this point? Have you understood this? Correct. Understood. But can I say In the current year, there was a revaluation gain. Revaluation gain will give rise to taxable temporal difference. Taxable temporal difference. Now, what our India's 12 says that because revaluation gain is transferred to OCI, their deferred tax will be also transferred to OCI. So, on 7 into 20%, 7 into 20% means 1.4. So, 1.4 will be the DTL created, which will be recognized through OCI. So, from this will minus what? 1.40. So balance what? 4.85 minus 1.4 is equal to 3.45. 3.45. So opening was 3.6 and the closing become 3.45. So there is a decrease in DTL. So there is some DTL reversal. DTL reversal is how much? You can see 3.45 minus 3.6. So DTL reversal is 0.15. So DTL created, just right, DTL created due to revaluation, this will be transferred to OCI. And DTL reverse, this is DTL reverse, this will be transferred to PL. This will be transferred to PL because DTL reverse will be due to depreciation. Because of depreciation, and depreciation is charged to PL account, so DTL reversal will be also transferred to PL. This is also an important point. Have you understood this calculation? This calculation have you understood? Bolo. Yes, sir. Chalo. Come to next question. Question 15. K Limited prepare consolidated financial statement to 31st March each year. During the year ended 31st March 2002, K Limited earned enter into the following transactions. On 1st April 2001, K Limited purchased an equity investment for rupees 2 lakh. The investment was designated as FBTOCI. On 31st March 2002, the fair value of investment was 2,40,000. In the tax jurisdiction in which K Limited operate, unrealized gain or loss arising on the revaluation of investment of this nature are not taxable unless the investment is sold. K Limited has no intention of selling the investment in the foreseeable future. Means just try to understand what they have asked. Explain and show how the tax consequences current and deferred of the three transactions would be represented in SOPL and other comprehensive income for the year ended 31st March 2002. Correct. So can you say for the first transaction because it because can you say on 1st April 2000 K Limited purchased an equity investment 2 lakh and which was designated FBTOC and the fair value is 2,40,000. So on that too there is no current tax consequences because current tax will be on taxable income and this whatever fair value gain will not be allowed under income tax side. So current tax consequences will be zero. There is no current tax consequences. But can you we need to find out deferred tax. Deferred tax will be what? Carrying amount will become 2,40,000 and the tax base will become 2 lakh. So 40,000 will become taxable temporary difference on which DTL deferred tax liability at the rate of 25%. So 40,000 into 25%, that is 10,000 will be recognized but through OCI. Why through OCI? Because it is measured FBT because the gain and loss will be transferred to OCI. Therefore this DTL will be also created through OCI. This is only given in the solution. This you have understood. First part was easy. Second part. On 1st August 2001, K Limited sold product to A Limited, a wholly owned subsidiary operating in the same tax jurisdiction as K Limited for rupees 80,000. So 40,000, it was sold for rupees 80,000. The cost of the goods sold was 64,000. So can you see there will be one current tax consequences. So 80,000 is the sale price, 64,000 is the cost price. So 80,000 minus 64,000 means 16,000. On this there will be current tax consequences, that is 25%. So 16,000 ka 25%, 4,000 will be current tax. You can see they have given 4,000 will be the current tax which will be transferred to profit and loss account. Now they have given by 31st March 2002 A Limited has sold 40%. Has sold 40%. Correct. It means can you say 60% remain unsold? So whatever unsold portion on that deferred tax will be means on that unrealized profit will be there and on that unrealized profit there will be some deferred tax. Just try to understand what is this inventory unsold. So inventory unsold is what? Their carrying amount will be in the books of, means in the books of subsidiary company, that will become inventory. Correct now. So 80 now in consolidated financial statement, that unrealized profit will be eliminated. Correct. Means can I say 64,000 into 60% will be carrying amount, but the tax base unrealized profit will not be eliminated. Means 80,000 into 60% will be tax base. I hope you're understanding. Means simply we can say 16,000 into 60% will be deductible temporary difference. In simple word, 16,000 into 60%, how much? 9,600 will be the deductible temporary difference. On 9,600, we'll find out 25%. So into 25%, it is 2,400. So 2,400 will be deferred tax asset, which will be created. Have you understood this point? Have you understood this point? Bolo. This also you have understood? Means whenever you eliminate unrealized profit now, so carrying amount of the stock will be after elimination of unrealized profit, but tax base will remain same, because under income tax there is no elimination of URP. There is no elimination of URP. Okay, yes sir. Coming to point number 6. On 31st October 2001, K Limited received 2 lakh from the customer. The payment was in respect of service to be provided by K Limited from 1st November 2001 to 31st March 2002, 31st July 2002. Means you can see November, December, January, February, March. 5 months is what for this year? Correct. And April, May, June, July. April, May, June, July. 4 months is for next reporting period. K Limited recognize the revenue of 1,20,000. So what they have done? 2 lakh divided by 9 into 5. How much? How they have recognized? November, December, January, February, March, April, May, June, July. The 9 month. अच्छा चलो ठीक है. K Limited recognize revenue of rupees 1,20,000 in respect of this transaction in the year ended 31st March 2002, and we recognize the remainder in the year. Means out of 2 lakh, control has been transferred for 1,20,000. So 1,20,000 is already recognized, and the balance will become pre-received income. Means that will be deferred revenue. We recognize the remainder in the year ended 31st March 2023. Under tax deduction in which K Limited operate, 2 lakh received on 31st October 2001 was included in taxable profit of that particular year. Means entire is taxable as per Income Tax Act. So can you say this become one type of liability, pre-received income? So pre-received income is how much? 80,000. First, current tax consequences will be what? Current tax consequences will be 2 lakh into 25%, because entire is what? Taxable. So you can see 2 lakh into 25% is current tax. Now we need to find out deferred tax. So your liability is 80,000. Carrying amount of liability is 80,000. In tax base will be nil. So 80,000 is the carrying amount of liability is more than tax base. It become deductible temporary difference 80,000. On this 80,000 into 25% means how much? 20,000 will be the deferred tax asset. 20,000 will be the deferred tax asset. Check karo. You can see 20,000 deferred tax asset will be recognized. This type of question can be asked. Come to one more question. Come to question 20. B Limited is a newly incorporated. This is also good question. Can be expected in exam. B Limited is a newly incorporated entity. Its first financial period ended is 31st March 2011. As on the said that the following temporary difference exists. Taxable temporary difference of rupees 9,000, and these are expected reverse equally over 3 years. Means 3,000, 3,000, 3,000, it will be reversed. Deductible temporary difference 4,000, which are expected reverse for equally over 4 years. So 1,000, 1,000, 1,000, 1,000, it will reverse. Now it is expected that B Limited will continue to make losses for the next 5 years. Tax rate is 30%. Losses can be carried forward but not backward. Now, can you say taxable temporary difference? There is no condition. Means can you say we can recognize deferred tax liability on this 9,000 without any condition? means 9,000 into 3 per 30%. How much? 9,000 into 30% means 2,700 deferred tax liability will be created. Now, but 4,000, there is condition that future taxable profit should be available. So, Ind AS 12 has given some criteria for the assessment of future taxable profit. First criteria is what? First, identify the taxable temporary difference whose reversal pattern matches with the reversal pattern of deductible temporary difference. This is given under Ind AS 12. So you can see taxable temporary difference. It is given. It will reverse in this order. 3,000 equally over next 3 years means 3,000, 3,000, 3,000. Correct. And here nil. Here nil. Understood? Then deductible temporary difference 1,000, 1,000, 1,000, 1,000, 1,000, 1,000. Means can you say when taxable temporary difference reverse, that will increase taxable profit. Means can you say in this year due to reversal of taxable temporary difference, we have 3,000 taxable profit against which this can be utilized. Therefore, can you say for this we have a sufficient taxable profit and therefore DTA can be recognized for this 3,000. DTA can be recognized for this 3,000. But for this 1,000, there is no taxable temporary difference whose reversal pattern matches with this reversal. Therefore, what Ind AS 12 says that now find out whether there is any probability of future taxable profit. What they have given, key in this question, what they have given, they are expected to make losses for the next 5 years, means there is no probability of future taxable profit, and therefore on this 1,000, no deferred tax will be created. Means total deferred tax asset will be on 3,000 into what? 30%. On 3,000 into 30% or what? 30%. 30% means how much deferred tax asset? 3,000 ka 30%, 900 will be deferred tax asset. And on this 1,000, DTA will not be recognized. DTA will not be recognized. Got this point? Expected in exam. Expected in exam. Can we come to the next question? Means all this now MCQ can be also asked. Multiple choice question can be also asked in exam. Okay, sir? Chalo. Come to question 22. X Limited prepare consolidated financial statement to 31st March each year. During the year ended 31st March 2012, the following event affected the tax position of the group. Y Limited, a wholly owned subsidiary of X Limited, made a losses adjusted for tax purpose of rupees 30 lakh. So there was a tax losses. Y Limited is unable to utilize this loss against previous tax liability. Of course, it cannot be carried backward. Income tax does not allow Y Limited to transfer the tax losses to other group companies. Of course, it cannot be set off with the profit of other group companies. However, it allows Y Limited to carry the losses forward and utilize it against company's future by taxable profit. Means it can be carried forward. Means on this tax losses, DTA can be created subject to prudence condition that future taxable profit should be available. But what is given? The actors of X Limited do not consider that Y Limited will make taxable profit in foreseeable future. Because of this particular point, no deferred tax asset will be created on this. No DTA will be recognized. Chalega? Okay, sir. Next point. Just before March 18, X Limited committed itself to closing a division after the year and making a number of employees redundant. Closing a division means they are committed to closing a division, means Ind AS 37 will be applicable and provision for restructuring costs should be recognized. And therefore, X Limited recognized a provision for closure cost of 20 lakh in the statement of financial position. Income tax allow the tax deduction for closure cost only when the closure actually takes place. Means how much is the carrying amount of liability? 20 lakh. But it will be allowed only when it is actually paid. So it will be the tax base will be nil. Now carrying amount is more than tax base for the liability. So it will become deductible temporary difference. On this will create DTA by applying the tax rate. Tax rate is given in the at the bottom of the question 20%. If I apply 20%, DTA will be recognized on this. And is given in the year ended means X Limited has a taxable temporary difference from other sources which are greater than 20 lakh. Means they have a sufficient taxable profit whose means taxable temporary difference whose reversal pattern matches with the reversal pattern of deductible temporary difference, and therefore they have given also expect to make taxable profit which are well in excess of 20 lakh. Means this is a clear indication that DTA can be recognized. Next point. During the year ended 31st March 2017, X Limited capitalized the development cost which satisfy the criteria under Ind AS 38. The total amount capitalized was 16 lakh. The development project began to generate economic benefit from 1st Jan 2018. Means it was available for use from 1st Jan 2018. Means for current year, January, February, March, 3 month amortization will be applied. They have given that economic life is what, 5 year, economic life is 5 year. So 16 lakh divided by 5, 3 month amortization will be how much? 80,000. So 16 lakh minus 18,000, 80,000, 15 lakh 20,000 become carrying amount. 15 lakh 20,000 become the carrying amount. This you have understood? Yes, sir. Now it is given the question that the actors of X Limited, the actors of X Limited estimated that project would generate this. To I have already read. The development expenditure was fully deductible against taxable profit. So it is allowed as expense in the year in which it is incurred under income tax act. Therefore, the tax base will become nil. Tax base will become nil. Understood? So it means carrying amount is more than tax base. So this become taxable temporary difference of 15 lakh 20,000 on which 20% rate will be applied and DTL will be created. DTL will be created. For DTL, no condition is there. There is no such condition. Last point. This all point have been also asked in MCQs given by ICI in Board of Studies portal. ठीक है ना? On 1st April 2017, X Limited borrowed 1 crore. The cost of X Limited of arranging the borrowing was 22 lakh. So X Limited borrowed, so transaction cost will be deducted. So it means it is 100 minus 2, 100 lakh minus 2 lakh. So it will become 98 lakh opening balance. Correct. The cost qualified for tax deduction on 1st April 2017. However, this transaction cost is allowed under Income Tax Act as an expense. The loan was for 3 year period. No interest was payable on the loan, but the amount repayable was 1 crore 30 lakh 43,800. This is repayable at premium. This equates to an effective annual rate of 10%. So 10% is ER. So interest expense will be added. So 9 lakh 80,000 will be added, but there is no contractual cash outflow because interest payment is nil. Contractual rate of interest is payable. No interest is payable na. So 98 lakh plus 9 lakh 80,000. This become how much? 107 80,000. This become carrying amount. But under Income Tax Act, can you say the tax base will be 1 crore only? Will be 1 crore. Because it is given that under income tax that the premium amount will be allowed as an expense on the date of redemption. So right now the tax base amount will be 1 crore only. The difference becomes 7 lakh 80,000. Because it is a liability and carrying amount is more than tax, but this becomes deductible temporary difference on which DTA will be recognized. Got this point? पढ़ लो. Okay, sir. Have you understood? Lot of question I have taken for India's 12. I think you are understanding or not? Are you able to follow me? Come to first question 36. This is a question of reconciliation statement. Now what India's 12 says that whenever tax expense as per applicable rate and tax expense as per SOPL are not same, then a reconciliation statement is required to find out a difference. What is the reason of that difference? Correct. A reconciliation statement is required. Now just try to understand. I'll just give one point because normally students are confused about this. You just try to understand. The tax expense as per SOPL is current tax and deferred tax. And tax expense as per applicable rate. This we need to find out. Now the reason, what are the reason? So the temporary difference, normally when I say temporary difference, are of two types. One is known as permanent difference, one is known as timing difference, as we have done in CA Inter. So timing difference and permanent difference. For timing difference, this difference will not arise because that is already already for that deferred tax is created. So because for timing difference we create deferred tax, so that will not be a part of reconciliation. But any tax effect due to permanent disallowance for that difference will arise. Understood? So if any item, yeah, any difference is in the nature of timing difference, for that no difference will arise, because for timing difference we calculate deferred tax. But for permanent difference we do not calculate deferred tax. That may be one of the reason for what? That may be one of the that is the reason for the difference. That is the reason for difference. So one of the reason is what? Permanent difference. Permanent difference what? Expense which are permanently allowed under Income Tax Act. Yeah, income which is permanently exempted under Income Tax Act. Yeah, there is one more difference. Rate of tax difference. The regular tax is 30%, but under Income Tax Act we are applying 20% or 35%. This may be also one of the reasons. These are the few reasons for which difference will arise. Difference will arise. Got this? Now let us do this question. Following the summarized PL they have given, you can see the PL is given, and you can see this is the PBT in which they have given current tax. This is current tax expenses, and this is profit after tax. This is not current tax, this is tax expenses. Tax expenses will be what? Deferred tax and current tax. Chalega. Consider that income tax rate applicable is 30%. Now if I apply 750 into 30%, how much it is coming? 750 into 30%, that is coming 225. And you can, this is a difference, this we need to reconcile. What is the reason that we need to reconcile? Chalega. Other expenses include the following expense which are not deductible for income tax. This is permanent disallowed. So on this we'll apply 30%. We'll calculate 30%. And because this is permanent disallowed, correct now? So it means, are we able to understand? So on this we are paying some tax. On this we are paying some tax. So our tax expense will increase. Our tax expense will increase. Chalega? Yes, sir. Other expense also include expenditure on scientific research amounting to rupees 10 lakh, in respect of which 150% weighted deduction is available. So there is some expense which is permanently allowed 50%. So 50%. So 50%, 10 lakh ka 50%, how much? 5 lakh. 5 lakh ka 30%. On this case we will get some tax benefit. Our tax expense will decrease because this expense will be allowed. Other income include dividend which is permanently exempt and long-term capital gain of 12 lakh which are taxable at 10%. However, our regular tax is 20%, but this is taxable at 10%. This is one of the reasons. This is permanently exempt. Agriculture income is permanently exempt, and profit of 75 lakh earned in USA, which New Age Limited has paid tax at a rate of 20%. Can you say regular tax is 30%? On this also 10% difference will arise. Doing review of the financial statement of New Age Limited, you can see CFO multiply PBT with the income tax, that is coming 225. However, under Income Tax Act, tax expense 211. For this, a reconciliation required. So you can see we have started with tax expense as per applicable tax at 225, and we'll end with tax expense as per SOPL, that is coming 211.65. What is the reason that we need to find out? Reason is given. What is given first? Let us see. Tax effect of the expense that are not deductible in determining taxable profit. You can see penalty, impairment, goodwill, donation. Correct. So this will increase our tax expense into 30%. Then tax effect of the expense that are deductible in determining taxable profit, means which is allowed. Means one is weighted deduction of 50%. So 10 into 50%, 30%. This will decrease our tax expense. Correct. Then exempted to dividend income, agriculture income. These are permanently exempted. Permanently exempted means this will decrease our tax expense. So you can see 30% we have calculated. This will decrease our tax expenses. And the tax effect on the income on which different tax rate will be applied. So there was one long-term capital gain in which 10% was there. So it means we have saved 20%. Correct now. And here 20%, we have saved 10%. So you can see 10% on this and 20% on this. This also will decrease our income tax, and this will always tally with this. This will always tally with this. Understood? Only one point I am asking. Suppose they have given depreciation under Income Tax Act. they have given depreciation under income tax and depreciation as per books is given यहाँ पर. Depreciation as per book has been given यहाँ पर. Suppose, but depreciation is a item of timing difference. Therefore, on that, for that no reconciliation required. For that no reconciliation is required. This is also important question, have been already asked in exam for 6 marks. Can be again be simple question, but once you have done it, now you have confidence. When you have not done it, you may struggle in exam hall. Got this point? Have you understood this particular point? Chalega. Now let us come to one first question. This is also important. I have seen ICA is asking some MCQ question for this first question. Newly added question, but they are asking some MCQ related question for this. S Limited is a manufacturing company wanting to calculate its taxable profit or loss for the year ended 31st March 2008. Means current year is 2007-2008. The statement of PL and OCI and the balance sheet and the notes are given below. Tax rate for the financial is 30%, but the new tax rate is 32% for the year 8 and 9 and beyond has already been enacted before year end. It means, can I say this new tax rate as per the new Finance Act is already enacted. So what our India's 12 say that current tax will be calculated as per 30%. But deferred tax will be calculated based on the rate of any act which is either enacted or substantially enacted at the end of the year. Understood? Now it means deferred tax will be calculated based on 32%. This is a good point. Calculate taxable profit and related current tax expenses. So we'll calculate everything with this. So you can see they have given one balance sheet. They have given, let us read one by one. Depreciation expense for the year for 7-8 allowable as per income tax rule is 72,10,000. Depreciation is allowed for the purpose of financing reporting, including in operating cost, is 59,50,000. Means what is the depreciation as per book 59,50,000? What is as per income tax 72,10,000? So can you say if you want taxable income or if you want current tax, we'll start with PBT 59,50,000. We have started with PBT. We'll add depreciation as per books and we'll deduct depreciation as per income tax act. I think this to no doubt. No doubt you have understood. Chalega. Have you understood this? Yes, sir. Now what they have given? Cost price of PP is 5 crore 60 lakh and H Limited deducted expense of 1 crore 45 lakh 60,000 in his tax return of prior to financial year 7-8. Means under income tax already they have deducted this much. Further, as on 31st March 8, H Limited first time revalued its PP to a market value of 42, it is 4 crore 20 lakh. Revaluation surplus is 30 lakh 80,000. Means you can see PP is coming in the balance sheet 4 crore 20 lakh, that become carrying amount. So carrying amount already we calculated. Carrying amount is how much? For the purpose of deferred tax. So carrying amount is 4 crore 20 lakh. Now we need to find out tax base. Tax base will be how much? Tax base will be what? Cost price how much given? It is given 5 crore 60 lakh. From this, how much in previous year and how much in current year? That you deduct. It means 560 minus 145.6 minus 72.1. It's coming 33 crore 42 lakh 30,000. Check karo. 3 crore 42 lakh 30,000. Got this point? Means I am explaining each and every point. This also you have understood. So PP we have understood. PP any doubt? PP no doubt. Next point. In 2004-2005, H Limited incurred product development cost of 35 lakh. These costs were recognized as an asset and amortized over 10 years. It is which year? 2004-5. Current year is 7-8. Means can 4-5, 5-6, 6-7. and 7,8. Means 4 year amortization has been done. So 3,50,000 into 4. This much has been amortized. So minus 35 lakh. What is the carrying amount? Carrying amount will come 21 lakh, and of course that is given in the balance sheet. Check kalo. 21 lakh is given in the balance sheet. Correct. But can you say what is allowed under income tax? For tax purpose, HCB deducted full product development cost when they were incurred in the previous year. Means can I say in current year nothing is allowed, only what is disallowed? The 3,50,000 has been what has been recognized as an expense in books of account, that will be what disallowed na. Understood? 1 minute. Chalo. So it means you can see 3,50,000 has been disallowed, added back. Nothing will be allowed under income tax because that is already allowed. Now carrying amount is 21 lakh, tax base is 0, tax base is 0. This also you have understood. Yes sir. आगे चलते हैं. Trading investment were acquired in the preceding year at a cost of 80,50,000. These investments are classified as FBTPL and thus recognized in their fair value. Fair value adjustment are not allowable under Income Tax Act. Now it means we need to find out what is the carrying amount of trading investment. You can say 72,80,000. It means the decrease in fair value. So how much decrease करेंगे? Cost price कितना था? 80,50,000. What is the fair value? Fair value is how much? 72,80,000. So what is the fair value loss? 7,70,000. That will be disallowed under Income Tax Act. Understood? And nothing will be allowed. Nothing will be allowed. So 7,70,000 has been disallowed. Check करो. 7,70,000 has been disallowed and nothing will be allowed. Carrying amount and tax base. Carrying amount is given in the balance sheet. Correct? And a tax base will be the cost price only. Understood this point? Any point which you are not able to understand, ask me. I will again explain you. Simple, I am not explaining. Next point. This point number D I will explain at the end. Point number E. As Limited created a provision for inventory obsolescence in accordance with India's 2 requirement. New provision created for current year is 3,78,000. Total provision is 6,30,000. Being a general provision, this provision is not tax deductible. Means new provision whatever has been created, that will be disallowed. 3,78,000 will be disallowed. 3,78,000 will be disallowed. And nothing will be allowed under Income Tax Act. These are understood? Yes sir. Now coming to the carrying amount is already given in the balance sheet. The inventory carrying amount is how much? It is which amount? 1,06,40,000. In 1,06,40,000, can you see you need to add this? If you add back this 6,30,000, the total provision will get a tax base. You will get the tax base. You can add by your own. So you can see carrying amount is how much and tax base after adding 6,30,000. This also you have understood. This also you have understood. आगे चलते हैं. Government grant are not taxable. Full government grant received in 2007-2008 is included in the balance sheet. Means that is treated as deferred income. So deferred income is liability. You can see government grant. How much deferred income? So that become 14 lakh means liability. Understood? So tax base will be nil, 14 lakh, and tax base will be nil. And because it has not been recognized in books of account, so no adjustment is required under taxable. It is non-taxable under Income Tax Act. It has not been transferred to PL, so no adjustment to calculate taxable profit. You can see no adjustment has been done, and this will be carrying amount is how much? You can, because it is liability, it is written as a minus and it is 0. This also you have understood. Yes sir. I will explain this one point for this at the end. At the end I will explain. Yes sir. Coming to the next point. In 2007-2008, H Limited increased the liability for product warranty cost by rupees 1,75,000. Product warranty costs are not tax deductible until the company pays the claim. Claim paid in 2007-2008 amounted to rupees 2,70,000. So this is increase in liability. This is charged to PL account. This will be added back. And what is actually paid in current year? 2,17,000. This will be allowed under income tax. So you can see 1,75,000 will be added back and 2,70,000 will be minus. This you have understood. Carrying amount is given in the balance sheet about product warranty You can see liability for product warranty cost is 5,60,000. Correct. Tax base will be nil because that is allowed under Income Tax Act only when it is paid. So 5,60,000 and 0 will be the tax base. You can see 5,60,000 and 0. This also you have understood. Come to next point. Next point. During the year, H Limited introduced a healthcare benefit for employee. The expense are allowed for tax purpose only when the benefit are paid, but in the line with Ind AS 19, recognized in PL when the employee provides services. Okay, sir. So during the year they have introduced. So can I say, let us see what their medical benefit for employee. This is 24,50,000. 24,50,000 because that has been created in current year. This will be added back. You can see 24,50,000 added back and nothing will be allowed for this particular purpose. And carrying amount is given in the balance sheet and the tax base once again will be nil because it will be allowed only when it is paid. You can see for this is the carrying amount and this is nil. This also you have understood. Correct. This also you have understood. Then penalty toward violation of law included in operating expense amounted to 63,000. These are not deductible for tax purpose. This is permanently disallowed. तो पेनल्टी आउटस्टैंडिंग, देयर इज वन पेनल्टी आउटस्टैंडिंग, चेक करो है क्या. Out is not outstanding, it is already paid. Operating expense, अच्छा, including operating means already paid, so there is no outstanding amount, but can this will be disallowed. 63,000 will be disallowed and nothing will be allowed. Yes sir. And for this there is no carrying amount, there is no tax base. Okay, you can see. चलेगा, आगे चलो. Tax law allow to deduct expense for petrol only up to 1,40,000 per vehicle per year. H Limited had 4 vehicles and the total petrol expense amounted to be 7,21,000. So what is allowed? 1,40,000 into 4 is allowed. So how much is disallowed? Minus कर दो 7,21,000. This allowed is 1,61,000. You can see 1,61,000 is added back. And because this is expense, there is no asset, there is no liability for that. There is nothing for this carrying amount and tax base. This much you understood? Correct. So you can see apart from debtor, I have covered all the points. Debtor I will explain. Now coming to other point, trade payable, no information means carrying amount and tax base will be same. Cash and cash with no information means carrying amount and tax base will be same. Investment in subsidiaries there, no information means carrying amount and tax base will be same. Got this point? Only I need to explain trade receivable now. If I have explained trade receivable, so this particular illustration number 1, which is the comprehensive question, you will be able to understand. Okay, now coming to trade receivable. What they have given, bad debt provision amounted to rupees 45,50,000 and relate to two debtor A 28 lakh, receivable originate in 2005-6, current year is 7-8. 100% provision was recognized in the preceding year and that will be 17,50,000. Receivable originated in 6-7 means last year and 100% provision was recognized in the financial year 7-8. Understood? You can see 28 lakh plus 17,50,000 will be this amount. Means one thing is clear that you can find out the gross debtor by adding this. So gross debtor will be what? Gross debtor is what? Debtor given in the balance sheet is 2 crore 19 lakh 10,000. 2 crore 19 lakh 10,000. इसमें प्लस कर दो प्रोविजन. प्रोविजन इज हाउ मच? 45 lakh 50,000. This is coming how much? 2 crore 64 lakh 60,000. Correct? Understood? Now tax law allow deduction of 20% of provision for the debtor overdue for more than 1 year and 30% of debtor overdue for more than 2 years and remaining 50% debtor overdue for more than 3 years. So as per tax law, deduction allowed on this basis. Got this point? First you need to find out how much provision is created in the books of account. You can see 100% was recognized. 100% provision was recognized in preceding year for debtor A. Understood? And for 17,50,000, 100% provision was recognized in the current year. Means can you say This 17 lakh 50,000, this was the provision creating current year which will be disallowed. So you can say 17 lakh 50,000 will be added back. 17 lakh 50,000 has been added back. This you have understood. To find out taxable income. Now only we need to find out how much is the provision allowed under Income Tax Act. For that, of course, we need to do one working note. You can see for debtor A, it is 28 lakh. 28 lakh. It was originated in 5-6. Correct. So can I say first 6-7 and first 7-8. For 6-7, because this will be due for more than 1 year. So 20% provision is required. And then another 30% provision is required. So total provision required under Income Tax Act will be 14 lakh. Under Income Tax Act will be 14 lakh. Understood this point? Similarly for debtor B, it is 17 lakh 50,000, which originated in last year. So for 7-8, only 20% provision is allowed. So 17 lakh 50,000 into 20%, how much? This 3 lakh 50,000. Means under Income Tax Act, इसमें कर दो 14 lakh add. Under Income Tax Act, provision allowed is 17 lakh for the current year. So for the current year, how much is allowed? It is 3 lakh 50,000, and this is how much? 30%. 28 lakh ka 30%. 8 lakh 40,000. 8 lakh 40,000 plus 3 lakh 50,000 means 11 lakh 90,000 is allowed under income tax. Have you understood this point? Have you understood this point? Understood means out of course data this was allowed, this was provision created last year. We want only 30%. 30% of 28 lakh and 20% of 17 lakh 50,000 is as per current year provision allowed under Income Tax Act. So you can see all the points about taxable income we have understood. We can find out taxable income, apply 30%, this become current tax, this become current tax. Current tax to you have understood. Now coming to the provision, this trade receivable, this is given in the balance sheet carrying amount, only we want this. So just try to understand, already we calculated the gross amount, gross data we calculated. From this, if you deduct this to provision, 14 lakh plus 3 lakh 50,000. So 14 lakh plus 3 lakh 50,000, this is the total provision, minus what this? Minus 2 crore 64 lakh 60,000 is equal to how much? 2 crore 82 lakh 10,000. Check karo. 2 crore something गड़बड़ हो गया, एक मिनट रुको. First, what is the gross debtor? I have not written this. 2 crore 19 lakh 10,000. इसमें से we'll add provision. Provision is what? 45 lakh 50,000. It's coming 2 crore 64 lakh 60,000. Okay. This much is okay. Now what is the provision allowed under Income Tax Act? It's 14 lakh plus 3 lakh 50,000. That is coming 17 lakh 50,000. So 2 crore 64 lakh 60,000 minus 17 lakh 50,000. Coming 22 crore 47 lakh 10,000. Check karo. 2 crore 47 lakh 10,000. Now correct. Now correct. Have you understood this point? I mean, this is very interesting one, and I have seen in one of the MCQ they have given this question. Have you understood this point? Otherwise, I will repeat once again. Only trade receivable, I think, a discussion required. If you have understood trade receivable now, whatever I have explained, then I think I can go further. Bolo. Do you want me to repeat trade receivable? Please repeat. Apart from trade receivable, you have understood Manikanta? Chalo, I will explain by writing. Trade receivable. Batao. What is given? Carrying amount given in the balance sheet. So carrying amount given in the balance sheet is 2 crore 19 lakh 10,000. 2 crore 19 lakh 10,000. And how much provision already we created? If we add back provision, provision is given in the additional information. That is how much? 45 lakh 50,000. This is the provision already created. We'll add back. So 45 lakh 50,000 we have added back. This is the gross debtor. What is the gross debtor before provision? It is 2 crore 19 lakh 10,000 plus 45 lakh 50,000. That is coming 2 crore 64 lakh 6,000. This much you understood? Yes, sir. Correct. Now we need to find out how much provision is allowed under Income Tax Act. So there were two debtor. Debtor A amounted to rupees 28 lakh, which was originated in the year 5-6. Correct. So can you say in the year 6-7 and 7-8 will create provision? In the 6-7 it is outstanding for more than 1 year, so 20% provision. In the 7-8 it is outstanding for more than 2 years, so 30% provision as per Income Tax Act. So 28 lakh cut 20%, how much? It is 5 lakh 60,000. And 28 lakh cut 30%, how much? 8 lakh 40,000. Total become 14 lakh. So there is a debtor B. Debtor B amount is what? Which is doubtful debtor. Debtor B is 17 lakh 50,000. 17 lakh 50,000. Which was originated in 6-7. Means in 7-8 will create provision. It is outstanding for more than 1 year. So 20% provision will be created. The 17 lakh 50,000 ka 20% how much? 3 lakh 50,000. 3 lakh 50,000 will be the total provision under total provision plus करेंगे 14 lakh. So it becomes 17 lakh 50,000 under Income Tax Act. So what is the tax base under Income Tax Act? It becomes 2 crore 64 lakh 60,000 minus 17 lakh 50,000 is equal to 2 crore 47 lakh 10,000. Now have you understood how it has been calculated? Okay. In the current year, can you say this will be allowed under Income Tax Act? 8 lakh 40,000 plus 3 lakh 50,000 will be allowed under Income Tax Act. Understood? And under books of account, what this was already created in previous year, and this is created in current year. So in current year, this will be added back. 17 lakh 50,000 will be added back. This will be charged to profit and loss account, already charged to PL account. So this has been added back. Have you understood? Manikanta understood. Happy? Happy Manikanta? Happy? If you're happy, just give me a smiley sign, Ray. Okay. I think you have understood. Now let us come to the next point. Once you have calculated this, current tax you calculated. Now let us come to this. This you have understood, carrying amount, tax base. Once you have calculated carrying amount and tax base, can you see you can find out temporary difference by applying the rules? Rule is what? For asset carrying amount is more than tax base, taxable, otherwise deductible, reverse for liability. So you can see they have calculated taxable, correct now? Deductible, this you can identify, deductible. Now government grant, one special point. Government grant, because that is permanently exempted under Income Tax Act. Means this is never taxable. Because it is never taxable, it is an item of permanent difference and therefore no deferred tax. So normally what I say in my class, कि whenever there is an item of permanent difference, always take tax base is equal to carrying amount. Suppose you have taken tax base is equal to carrying amount, then no difference will arise. So there are two methods. Either consider tax base is equal to 0 or consider tax base is equal to carrying amount. When you are taking tax base is equal to 0, then some difference will arise, but it is an item of permanent difference, therefore no deferred tax. Therefore no deferred tax. So to eliminate this, what this, I will say this point in exam hall, because there is a high chances you can do mistake here, high chances. So just try to understand any item which is permanently disallowed or permanently allowed or permanently exempted, this, for that no deferred tax. So if you are taking tax basis 0, even though some difference arise, it is excluded from the calculation of deferred tax. Excluded from the calculation of deferred tax. Understood? This point have you understood? Now you can find out deferred tax, but deferred tax will be calculated based on which rate? Rate will be what? 32%, whatever is given. Correct now. On that rate basis, you have calculated deferred tax asset and deferred tax liability will be created and the solution will be done. Done. One last point, one last question, newly introduced question. So this will be also covered. I think this may be also asked. November 2023, this question was asked. On 1st April 2001, entity paying a tax at 30% acquired a non-tax deductible office building for rupees 1 lakh in circumstances in which Ind AS 12 provide recognition of deferred tax liability associated with a temporary difference of rupees 1 lakh. Non-tax deductible. Non-tax deductible means what? Ki for that depreciation will not be allowed. Under Income Tax Act, the building is depreciated over 10 years at 10,000 per year to residual value of 0. The entity's financial year end on 31st March. On 1st April 2002, means at the beginning of next year, the carrying amount of building is 90,000, of course 1 lakh minus 10 to 90,000. It is revalued upward by rupees 45,000 to its current market value of 1,35,000. There is no change to the estimated residual value of 0 or to the useful life of building after revaluation. Determine the carrying amount, depreciation for the year ended 31st March 2003 and the deferred tax thereafter till the useful life of building. Further analyze the treatment and the impact of deferred tax since 31st March 2003 till the useful life of building. Means I'll just explain with the solution only. You can see this is Y0 1 lakh. Means this is beginning of year 1. This is year end 1 90,000. And this is the same date. Same date. Because revaluation has been done. So 45,000 has been added, become 1,25,000. Then again, can I say 1,35,000 divided by 9. So now 15,000 depreciation. So 1,35,000 minus 15,000 they have done. So 1,20,000 minus 15 minus 15 minus 15 minus 15 minus 15 minus 15. You can easily calculate. This becomes the carrying amount. Okay, tax base will be 0 because this is non-deductible. The tax base will be 0. Understood? Gross temporary difference will be 1,90,000. Then from this 1,35,000, 1,25,000. This also you can find out. Now unrecognized, here you need to understand, just try to understand what they want to say. See, whatever revaluation gain was there, that is actually a taxable temporary difference. The cost portion is actually for the cost means 1 lakh, that is for that temporary difference will not recognize any deferred tax because that depreciation is not allowed under Income Tax Act permanently. So you can see unrecognized temporary difference is what? The written down value excluding revaluation amount. So 1 lakh, 90,000, 90,000, then 80, 70, 60, 50, 40. This you eliminate. So recognized temporary difference will be what? 45,000, then 40,000, then 35,000, then 30,000, then 25,000. This is the recognized temporary difference on which DTL will be created. So DTL will be created at a rate of 30%. At the rate of 30%, at the rate of 30%, you can see it has been created and at the end will become 0. Now DTL created, this will be created through OCI. But you can see this is a reversal. Reversal is because of additional depreciation and additional depreciation transfer to PL. Reversal will be through PL. So DTL created 13,500 will be created through OCI, but you can see every year how much is reversed? 13,500 minus 12,000. So 1,500 reverse every year. So reversal will be through PL. Reversal will be through PL. This, I think, very simple question, but once you read, then only you will be able to understand. Means if you will not understand and you will go to example without doing this question, you may be able not will be able to, means you'll be confused in exam all I will say. Have you understood now? So 1 lakh, what is the cost portion? That is actually non-deductible portion. On that we have not recognized any deferred tax. But revaluation gain, because when it will be sold, it will be taxable. It will be taxable. So for that, some taxable temporary difference will arise. Got this point? Yes, sir. Yes, sir. This also done. With this, Ind AS 12 is completed from my point of view. I think I have taken a lot of question and I have given more time to this because a lot of discussion required for this. Now we'll take 45-minute break, 45 minute to 1 hour, because I also thoda sa require rest for lunch break. I will make it 1 hour only. You also take thoda rest, or you can do whatever you want to do. 1 hour break. After 1 hour, we'll meet and we'll do Ind AS. First, I will take Ind AS 108, 105, 40, 16, 38. This will be my target. Target, have you understood? In the next half. If you want to add some Ind AS, you can say. Okay, sir. First, I will complete this 108, 105, 40, 16, 38. चलेगा? अच्छा, Ind AS 1, Ind AS 8. This also I am adding. Okay? Happy? Any more? Chalo. We'll take a lunch break of 1 hour. You also take your lunch. I hope you have understood till now whatever we have done and you are enjoying all the discussion whatever we are doing. Okay, sir. चलिए. Now, yes, everyone. Can we start once again? Everyone ready? Yes, sir. So now we'll take India's 108 operating segment. Very simple, but it has been seen that normally from this chapter, IC asks a question, then there is one question which have been asked three times in exam. And I will say not only three times, four times similar question have been asked. Three times same question, one time similar question have been asked. Got this point? Yes, sir. Let us do this chapter. Question number, we'll start with question number 10. Okay. X Limited has identified four operating segments for which revenue data is given below. Similar question have been asked in exam. You can see they have given external sale, internal sale and total sale. Okay. Now we need to find out reportable segment. Reportable segment, what is the criteria for reportable segment? So Ind AS 108 has given some quantitative threshold criteria, which is actually based on three particular point. One is based on segment revenue, second is based on segment result, and third is based on segment asset. So right now the information of only revenue has been given. So we need to find out reportable segment only based on segment revenue. So what Ind AS 108 says that if any segment, for any segment revenue is 10% or more than the total segment revenue, then it will be reportable segment. Now segment revenue consists of external sale plus inter-segment sale. So you can see they have given external sale as well as internal sale. So this become total segment revenue. We can find out easily the percentage find out karo. It is 30 divided by 100 means 30%. This will be 6.5%, this will be 9.5%, this will be 54%. So from this segment A and segment D are reportable segments. Segment A and segment D are reportable segment. Now what are the other information given? Additional information. Segment C is a new business unit and management expect this segment to make a significant contribution to the external revenue in coming year. Which of the segment would be reportable under the criteria identified under Ind AS 108? So based on segment revenue, can it segment A and segment D are reportable? But there is one more criteria. Whatever reportable segment we have identified as per quantitative threshold criteria, the external sale of reportable segment should constitute at least 75% of total entities revenue. 75% of total entities revenue. So let us identify that criteria also. You can see the total entity revenue will be 50 lakh. Only we need to consider external sale. When I am saying entities revenue, so that will be excluding inter segment sale. So it will be 50 lakh. Now what is the reportable segment? Segment A and segment D, it become 35. 30 plus, it become 30 plus 5 means 35. Correct now? So 35 divide by 50, how much percentage? 35 divide by 50, it is coming 70%. It is 70%, but it should constitute at least 75%. It means, can I say more segments should be identified as reportable segment. So normally that identification will be done by management, but as per the information given the question, it is given that segment C may add more revenue in the coming year. So this is an indication that you can add segment C as an additional segment, and after adding segment C as reportable segment, if the total external sale which are reportable, if that constitutes 75% of entities revenue, then it will be also reportable segment. So if you add segment C, it will become it means we'll add 8 lakh 50,000 to the reportable external sale. So it will become how much? 35 plus 8.5 means 43.5 divided by 50, it will be around 87%. Therefore, segment C can be identified as additional reportable segment, and therefore A, C and D will become reportable segment. Got this point? However, in this question it is first they have given A and D are reportable segment, then they have added segment C and they have said that yes, it can be added as reportable segment, but alternatively they have also said that instead of segment C, segment B can be also added as segment B can be also identified as additional reportable segment, because by adding segment B also, that 75% criteria is also satisfied. So either the answer will be A, C and D, or it can be A, B and D also. Got this point? Yes sir. Coming to the next question. This question have been asked how many times? You can see it has been asked one time, two times, three times. Three times this question have been asked. Once again it can be again asked in exam, because you can see first it was asked in May 2018, then July 21, then May 2023. So again it can be asked. That very simple, but I don't know why they are asking this type of question so many times. X Limited is an operating in coating industry. Its business segment comprise of coating and other consisting of chemical, polymers and related activities. Certain information for the financial year is given. You can see for coating and other, they have given revenue, external revenue including GST. But can I say we should report revenue excluding GST? So we'll do minus GST, so that the revenue excluding GST should be reported, because revenue should be always excluding GST. Other operating income should be also added to find out segment revenue. Result is given, asset is given, liability is given, segment wise information has been given. So in this question you need to prepare one segment report for disclosure purpose. So for any reportable segment we should disclose segment revenue, then segment result, then segment asset, then segment liability. And also we need to prepare one reconciliation statement so that items can match with the information given in the financial statement. The reconciliation is also required. Other three important disclosure are that segment capital expenditure should be also disclosed, depreciation and amortization expense segment wise need to be disclosed, and other non-cash expenses if any given the question that need to be also disclosed. Apart from that, we need to also disclose some information regarding geographical location if that is given in the question. So for geographical information we should disclose external sale, then segment asset, and then segment capital expenditure. These are the information need to be disclosed. Understood? So you can see additional information given, what unallocated revenue net of expenses. This is required for reconciliation purpose. Any information which is not given segment wise, that is required for reconciliation purpose. Understood? Any information which is not given segment wise, that is required for reconciliation purpose. Interest and bank charges reconciliation item, income tax expense reconciliation item, investment and unallocated asset reconciliation item, unallocated liability, reserve and surplus, share capital are reconciliation item, depreciation for coating and other, this is given what? Segment wise, so this is disclosure required. Segment wise disclosure required. Capital expenditure for coating and other, they have given segment wise disclosure required. Revenue from outside India means geographical location, so this is the information required for geographical information, correct? And segment asset outside India they have given. Based on above information, how X should disclose the information about reportable segment revenue, profit or loss, assets and liability for the financial year 2001-2002. So first we should disclose information about operating segment. Okay, there are two operating segment, one is coating and another is other. So just write down the company's operating segment comprise of coating and other consisting of chemical, polymers and related activities. This information has not been given the question. So if not given the question, you are not supposed to write down. I don't know from where the ICA has given this particular point, correct? Then we should disclose segment revenue, results and other information in one format. First we should write down external revenue, or you can write down revenue, because in this question they have not given inter-segment revenue, therefore they have written only external sale. But we should disclose segment revenue which should consist of inter-segment sales also. Got this point? So first we write down revenue given in the question, segment revenue, minus GST, So this become external revenue net amount, and other operating income is also given. Other operating income should be also added. Suppose they have given inter-segment revenue, so inter-segment revenue will be added. That will become segment revenue, and from that you deduct inter-segment revenue, so that it will, the total will match. Means this total after deduction of what inter-segment revenue should match with the revenue given in SOPL. Understood is fine. For this particular question, they have not given inter-segment revenue, but in your exam question, they may give inter-segment revenue also. Then write down results. Segment result is given the question. Then you need to reconcile with the profit and loss of profit or loss calculated in SOPL. Got this fine. So any unallocated income net of expense will be added. Correct. Unallocated income net of expense will be added. Then interest and bank charge will be deducted. Interest and bank charge will be deducted. This will become profit before exceptional item. There is no exceptional item given. This will become profit before tax, and then deduct current tax and deferred tax given in the question. This will become profit as per SOPL. Profit for the year as per SOPL. This will match. Reconciliation done. Reconciliation done means whatever information given in the question, that you just put down in this particular format. Then they have given segment assets. They have given segment asset. Segment wise, this become total segment asset. In this will add investment and unallocated asset. Become total asset as per balance sheet. Total asset as per balance sheet. Then we'll disclose liability. Liability, they have given segment liability. This become total segment liability. In this will add unallocated liability. Unallocated liability. Then share capital and reserve and surplus. So this become total shareholders fund as per balance sheet, which will match with the total asset in the balance sheet. Got this point? Suppose in the question reserve and surplus is not given, then reserve and surplus or other equity will be taken as a balancing figure. Got this point? Yes, sir. Then other information which is required to disclose, one is capital expenditure and depreciation. They have not given any information about other non-cash expenses. That is given, that need to be also disclosed. This information is also given segment wise, but for this no reconciliation is required. Then we should disclose some information about geographical information, that is how much in India, how much outside India total. For that, three information is required to disclose. First is external sale, then is segment asset, and third is segment capital expenditure. You can see external sale total has been, total we can take from this 3,70,000. Outside India is given the question. Outside India, how much given? It is 3, it is what? 30 in lakhs we are doing. So 30,000 in lakhs. 30,000 in lakhs. So you can see we have written 30,000 in lakhs. The difference will be in India. The difference will be in India, means this has been taken as a balancing figure. Similarly, segment asset total we can find out from balance sheet, and from the total we can find out from this information. Total asset, correct now. So total asset, how much segment asset is given outside India? Outside India they have given how much? 10,000 segment asset. Outside India is given 10,000, and you can see segment asset in India can be taken as a balancing figure. Then total capital expenditure can be taken from above calculation, that is 7,000. You can see we have already calculated segment capital expenditure. Total is 7,000 only, 7,000. So 7,000. How much outside India? Nothing has been given. So in India will be balancing figure. Understood? However, these notes are not required. But if you can write down this note, write down the operating segment have been identified in line with IND AS 108, taking into account the nature of product, organizational structure. This is not required. Means I don't think so this note is required from examination solution point of view. But if you can write down this note also. Chalega? Yes, sir. This question done. This question number 12 is important because I have seen in recent RTP they have given this type of question. An entity uses the weighted average cost formula to assign cost of inventory and cost of goods sold for financial reporting purpose. Means for preparation of financial statement, for inventory they are using which cost formula? Weighted average. But a report provided to chief operating decision maker use first in first out method for evaluating the performance of segment operation. But for segment reporting they are using first in first out method. Which cost formula should be used for IND AS 108 disclosure purpose? So for IND AS 108 we'll use the formula whatever has been used by chief operating decision maker. It means only FIFO basis. There is no need to apply weighted average basis. But can I say if you apply FIFO basis, then whatever information you are disclosing that will not match with the information given in the balance sheet, for that a reconciliation is required. For that a reconciliation is required. Got this point? Yes, sir. Come to question 13. ABC Limited has 5 operating segments, namely A, B, C, D. The profit and loss means now they have given only segment result. So one second, segment result, any means any segment become reportable segment if segment result is 10% more of 10% more of total prof of 10% of more of combined result in terms of profit, or combined result in terms of loss, whichever is greater in absolute terms, whichever is greater in absolute terms. So whenever they have given segment profit or loss, first find the total of profit, total of segment profit. What is the total of segment profit? Can you give me? 780 plus 1500 plus 6000. This become 8280, and total of segment loss is how much? 2300 plus 4500. It is 6800. Both you need to take in absolute figure, means ignoring negative side. So you can see the combined result in terms of profit is more than combined result in terms of loss. Therefore, this will become your benchmark 8280. Now you need to find out segment result in relation to the combined result in terms of profit. Combined result in terms of profit means 780 divided by this, 1500 divided by this, 2300 divided by this, 4500 divided by this, 6000 divided by this. And if any segment result is 10%, more than 10% of combined result in terms of profit, then that segment will become reportable segment. Got this point? That is only given. Check karo the percentage as absolute percentage of 8280 crore. This is 9%, 18%, 28%, 50 or 54%, 72%. So this become reportable segment, and this is not a reportable segment. Therefore, B, C, D, E are reportable segment. Understood? Yes, sir. One more question. XYZ Limited has 8 segments, namely A, B, C, D, E, F, G, H. The information regarding respective segment for the year ended is given. You can see they have given external sale, inter-segment sale, then they have given segment result, profit or loss, segment assets. Identify which of the above segment out of A to H would be considered as reportable segment. Okay, so we need to find out. First, we need to apply criteria 1. Segment revenue is 10% or more of total external plus inter-segment sale. Correct? You can write down, first write down total sales. Total sales means including external as well as internal sale. Total sales, that is given in the question. Then write down percentage to total sale. Percentage you can find out. Percentage you can find out. So you can say percentage has been calculated, and only A and B are 10% more than the are actually having 10% or more than 10% of total segment revenue. Therefore, A and B are reportable segment. Whenever this type of questions come, always prepare the statement in this way only. This will be comfortable to understand also and comfortable to present also. Got this point? Then criteria 2 is 10% more of segment result. So first, consider segment profit or loss separately in absolute terms. So first we need to calculate profit or loss separately in absolute terms. So you can see profit they have written separately, loss they have written separately, and you can see the segment loss is more than the segment combined profit. Therefore, this will become benchmark. Now we need to find out segment. Now we need to find out. Now we need to find out segment result. Segment result in relation to the total segment loss. Total segment loss. So since segment loss is greater, we select 100 as evaluating the segment percentage. Understood? The percentage to segment loss. Percentage segment loss. You can see 5 by 100 is 5%, 90 by 100 is 90%, 15 by 100 is 15%, and as such, so you can see this 90% and 50% will meet the criteria, and they have a B and C are also reportable segment as per criteria number 2. As per criteria number 2. Got this point? If any one criteria is satisfied, it will become reportable segment. So based on segment revenue, A and B are reportable. Based on segment result, B and C are reportable. Now we'll come to segment asset. So once again, total asset has been given. Find out percentage to total asset. You can see based on this, A, B and D are reportable. So can you say A, B, C, D are reportable based on quantitative threshold limit. Now once A, B, C, D are reportable, even though question is silent, we need to also apply 75% criteria, 75% revenue criteria. So however, you can see based on above, the reportable segment become A, B, C, D. However, 75% test for external sales should be also checked. So you can see A, B, C, D, First, we'll identify the external sale of ABCD. So we have mentioned external sale of ABCD as per the information given the question. Don't include internal segment sale. Only take external sale. So this become 280. So what is the total external sale given in the question? So total external sale given in the question, if you see that sum total of this only, this will come 405. Sum total of this, which is coming 405. So this is coming 69.14%, but the required percent is 75%. Therefore this criteria is not satisfied. Therefore we need to add additional segment as reportable segment such that the total external sales reportable should be at least 75% of entity's revenue. So in the solution they have not given any information about additional segment. Therefore what they have mentioned, hence in the above scenario, additional operating segment need to be identified as reportable segment till the 75% test is satisfied, even if those segments do not satisfy the quantitative threshold limit. Got this point? Yes, sir. Best way. This type of question can be asked for 5 marks, 6 marks, or whatever. 15 also you have understood. Now come to the last question of this particular chapter. This was asked in one of the exam. Hamon Limited has 3 segment HMD. The following information is provided for the year ended 31st March 2003. We can see sales to M. This is inter-segment sale. Sales to D, inter-segment sale. Other sale, domestic sale they have given. Then external sale they have given. Then operating profit or loss before tax has been given. Reallocated cost from head office is given. Interest cost has been given. Fixed asset has been given. And head office fixed asset is also given. Net current asset has been given. Head office net current asset has been given. Long term liability has been given segment wise, and head office also given. Other information, share capital and reserve and surplus given. Prepared segment information as per Ind AS 108. Information about operating segment. First write down the company's operating segment comprise of HMD. Then segment revenue result and other information. Prepare one segment segment report, a segment information report. So you can see reportable segment HMD. Then write down unallocated item, or you can add unallocated item below the line also, correct now, or you can write down in this way also. Then write down total for reconciliation purpose. You can see segment revenue. First they have written domestic sale, then export sale. So this become total external sale. However, there is no write down domestic and export separated. You can write down directly external sale. Then in this you will add inter-segment sale. Inter-segment sale has been added. This become total sales. Total sales. Correct. From this you will deduct inter-segment sale. So this will match with the entity's revenue. This will match with what? Entity's revenue. So once you deduct inter-segment sale, this will match with what? Your entity's revenue. Understood? Reconciliation also done. Then segment result. Segment result is given in the question only. Then we'll do reallocated cost. Reallocated head office cost has been given 4, 2 and 2. So if you have done deducted 4, 2 and 2 deducted. Understood? Then some interest expense has been given, that is also deducted. This become profit before tax and exceptional item, because they have not given any exceptional item, they have not given tax, so that reconciliation is not possible. Correct now. So this become profit before tax and exceptional item, or you can ignore tax and exceptional item. Chalega. Then information related to total asset liability. So you can see they have given segment non-current asset they have given. Then segment net current asset they have given. Correct now. And we have also added unallocated item. So this has been done for reconciliation purpose. So what you can do, first you add these two and then add unallocated asset. You can do in that way also. Chalega. So this become total asset, total asset. Similarly, non-current liability has been given. Segment wise has been given. Unallocated wise also given. This become total non-current liability. Understood? Very simple. Means whatever has been given, just write down from the information given the question in a presentable way in a format. Chalega. Then geographical information, even though question is silent, this is required to be done. So geographical information they have given only one external sale. So external sale they have given export sale as well as domestic sale. So this become external sale. Only in this we will disclose external sale without disclosing inter-segment sale. Correct? Now this become 900. Chalega. Any doubt? Have you understood this? So with this we completed Ind AS 108. Okay, sir? India S108 done. Do you have any more question of India S108 which you want me to explain? As per India S108 is concerned, India S108 is done. Now we'll take which Indias? Let us take India S105. Okay, sir. Take take 5 minute break. Just identify if there is any question or not about India S108 which you want me to discuss. Correct. Then we can start India S105. Got this point? I'll come in 2-3 minutes. Okay. Now, can we start India S105? India S105 is for what? Non-current asset held for sale and discontinued operation. This is also very simple India S105. Whenever any non-current asset or disposal group is classified as held for sale, then it is remeasured at fair value less cost to sale. Means measurement will be done at carrying amount or fair value less cost of sale, whichever is lower. And any loss means if fair value less cost to sale is less than carrying amount, then any loss will be considered as impairment loss as per Ind AS 105, which will be charged to profit and loss account, which will be transferred to profit and loss account. Be careful about one point, that as per Ind AS 36, just try to understand. As per Ind AS 36, any impairment loss can be adjusted with revaluation surplus if any. But any impairment loss as per Ind AS 105 cannot be adjusted with revaluation surplus, even though there are some revaluation surplus for that non-current asset. Got this point? Understood? So this is the major difference between Ind AS 36 impairment loss and Ind AS 105 impairment loss. Once any non-current asset is classified as held for sale, then depreciation or amortization of that particular asset will be ceased. Correct? Means subsequent depreciation and amortization will be not permitted. Yes, sir. Yes, sir. This some I have just given some point of view to understand. We have to start this chapter. Now, when a non-current asset disposal group will be classified as held for sale when two conditions are satisfied. First, it must be available for immediate sale. It must be available for immediate sale in its current condition. Second, the sale must be highly probable. Sale must be highly probable. If these two conditions are satisfied, then non-current asset or disposal group will be classified as held for sale. Why? Because in that case, the carrying amount will be recovered principally through sale transaction, not through use. Got this point? Yes, sir. Let us come to question. First, come to question number 5. Now, this question was already asked in last exam. Already, this question was asked in last exam, but then also once again, let us do it. Now, this question is related with changes in plan. Suppose initially it was classified as held for sale, then now after 1 year, yeah, after 1.5 year, it is no longer classified as held for sale because the condition is now no more satisfied. In that case, what Ind AS 105 says that it will be remeasured, at lower of point number one, carrying amount, as if such asset was never classified as held for sale. Second, recoverable amount, whichever is lower. Correct? So you need to identify the carrying amount as if it was never classified as held for sale. Then compare with recoverable amount. Lower amount will be the amount at which it will be again remeasured on the date when it is no longer classified as held for sale. Got this point? S Limited purchased a property for rupees 6 lakh on 1st April 2001. The useful life of the property is 15 years. On 31st March 2003, S Limited classified the property as held for sale. The impairment testing provide an estimated recoverable amount of rupees 4,70,000. So it is, you can see they have given recoverable amount. The recoverable amount means Ind AS 36. Can I say for this chapter first we want carrying amount, and carrying amount will be as per respective Ind AS. So if you want to calculate carrying amount, that should be after applying Ind AS 36. So first do impairment testing as per Ind AS 36, then apply Ind AS 105. The fair value less cost to sell on the same date is given 4,60,000. So one thing is clear that 4,70,000 may be value in use which is higher than what? Fair value less cost of disposal. Therefore recoverable amount is what? 4,70,000. Yes sir. On 31st March 2004, the management changes the plan as the properties no longer meet the criteria of held for sale. The recoverable amount as on 31st March 2004 is 5 lakh. Value the property at the end of 2003 and at the end of 2004. First we'll do at the end of 2003. So what is the carrying amount? Initial cost given 6 lakh. Correct. Now on 31st, it was purchased on 1st April 2001. It was classified as held for sale on 31st March 2003, means 2 year depreciation will be charged. So 6 lakh, we'll do 6 lakh, total life is 15, divide 15 into 2. So it become 80,000 depreciation, correct? So this become what? 5 lakh 20,000, 5 lakh 20,000. Now we'll apply impairment testing. Recoverable amount is 4 lakh 70 and the carrying amount is 5 lakh 20. So what is the impairment loss? तो minus कर दो इसमें से 5 lakh 20 minus 4 lakh 70. How much it is coming? 50,000. The 50,000 will become impairment loss as per Ind AS 36, and this will be the carrying amount. On the date it is classified as held for sale. Carrying amount on the date it is classified as held for sale. Okay, now this will be compared with the fair value less cost of disposal. You can see fair value less cost of disposal is 4,60,000 given. So we'll take lower one, and lower one is this, and therefore 10,000 will be again recognized as impairment loss, which will be charged to profit and loss account immediately. Correct? It means, can I say depreciation of 40,000 will be charged to profit and loss account in that year, and impairment loss 50,000, 10,000 charged to profit and loss account in that particular year. Chalega? Yes sir. First part is very easy. Second part means on 31st March 2004, when it is no longer classified as held for sale, we'll do remeasurement. Now here doubt what came when these questions came in exam, most of the students have done reversal of impairment loss. Just try to understand right now, this is a question of changes in plan. Right now we are into Ind AS 105. Why you are applying Ind AS 36? Once we enter into Ind AS 105, now we will not apply Ind AS 36. Understood now? So you have enter into Ind AS 105. Got this point? So now you need to apply changes in plan wala condition. How? Once it is reclassified from PP classified as held for sale to PP, then again you are applying Ind AS 36. Then apply what? Ind AS 36 requirement. So right now we are doing changes in plan. So in this case, you are not supposed to think about reversal of impairment loss as per Ind AS 36. Right now what we'll do, we'll compute two amount. First, carrying amount as if the asset was never classified as held for sale. So can you say it was the carrying amount before it was classified as held for sale? 1 year depreciation will be charged on this. So 4,70,000. Remaining useful life will become how much? 15 minus 2 divided by 13. So that become what? Depreciation become 36,153. So 36,154. So this is the carrying amount as if the asset was no longer classified as held for sale. Compare with the recoverable amount. recoverable amount. We'll take the lower one. Lower one is what? 4,33,846. Correct. Now it means this become the revised carrying amount on this date. So what is the original carrying amount? Original carrying amount was 4,06,000. Now the revised carrying amount become 4,33,846. So how much decrease in the asset? How much decrease in the carrying amount? The decrease property will valued at this amount, and decrease adjustment to the carrying amount will this minus this. This will be again charged to profit and loss account. Got this point? Good question. I will say good question. Already asked in last attempt. Probability is less, but once again I have discussed it. Okay, sir. Question number 8 in this particular chapter. This is the question which is the most important question. I think it has been asked uh, 2 times or 3 times. So pakka it has been asked. Similar type of question have been asked. Chalega? Yes, sir. Following is the extract of the consolidated financial statement of A Limited on which date 31st March 2001. They have given this information. On 15 September 2001, NTDA decided to sell the business. It noted that business meet the condition of disposal group classified as held for sale on the date in accordance with Ind AS 105. Means on 15 September 2001, it is classified as held for sale. So this information is not relevant. We want carrying amount as on 15 September 2001, and you can see in the next para they have given carrying amount as on 15 September 2001. This information relevant. So this information was not relevant only. Now student will be confused ki why they have given this information. Chalega? However, it does not meet the condition to be classified as discontinued operation in accordance with this standard. This para is not relevant for measurement purpose. The disposal group is stated. They have given on the date what is the carrying amount. Total carrying amount is 2160. Entity proposed to sell the disposal group at 19 lakh. So 19 lakh become fair value. It estimated the cost to sale will be 70,000. So 19 lakh 19 lakh minus 70,000, it become 1830. So 1830 become fair value less cost of disposal. What is the total carrying amount? 2160 minus kar do 2160. What is the total impairment loss? 330. Now what Ind AS 105 says that whenever you calculate impairment loss for a disposal group, that will first allocate a goodwill. So first you allocate to the goodwill to the extent of their carrying amount is entirely to entire goodwill will be impaired. The balance become 130. This balance impairment loss will be allocated to other non-current asset of the disposal group to which Ind AS 105 is applicable. Correct? So can you let us find out. Can you see Ind AS 105 will be applicable to intangible asset, but is not applicable to financial asset measured at FBT, PL or FBT OCI. Correct? It is also applicable to PP, but it is not applicable to the balance assets and liability. Means can I say this 130 will be allocated to intangible asset and PP. In this ratio you can easily allocate. Let us allocate to 130 into 930 divide by how much? 930 and 1020 become 059 1950 divide by 1950. How much coming? 62. So 62 will be allocated to intangible asset and balance will be allocated to PP. So 68 will be allocated to PP. This allocation done. Correct? Allocation done. The first part has been done. Now they have given as on 31st March 2002, means next year. 30 means next reporting date. There has been no change to the plan to sell the disposal group, and NTDA still expect to sell it within 1 year of initial classification. Mr. X, an accountant of entity, remeasure the following asset liability in accordance with respective standard. So can you say other assets and liability will be remeasured as per respective standard that has been given. The disposal group has not been trading well and its fair value less cost to sell has now become 16,50,000 required. What will be the value of assets and liability within the disposal group as on the following date on 15 September on 31st March. 15 September already we have done. You can see this already we have done. Revised carrying amount can be calculated. Now we'll do on 31st March 2002. So can you see in this already means they have done in some other way. What I will suggest you start from this. Means there is no need to present in this way. Can you say goodwill has become nil? Intangible asset already we calculated 868 and now further no amortization. So it will be 868. Financial asset new amount has been given. Financial asset how much given? 410. So financial asset item 410. PP it will become 952, no depreciation. Deferred tax asset will be how much? New amount 230. current asset will be new amount, that is 400. Current liability will be negative, how much? 900, new amount. And non-current liability, it will be 250, new amount. This you find out a total find out 868 plus 410 plus 952 plus 230 plus 400 minus 900 minus 250. It is coming 1710. So 1710 is coming 1710. Got this point? Now what is the fair value less cost to sell? It is given the question 1650. So 1650. So what is the further impairment loss? 1650 further impairment loss 60, and this 60 will be now allocated to once again the PP and intangible asset in the same ratio of carrying amount. Means it will be allocated in this ratio. It can be allocated easily. Then we can find out revised carrying amount. We can find out a revised carrying amount. From my point of view, this is not supposed to be worked out. I don't understand why they have worked out this. This was not required. Because whatever measurement you are doing as per respective Indias, that should not be calculated for this particular chapter. Understood? Have you understood this point? This is not a part of this question. I think this is misprinting. चलेगा? Okay, sir. Then come to this question, question 11. This is also an interesting question. Good question. This question I have taken from analysis of financial statement. Analysis of financial statement means there are some questions given in that chapter which is actually can be done as per respective Indias. In that chapter, what they will do, they will give one case study with some wrong treatment. Whenever the question will start with analyze. So just remember, this question will be of 8 to 10 marks. Can be of 6 marks also. Correct now. But normally this question is of 8 to 10 marks. So whenever they say analyze, what you should write down? You should write down सबसे पहले respective Indias. Whatever Indias we are dealing, respective Indias with the title. Then write down the definition and recognition criteria. Then write down initial measurement, subsequent measurement principle. Then a wrong treatment done given the question. Then what will be the correct treatment as per respective Indias. Then give the extract of financial statement, supported by working note. This much is required. So whenever the question asks about analyze, so first write down the respective Indias, then write down definition and recognition criteria, then write down initial and subsequent measurement principle, then write down wrong treatment given the question, then what will be the correct treatment as per respective Indias, then extract of financial statement with supporting working note. If suppose working note is required, that working note also you give. This much is required. Now let us read the question. The accountant of PB Limited decided to treat the plant as held for sale until the demand picks up and accordingly measure the plant at lower of carrying amount and fair value less cost to sell. This is not correct. Because can I say, if the plant can be again used when the demand picks up, it means it is actually taken out temporary from use. So this is not classified as held for sale. It can be classified as held for sale only when the two condition is satisfied given under Ind AS 105. So this is not correct. The accountant has also stopped charging depreciation for the rest of the period considering the plant as held for sale. This is also not correct. The fair value less cost to sell on 30th September 2017. 30th September 2017 is the date when it is classified as held for sale, and 31st March 2018, this is the reporting date. They have given 13.5 and 12 lakh respectively. You can see the carrying amount on initial classification as held for sale. What they have given 24 lakh is the purchase price, and they have charged depreciation for 2.5 years. Means for current year 6-month depreciation has been charged. That is not correct. We should charge full year depreciation because this is not classified as held for sale. This we need to correct. Then this become the carrying amount, and then they compare with the fair value less cost to sell on reporting date, and this become the lower one. So this disclosed in the balance sheet as asset classified as held for sale. This is also not correct. Understood? Analyze. So you can see what they have written. First, they have written as per Ind AS 105, non-current asset held for sale and discontinued operation. Entities shall classify non-current asset as held for sale if the carrying amount will be recovered principally through a sale transaction. For the asset to be classified as held for sale, there are two conditions. It must be available for immediate sale in its current condition, correct? And the sale must be highly probable. You can add on this much. This para, if you want to ignore, ignore. Means it is the sale is highly probable when further 5 conditions are satisfied. If you want to write down. Correct. So understood. Then they said further Ind AS 105 state that once the entity shall not classify as held for sale a non-current asset, that is abandoned, means abandoned asset, yeah, any asset to be abandoned are not classified as held for sale. So these assets are not abandoned also, correct now. So this asset has been taken temporarily out of use. So any asset which is taken temporarily out of use are not abandoned asset, correct? Entity shall not account for non-current asset that has been temporarily taken out of use as if it has been abandoned. So it is not an abandoned asset also. Then they have written Ind AS 16. Ind AS 16 said that depreciation should cease only when it is classified as held for sale or when it is de-recognized, whichever is earlier. But in this situation, because it is not classified as held for sale, depreciation should not cease. Then add on accountant of PB Limited has treated the what wrong treatment they have done, that you write down. Then correct treatment required, that you can write down. Then add on the correct working note. 24 lakh, you can see 3-year depreciation. This became carrying amount. Can you see this is an indicator because they have given fair value which is significantly lower than the carrying amount. This become an indication of impairment. So by your own you can apply impairment testing, but as per Ind AS 36, so you can see 12 lakh. This become impairment loss. And if it is not classified as held for sale, it will be shown under PP only. That is 12 lakh. This become extract of financial statement. Then working note has been given for that impairment loss testing. Understood? Good question can be asked in exam. Have you understood? Bolo. Have you understood this point? One more question. Question 16. Company X has identified one of its division. This is a newly asked question in November 2023. Good question. Only one point I need to explain. If I will not explain that point, you may do mistake in exam. Company X has identified one of its division to be sold to the prospective buyer, and the board has approved the plan to sell the division on 38 September 2001. So 38 September 2001. The sale is expected to complete after 1 year, but it still qualified to be held for sale under Appendix B to Ind AS 105. Okay. Cost to sale, the division is estimated to be 10 crore to be incurred in March 2003. So cost to sale will be incurred in March 2003. 31st March 2003. Right now we are on 38 September 2001. The fair value of division is 400 crore on 38 September 2001 and 31st March 2002, and the carrying value is 500. Well, the fair value remains same. Fair value remain same. How shall such a division disposal group be measured under Ind AS 105 on 38 September 2001 and 31st March 2002? You can see the fair value has been given 400, but cost to sale has been given as on which date? On 31st March 2003. But this is 2002. Means here it is 1 year gap. Here it is 1.5 year gap. And then they have given considered discounting factor at a rate of 10% for 1 year and for 1.5 year. Means in this case it will be 10 crore multiplied by 0.867, and here 10 crore multiplied by 0.909. We can easily calculate cost to sale, and then we can find out fair value minus less means less cost to sale. What the presentation they have given, let's see. You can see this become fair value less cost to sale on 38 September 2001, and this become fair value less cost to sale on 31st March 2001. Understood? Correct? Now just try to understand. Initially carrying amount was how much? 500. So initially carrying amount means on 38 September 2001 carrying amount was 500. fair value less cost to sale was 391.33. This you have understood now. So the difference is how much? 500 minus 391.33. It is coming 108.67, and this will be transferred to PL account. This will be transferred to PL account. No doubt about this. Yes or no? Correct. Now on 31st March 2001, now the carrying amount is how much? It is 391.33, and fair value less cost of disposal is 390.91. Correct now. Got this point? Are you able to understand? Now, whether this is also impairment loss. So what India says that this is not impairment loss. The changes is not due to changes in fair value. Means can I say that changes happen because of the effect of time value of money? Because of the effect of time value of money. So this difference coming how much? Check karo. 391.33 minus 390.91 is equal to 0.42 crore. So this 0.42 will be recognized as borrowing cost and transferred to profit and loss account. That is only given. The increasing cost to sale, the division by 0.42 crore will be recognized in PL as a financing cost in accordance with para 17 of India's 105. This is a very interesting point, which is for the first time they have asked in any question of ICA study, ICA resource. Correct. Simple question, but this type of question will be asked in exam directly now. So will be confused what to write, what not to write. Got this point? Have you understood? Follow. Have you understood this point? Everyone. So India's 105 is also completed from my point of view. India's 105 is also completed from my point of view. Now which India's will do? India's 105 understood? Do you have any more question which you want me to do? You want me to take first India's 20? Okay, chalo, we'll take India's 20, but we'll take a 5-minute break. After that, we'll do. Okay? Yes, sir. Now, everyone, can we take Ind AS 20? Yes, sir. So in days 20, I have limited question only. I have taken that question which require thoda sa attention. Got this point? So let us come to question number 10. A Limited has received a grant of A Limited has received a grant of how much? 10 crore for the year 2001-2002 from a local government in the form of subsidy for selling goods at a lower price to lower income group population in a particular area for 2 years. A Limited had accounted for the grant as income in the year 2001-2002. It has been recognized as an income. While accounting for the grant in the year 2001-2002, A Limited was reasonably assured that all the conditions attached to the grant will be complied with. However, in the year 2005-2006, it was found that A Limited has not complied with the above condition and therefore notice of refund for the grant has been served to it. A Limited has contested but lost in the year 2005-2006 and now the grant was fully repayable. How should the A Limited reflect the repayable grant in the financial statement ending 2005-2006? So as per Ind AS 20, whenever there is a grant which is related to income, correct now, means any grant which is related to income, if it become repayable, first it will be adjusted with unamortized deferred grant and balance will be adjusted with what? Profit and loss account. Means in this case, because the entire grant has been transferred to what? Profit and loss account. Entire grant has been transferred to profit and loss account, correct now. So first journal entry what for repayment, the repayment you can say repayment of means the journal entry what you can say uh, repayment of grant to grant payable and then grant payable to bank. You can say the repayment of government grant which is an expense transferred to PL to grant payable and then grant payable account debit to bank. Only this is the journal entry. Simple. Because in this question, the entire grant has been transferred to profit and loss account. Entire grant has been transferred to profit and loss account initially. So there is no unamortized deferred income. Suppose out of 10 lakh, 6 lakh has been transferred to PL and 4 lakh is unamortized. Then what journal entry we would have done? The repayment grant to grant payable means out of this first it will be adjusted with what? Unamortized grant to the extent of 4 lakh and balance will be transferred to PL. 6 lakh will be transferred to PL in that case. Got this point? Yes sir. I think simple. This is very simple question. Yes sir. Coming to तो यहाँ पे लिखा है assuming that there is no deferred credit balance exists in the year 2005-2006 therefore repayment has been recognized in PL because the question was not clear about that. It may be also noted as standard also provide that circumstances giving rise to repayment grant related to asset may require consideration to be given to the possible impairment. This is not required. Question number 12. A Limited received from the government a loan of 1 crore at a rate of 5% payable after 5 years in a bulleted payment. The prevailing market rate of interest 12% interest payable regularly at the end of each year. Calculate the amount of government grant and pass necessary journal entry. Also examine how the government grant to be recognized. Also state a grant will be recognized in the statement of PL assuming that loan is to finance a depreciable asset. So this is a concessional loan received from the government. So what Ind AS 20 says that first we need to find out the fair value loan as per Ind AS 29. So fair value loan as per Ind AS 29 we need to calculate it. So we need to find out contractual cash outflow. So 5% is the contractual rate of interest. Means can you say 5 lakh is the contractual interest payment which is payable for how many years? 5 years. We need to find out the present value of 5 lakh discounted by using market rate of interest that is 12%. So can you give me First, annuity factor. Annuity factor will be what? 1 point at a rate of 12%. 1.12 divide equal to. So this is 0.892. Yeah, 893 kar do. Then 0.797. Then 0.712. Then 0.636. And then 0.567. What is the total? 893 is 0.893, 0.797, 0.712, 0.636, 0.576. It is coming 3.614. So multiply by 3.614. How much it is coming? 5 lakh into 3.614. It is coming how much? 18 lakh 7,000. And can you see the entire 1 crore will be repayable after 5 years? So now we need to find out for 1 crore what is the present value at a rate of 12%, which is payable after 5 years. We'll multiply by 0.576. 576. So it will be 57 lakh 60,000. So plus 57 lakh 60,000 is coming how much? 75 lakh 67,000. You can see they have given approximately 74 lakh 76,656. Means it is quite possible they have taken 4 decimal, I have taken 3 decimal. So this is the fair value loan. So fair value loan is what? 74 lakh 76,656. I have taken 3 decimal, or quite possible my discounting factor may be wrong, but just check it. Just check it whether it is coming with 4 decimal or not. Everyone check it. What is the fair value loan? So 5 lakh into present value factor at a rate of 12%, then 1 crore multiplied by present value factor at a rate of 12%. Means this will be annuity factor, this will be present value factor. How much it is coming? Total amount is coming how much? Peligula. Are you computing? Where the answer is coming same? You have also taken 3 decimal. I have also taken 3 decimal. Okay, chalo. What is the total amount coming? So 74 approximately correct. 74 lakh 72,000. I think they have taken 4 decimal. So you can also take 4 decimal or 3 decimal. Both answer will be correct only whatever you are taking. So this is the fair value loan. What is the amount of the loan process received? 1 crore. So difference will be considered as deferred income, means deferred government grant. So what journal entry will do? Bank account debit to deferred government grant to loan payable. For these, Ind AS 109 will be applicable. For this, Ind AS 20 will be applicable. Now Ind AS 109 says that it will be subsequently recognized at amortized cost. You can see one amortized cost table has been prepared where interest is calculated by applying ER. ER will be equal to market rate of interest, that is 12%. Then contractual payment has been deducted. So this is the amortized cost at the end of each year. This you can easily find out. And can this 25 lakh 23,344 will be amortized to PL, because this loan has been taken for the purchase of depreciable asset, so will be allocated over the useful life of the asset in the ratio of depreciation, because the useful life of depreciable asset has not been given, so you can't calculate that. Understood? So only one point has been given on a systematic basis over the period in which A Limited recognized as expense the related cost for which the grant are intended to compensate, means in the ratio of depreciation over the useful life of the asset. Chalega? Understood? Good question. Come to one more question, question 18. NTDA is awarded a government grant of 60,000 receivable over 3 years. Correct? 40,000 in year 1, 10,000 year 2 and year 3. Contingent on creating 10 new jobs and maintaining them for 3 years. The employer recruited at a total cost of 30,000 and the wage bill for the first year is 1 lakh, rising by 10,000 in each of the subsequent year. Calculate the grant income and the deferred income to be accounted for in the books for the year 1 to 3 in the following two situations. First condition, situation, there is a reasonable assurance that the entity will comply with the condition and the grant will be received. There is no reasonable assurance. So they have given two situations. Now just try to understand what is the total grant 60,000. First though, if I just try to explain you, year 1, year 2, year 3. So first you need to find out the expenses which they are intended to compensate. The grant is intended to compensate. So first year the total cost of recruitment was 30,000, wage bill was 1 lakh. So this is 1 lakh 30,000. Then the wage bill was increased by 10,000, it become 1 lakh 10,000. Then again increased by 10,000, it become 1 lakh 20,000. So total it become 3 lakh 60,000. And total government grant is equal to 60,000. So this 60,000 will be allocated to each year in this ratio. This you can allocate. So 60,000 into 130 divided by 360 is coming how much? 21667. Then 60,000 into 110 divided by 360, it is coming 18,333. Correct? And last May it will be 10,000 only. It will be 20,000. Correct? Okay, sir. Now, as per case number 1, when both the conditions are satisfied, means there is a reasonable assurance the condition will be satisfied and grant will be received, then in that case, can you see initially entire government grant will be recognized irrespective of the fact whether it has been received or not received. Correct now. In that case, your deferred income initially means the first January entry will be what bank account debit deferred income 60,000. So out of 60,000, how much you have transferred to PL? 21667 you have transferred to PL. So what is the deferred income? 60,000 minus 21667 is equal to what? 60,000 minus 21667, that is 38,333. Then next year 38,333. Again how much has been transferred to PL? 18,333. The deferred income will be 20,000. Then again it will be 20,000. How much transferred to PL? 20,000. The deferred income will be nil. So in first situation the deferred income position will be this. But in the second situation, when there is no reasonable assurance the condition will be satisfied, in that case we can recognize government grant only to the extent which whatever we have received. Correct now, means we cannot recognize government grant on accrual basis. In that case, can you see first we have recognized 40,000, out of which how much we have transferred? 21667. Understood? So 40,000 minus 21667, that is 18,333 deferred income. Then can you say 18,333 become opening balance? Then again we recognize 10,000. Then how much is transferred to PL? 18,333. And what will remain? 10,000 will remain as deferred income. Then last year 10,000. Again we recognize 10,000 because that will be collected, and minus 20,000. This will become nil. So in this case you can see in both the situation government grant transferred to PL will remain same. Only deferred income at the end of each year will change. This question has been already asked in exam. When this question was asked in exam, then these two situations were not given. Whenever the question is silent about a situation, always assume that both the conditions are satisfied, because you can't assume by your own that conditions are not satisfied. If the question is silent, always assume that both the conditions are satisfied and do as per this calculation. Understood? Have you understood this particular point? Yes, sir. I hope you understood. Good question can be asked. This 21 is super question, but till now not asked in exam. Can be asked in exam. Correct now. But if this question will come, it is a lengthy question, will be of, I will say 7 marks, 7 to 10 marks also. It can be of 10 marks also. A Limited is engaged in the manufacturing of certain specialized chemical. During the manufacturing process, certain wastewater is produced, which were released by A Limited in the nearby river. Correct. Then you can read, if a manufacturer installs certain pre-approved wastewater treatment plant, the government will provide an interest-free loan equal to 50% of the cost of the plant. Such loan is repayable to the government after 5 years from a date of disbursal. The manufacturer availing the benefit of this scheme must treat the wastewater of his factory using the specified plant, correct now, before releasing it to the river. If this condition is not satisfied, the entire loan become immediately repayable to the government along with the penalty of 10 lakh. The entire loan will become refundable if condition is not satisfied along with 10 lakh penalty. Cost of wastewater treatment plant is to be installed to avail the benefit of the scheme is 50 lakh. What is the total cost of the plant? 50 lakh. So government grant will be 25 lakh. A Limited decided to utilize the scheme because if it were to obtain a similar loan from the bank, it would be available at a market interest rate of 12%. 12% is the market rate of interest. Accordingly, A Limited applied and obtained a government loan of 25 lakh on 1st April 2001. A Limited purchased and installed the plant such that it became ready for use on the same date. A Limited has an accounting policy of recognizing government grant in relation to depreciable asset in the proportion of depreciable expense. Means whatever government grant has been received, that will be treated as deferred income. Deferred income means there are two approaches. It can be also deducted from the cost price of asset, that will not be used. It has determined that plant will be depreciated over 5 years using straight line method. In the month of March 2003, government officer conducted a surprise audit and it was found that A Limited was not using the wastewater treatment plant as prescribed, means conditions were not satisfied. Accordingly, on 31st March 2003, means at the end of second year, the government ordered A Limited to repay the entire loan along with penalty. A Limited repaid the loan with interest and penalty as per the order on 31st March 2003. Measure the means everything has been given. So first you need to calculate in this case fair value loan. Fair value loan will be what? Because contractual rate of interest is 0. So there is no contractual interest payment. The entire loan amount is payable after 5 years. So 25 lakh into present value factor at the rate of 12% payable after 5 years. So I think it will be 0.567. This becomes the fair value loan. The 25 lakh this will be the amount to be recognized as government grant. Means first January into what? Bank account debit 25 lakh to deferred government grant. Yeah, deferred grant is 10 lakh 82,500 and loan payable will be 14 lakh 17,500. Correct. Can you say on this interest will be calculated by applying 12% interest rate for 2 years that you can do? Okay. Can you, this will be amortized in the ratio of depreciation because they have given that plant whatever has been acquired will be depreciated on SLM basis. Means 50 lakh is the cost price of plant. Of course, we need to also recognize that PP account debit to bank we can do, and that will be depreciated over 5 years. Depreciation account debit to PP 10 lakh 10 lakh. So out of this, can I say 1/5 will be also transferred to PL? So you can say grant income to deferred grant. You can say grant income, sorry, my mistake. Deferred grant to grant income, and grant income will be transferred to PL. So you can see deferred grant to grant income. You can have to grant income transferred to PL. So you can see divided by 5 years done. 10 lakh 82,500 divided by 5, that is 2 lakh 16,500. They have not done journal entry of interest expense. You can also do interest expense, means interest expense will be calculated on 14 lakh 17,500 at 12%, that is coming 1 lakh 70,100. That they have not done, but they have prepared one working note for that. You can see they have prepared one working note for that and they have calculated amortized cost at the end of year 2. At the end of year 2. And case deferred grant, the opening balance was this will be transferred in first year, this will be transferred in second year. Means this will be the closing balance of deferred income is unamortized balance of deferred income, unamortized balance of deferred income. Can you say in second year, again this journal entry will be done. Depreciation journal entry will be also done. They have not done depreciation journal entry, I don't know why, but depreciation journal entry, this journal entry and interest expense journal entry, you can do that 3 journal entry. After that, on 31st March 2003, we'll pass the refund journal entry. So what will be refund journal entry, that we need to understand. Correct now. So entire loan amount will be repayable. So first the loan outstanding amount is how much? 17 lakh 78,112. That will be debited. Then deferred grant 6 lakh 49,500 will be debited. And the amount payable is what? 25 lakh. And difference will be adjusted in PL. You can see what they have done. Loan account debit, deferred grant account debit, to grant payable, and the difference had been adjusted to PL. I hope this point you have understood. Can I say along with this a penalty of 10 lakh is also payable. So one more journal entry will do that PL account debit to government grant, PL account debit to government grant payable, because with the government grant 10 lakh penalty is payable. So entire amount payable is 25 lakh plus 10 lakh. You can do one compound journal entry and this 10 lakh will be also transferred to PL account. Understood? Good question, I will say. Have you understood this point? चलेगा? What is this question? Let us read. M Limited has constructed another factory few years ago with the assistance of at another government grant, innovative product. The grant is non-repayable and the following the construction of factory cannot be clawed back by the government. I mean this is non-repayable grant. There is no further condition attached to the grant that the company is required to satisfy. The grant received has been treated as deferred income and is credited to the income statement over the same period as factory is being depreciated. Following an adverse change in the demand of the product the factory manufactured during the following an adverse change in the demand of the product of the factory manufactured during the year at reporting date, the actors have conducted that factory carrying value is no longer recoverable in full and that a write down for impairment is required. Means there is an indicator of impairment. The write down is more than covered by amortized deferred income balance related to grant. So write down means impairment loss amount is more than uh, the impairment what they have given. The impairment loss is more than covered by the amortized deferred income balance related to the grant. Means whatever deferred income is not yet amortized to PL, that is the impairment loss amount is more than that amount. Discuss in the context of India's framework and India's 20 the impairment of factory for which innovative product government grant has been received. What would your answer be different if there are further conditions attached to grant beyond the construction of factory? Means simple question. They have asked whether impairment loss can be adjusted with the unamortized balance of deferred income. That is the question. Correct now. First they have written, just try to understand. Government grant related to asset including non-monetary grant at fair value should be presented in the balance sheet either by setting the grant as deferred income or by deducting the grant from the cost price of asset. This we know. Government grants should be recognized as income over the period in which the entity recognized as an expense the related cost they are intended to compensate. The outcome should be the same in PL statement regardless of whether the grant are netted or deferred. Yes, this also we know. In case the grant had been offset against the acquisition cost of the factory and the net carrying value is less. A minute. Now, just try to understand what they are saying. Common grant relating, this is the answer. To match the same result for the grant means what? Just try to understand what they want to say. Let me explain you. Let me explain to you with some example. Suppose the cost price of asset is 10 lakh and government grant is 2 lakh. So this become 8 lakh. So if the grant is deducted from the cost price of asset, so this net amount will be transferred to PL as depreciation, understood? But in the second case, when it is treated as what? Deferred income. 2 lakh is deferred income. So can you say every year this amount will be depreciated and this amount will be transferred to PL in the ratio of depreciation. Suppose 2 years expired and 5 years is the useful life. So can you say out of this 4 lakh has been transferred to PL and out of this 2 lakh divided 5 into 2 means 80,000 will be transferred to PL. So this become how much? 1,20,000. 1,20,000 and this will become 10 lakh minus 4 lakh, that is 6 lakh. Understood? Correct. This is one alternative. This is another alternative. Are you able to understand? Now, if you depreciate these in 5 years, what will happen? 8 lakh divided by 5 into 2 means 3 lakh 20,000. So in this carrying amount is coming how much? 8 lakh minus 3 lakh 20,000. It's coming 4 lakh 80,000. Now suppose the recoverable amount, suppose let us say, suppose the recoverable amount is 5 lakh. So this become 1 lakh impairment loss. In this case, just try to understand the recoverable amount is 5 lakh and 5 lakh is more than what? You can see the 5 lakh is more than what? Cost price. So in this, there is no impairment loss. Means it is automatically adjusted with the deferred income. Are you able to understand? But in this case, if you will not adjust with the deferred income, the matching concept will not be applicable. Therefore, what they want to say, in this case, the impairment loss should be adjusted with deferred income. Now you will be able to understand. To match the same reserve for the grant innovative product, which has been shown as a deferred income, the factory is initially recorded at its cost. It is reasonable to release an amount of deferred income to PL account to compensate for the impairment write down. Have you understood? Now they have given one more situation. If there is a condition attached to the grant, then what will be your answer? If there is a further condition attached to the grant beyond the construction of the factory, it may not be appropriate to release an amount of deferred income to compensate for the impairment write down. Entity would need to assess those further conditions to determine amount, if any, of the deferred income to release. Means what they are saying, if there is some condition attached, some condition has been given, then in that case it should not be adjusted with deferred income because there are some condition left. Condition is not satisfied till the condition is set. Means if there is some further condition, so till the condition is satisfied, it should not be transferred to PL account. So they have given one good question. Till now this question has not been asked. So do this question because it has been recently given in MTP, till now not asked in exam. Chalega? Understood? Yes, sir. With this, India's 20 is also over. There are there may be some more question. I think there are some question. I will say that do that question. This type of question are also highly probable in exam. But there are simple question. If I will say India's 20, 1 minute. They ask this question number 11. This type of question they normally ask 5 points and 5 point they will ask of 5 marks, or they may ask this type of question in MCQs also. Means I have found that this type of question they are asking in MCQs. Correct now. So do this by your own. You will be able to understand. This question number 11 is simple, which you can understand. Okay, sir. Balance. I think this question 19, this type of question, where point by point given now, so they will ask 5 point for 5 marks. What is the treatment? Similar question I have seen they are asking in MCQs also. Okay. Chalo. With this, India's 20 is also over. Okay, sir. So what we have left? We are left with I'm supposed to do India's 1, India's 8, India's 40, India's 38. Apart from this, you want any more India's from my side? Impairment. India's 36 also you want? Chalo. India's 36. Okay. Let me take one tea break. We'll take a tea break. You also take a tea break. Then we'll meet. Okay. Chalo. I think I'll take 15 to 20 minute break. Now, can we start once again, everyone? Yes. So we'll take one more chapter, India 36, as per your demand, impairment of asset. Okay. So let us cover all the expected question which I believe that type of question may come in exam. Can we start? Ready, everyone? Can you give me your attendance? Yes, sir. Everyone is ready? Fast. Then we'll start this chapter. Yes, sir. So come to question 13. On 31st March 2001, XYZ Limited makes the following estimate of cash flow for one of the assets located in USA. So you can see the cash flow is in dollar. Now what India 36 says that we need to estimate cash flow to estimate value in use. Now if that cash flow is in foreign currency, then first we need to calculate present value of such cash flow in foreign currency, and that then convert the present value in foreign currency by using the spot rate in functional currency. Got this point? This is the rule. So you can see they have given dollar, then they have given applicable discount rate in India 15%, in USA 10%. This is not relevant because present value will be calculated in foreign currency. Therefore, this rate will be applicable. Exchange rate are as follow. On 31st March 2001 means on the date of impairment testing 45, and expected exchange rate. This is also not relevant. This information not relevant. You can see first we have calculated the present value factor by using 10%. We have calculated present value in dollar. This we can do. Then multiply this present value by using the spot rate on the date of impairment testing, that is 45 per US dollar. So this will become value in use. Simple question. This type of question can be asked for 2 marks. Chalega? Yes, sir. Come to one more question. Question 17. A company operate in a mine a country where legislation requires that the owner must restore the site on completion of its mining operation. So guys, there is a restoration obligation, means there is an obligation to restore. Therefore, as per India's 37 provision will be created, and as per India's section, that provision will be capitalized and included in the cost price of particular asset. Yes, sir. The cost of restoration include the replacement of overburden which must be removed before mining operation commence. A provision for cost to replace the overburden was recognized as soon as the overburden was removed. The amount provided was recognized as a part of the cost of the mine and is being depreciated over the mine useful life. Same thing I have said. The carrying amount of the provision for restoration cost is 500, which is equal to present value of restoration cost. So what is the carrying amount of that liability? Is 500 rupees. Now entity is testing the mine for impairment. The CGU for the mine is the mine as a whole. Well, the coal mine is itself one CGU. Chalega. The entity has received various offers to buy the mine at a price of around 800. So again, this become fair value. Fair value. The price reflects the fact that buyer will assume the obligation to restore the overburden. Means just try to understand, if someone is purchasing the mine from us, so we need to also transfer the obligation to restore. If you have transfer obligation to restore, then the fair value has been calculated by considering that obligation to restore. Now what India 36 says that to find out a carrying amount of CGU, we should not deduct the carrying amount of any liability unless that liability has been considered for determination of recoverable amount. Means that liability has been considered for determination of recoverable amount, then deduct the carrying amount liability from the carrying amount of CGU. Got this point? So in this case, because this fair value has been determined by taking that liability into consideration, therefore to find out the carrying amount of CGU, we should also deduct carrying amount of liability. This is the concept. Have you understood? Yes, sir. Disposal cost of the mine are negligible. The value in use of the mine is approximately 1200, excluding restoration cost. Just try to understand, restoration cost is nothing but disposal cost. Now, whenever we calculate value in use, this always we consider the disposal cost also. So can I say to find out value in use, the present value of disposal cost should be also deducted. Present value of disposal cost should be also deducted. Therefore, can I say this is the value in use excluding restoration cost? That is not correct. That is not correct. Means from this 1200, we should also deduct 500. That is present value of restoration cost. The value in use should be how much? 700. And the carrying amount of the mine is 1000. Now what India 36 says that from this carrying amount of CGU, carrying amount of that liability will be deducted if that liability has been considered for determination of recoverable amount, that is fair value. It means from this also will deduct 500 and carrying amount of CGU will become 500. So just try to understand carrying amount of CGU is how much? 500. Fair value less cost to sell is 800 and value in use 700. We'll take a higher one is 800. So recoverable amount is how much? 800. And therefore, in this case, impairment loss will become 0. Impairment loss will be nil. Good question. Till now not asked in exam, can be asked in exam. Chalega? Yes sir. 17 you have understood? Or this question can be asked as a 2 marks MCQs also. Next point. Question 21. On 1st April 2001, Venus Limited acquired 100% of Saturn Limited for rupees 4 lakh. The fair value of net identifiable asset of Saturn Limited is 3,20,000. So can you say purchase consideration 4 lakh and the fair value of IND is 3,20,000. So difference will be goodwill. Goodwill is how much? 80,000. Saturn Limited is a coal mining business. On 31st March 2023, government has cancelled the license given to it in few states. So this become indicator of impairment. Indicator of impairment. This para you can read by room. Then what they have given, the useful life of Saturn Limited asset is estimated to be 20 years with no residual value. Straight line depreciation will be used. Correct. Now what they have said, ki the entire operation of Saturn Limited is treated as a CGU due to regulatory intangible. It is not possible to determine the selling price. Means they are not able to determine the fair value less cost to sell. Its value in use is estimated by the management is 2,12,000. So this only will become a recoverable amount. Yes sir. Then this was the position as on 31st March 2023 or 2003. Then by 31st March 2005, means after 2 years, the government reinstated a license of Saturn Limited. Means this become indicator of reversal of impairment loss. The management expect a favorable change in net cash flow. This is an indicator that impairment loss may be reversed. The recoverable amount of the net asset is re-estimated. The value in use is now 3,04,000 and fair value less cost to sale is expected 2,09,000, 2,90,000. We'll take higher one. Higher one is what? 3,04,000. This becomes the recoverable amount on the date of reversal. Calculation of impairment, calculate impairment loss and its reversal. Chalega? Yes sir. So first we'll do impairment testing. So you can see we have goodwill and other asset of the CGU. This become total amount. Initial cost is 80,000 and 3,20,000. Total become 4 lakh. First we'll calculate depreciation. On goodwill there is no amortization. Other asset will be depreciated for 2 years. Total useful life of other asset is 20 years. So we'll do 3,20,000 divided by 20 into 2. That will come 32,000 depreciation for 2 years. So this will become the carrying amount of the asset before impairment testing. Now we'll compare with the total recoverable amount. Total recoverable amount is 2,12,000. So if you compare with 2,12,000, what is the impairment loss? You can see 3,68,000 minus 2,12,000. Correct now. That is coming 1,56,000. The total impairment loss is 1,56,000. This will be first allocated goodwill. The entire 80,000 means we can allocate impairment loss to the extent of its carrying amount, that is 80,000. Balance will be allocated to the other asset of CGU. The balance 76,000 will be allocated to other asset. With this what happened? Can you see the revised carrying amount of goodwill will become nil and revised carrying amount of other asset will become 2,12,000 and the total will become 2,12,000. Understood? Yes sir. This was the on the date of impairment testing, that is on 31st March 2003. Now we'll come to 31st March 2005 on the date of reversal of such impairment loss. What need to be done? Can you see once goodwill is fully impaired, then their impairment loss cannot be reversed. So while testing for reversal impairment loss, this column is actually not required. Goodwill column is not required. We'll consider only one column, that is other asset. So on the date of reversal impairment loss, you can see the carrying amount is how much? The carrying amount is 2,12,000. 2,12,000. So can you say we need to first find out a carrying amount on the date of reversal? Carrying amount on the date of reversal. Got this point? Whatever I am saying. Are you able to understand? Correct? So in this case, first will means whenever there is a indicator reversal, so what our India 36 says that the amount of reversal will be lower of A and B. Lower of A and B. Amount of reversal will be lower of A and B. A is equal to what? A is equal to recoverable amount minus carrying amount, and B is equal to carrying amount as if no impairment loss was ever charged minus carrying amount. Minus carrying amount means carrying amount as on the date of reversal. As on the date of reversal. So first what we'll do, I'll just inform you what need to be done by some calculation. Means first we'll find out point number A. Point number A is what? Recoverable amount. Recoverable amount is given in the question. How much given in the question? That is 3,04,000. 3,04,000. And we need to find out carrying amount. Carrying amount. The revised carrying amount on the date of impairment testing was 2,12,000. Can I say on this we need to charge 2-year depreciation again? So 2,12,000 divided by 18. 18 is the remaining useful life into what? 2. So that is coming 23,555. So minus 2,12,000. It is coming how much? 1,88,444. So this is coming how much? Minus means 3,04,000 minus 1,88,444. So it is coming 11,5556. This is the A. Second B, we need to find out carrying amount as if no impairment loss was ever charged. As if no impairment loss was ever charged. So initial cost price was 3,20,000. Can I say if there was no impairment loss, then we would have charged depreciation for 4 years on this 3,20,000 only. So 3,20,000 divided by 20 into 4 will be 64,000. So minus 3,20,000. This will come 2,56,000. 2,56,000. Carrying amount as if no impairment loss was ever charged. And present carrying amount already we calculated, that is 1,88,444. So what is the difference between these two? So 2,56,000 minus 1,88,444 is equal to how much? 67,556. 556. So the amount of reversal will lower of these two. Lower of these two. Lower is what? 67,556. Therefore this amount will be reversed. This amount will be reversed. Therefore revised carrying amount will be how much? That is 1,88,444 plus 67,556, which will be equal to 2,56,000. 2,56,000. Got this point? One easy way to find out this amount means if you don't want to do this much calculation, what you do? First find out recoverable amount. Then find out carrying amount as if no impairment loss was ever charged. Recoverable amount is given 3,04,000. And this is 2,56,000 already calculated. To revise carrying amount after reversal will be lower of these two, that is 2,56,000. If you know this amount, get 2,56,000 minus present carrying amount will be the amount of reversal. That we means reverse calculation also you can do. Understood? Have you understood this point? Chalega. That is only given in the solution, you can now read. Okay sir? Yes sir. Next question. Come to question number 28. A Limited purchased an asset of rupees 100 lakh on 1st April 2000. It has a useful life of 4 years with no residual value. Recoverable amount are as follow. On 31st March 2001, then 2002, then 2003. Calculate the amount of impairment loss or its reversal, if any, on 31st March 2001, 31st March 2002. Means 3-year information they have given. First, original carrying amount is how much? 100 lakh. We'll first charge depreciation on that for 1 year. So 100 divided by 4 into 1, 25 lakh. So this become the carrying amount as on the date, as on year end 1. We'll compare with the recoverable amount given 60 lakh. Recoverable amount is 60 lakh. Therefore 15 lakh will be charged to profit and loss account. Impairment loss of 15 lakh will be charged to profit and loss account. Done. Correct. Now let us come to second year. Second year, can you say 60 lakh is the opening balance? Once again 1 year depreciation will be charged. So 60 lakh divided by 3. So 20 lakh depreciation means carrying amount become 40 lakh. Carrying amount become 40 lakh. On this date, what is the recoverable amount? Recoverable amount is 40 lakh. So you can see if the recoverable amount is 40 lakh, so there is no impairment loss in the second year. There is no impairment loss in the second year. Now we'll come to third year. Third year, the opening balance is 40 lakh. 1 second, we'll charge depreciation on this. So divide by 2 means 20 lakh become depreciation. So carrying amount on the date of impairment testing is 20 lakh. What is now? What is now recoverable amount? Recoverable amount is 28 lakh. 28 lakh. So can you say this is the indicator, because the recoverable amount is now more than what? Carrying amount. So there will be reversal. So what is the amount of reversal that we need to find out? So first, once again in this case, what you will do? Amount of reversal will be lower of two amount. First is what? Recoverable amount minus carrying amount. Recoverable amount given 28, carrying amount given 20, that is 8. Second, carrying amount as if no impairment loss was ever charged minus carrying amount. So we need to find out carrying amount as if no impairment loss was ever charged. So initially it was 100 lakh. Divide by 4 into 3. 3-year depreciation will be 75. Means this will be 25 minus 2, that is 5. Means can you say the amount of reversal cannot be more than 5. More than 5. Therefore amount of reverse will be 5 lakh, not 8 lakh. Got this point? You can see the reversal amount will be what? 5 lakh. Therefore reversal of an impairment loss of 5 lakh should be done as on 31st March 2003. Got this point? Chalega. This type of question can be asked. Have been already asked in exam for 6 marks. 3 year 2 marks, 2 marks, 2 marks, 3 marks question will be asked. Already asked in exam. Means very simple question they are asking. This also done. This question is a good question. Have been already asked in exam. This question, when it was asked, it was a question of 8 marks. But good question. What they have given. Alia Limited is a manufacturing company which deals into manufacturing of cold drink and beverages. It is having various plants across India. There is a machinery A in Baroda plant which is used for the purpose of bottling. There is one more machinery which is machinery B club with machinery A. But there is one more machinery B club with machinery A. Machinery A can individually have an output and also sold independently in the open market. Means for machinery A we can find out recoverable amount. But machinery B cannot be sold in isolation, and without clubbing with machinery A, it cannot produce output as a whole. The company consider this group as a CGU, and the inventory amounting to rupees 2 lakh and goodwill amounting to rupees 1.5 lakh is also included in such CGU. Means can you say the smallest group of assets which are capable of generating cash flow is this particular CGU. Now because machinery A, we can estimate the recoverable amount of machinery A independently. Therefore, some information has been given. Machinery A was purchased on 1st April 2013 for rupees 10 lakh and the residual value is 50,000. Sorry. Machinery B was purchased on 1st April 2015. This date is important. For rupees 5 lakh with no residual value. The useful life of both machinery A and machinery B is 10 years. The company expects following cash flow in the next 5 years pertaining to machinery A. So that this information has been given to find out value in use of machinery A. The incremental borrowing rate of the company is 10%. So you can see they have given 1, 2, 3, 4, 5. They have given the cash flow. Only be careful the last year we need to also add the disposal value to find out value in use. The disposal value of machinery A they have given 50,000. So this will be increased. This will be increased by 50,000. This be careful because the value in use is the present value of cash flow to be generated from the use of asset plus present value of any disposal cost which will be obtained at the end of useful life. Chalega. On 31st March 2018, the professional valuer have estimated the current market value of machinery A is 7 lakh. This they have given to find out fair value less cost to sale of machinery A. The valuation fee is 1 lakh. Just try to understand valuation fee is not the cost to sell. Means this is not a selling expense. So this is not to be considered to find out fair value less cost to sell. The valuation fee is not deducted to find out fair value less cost to sell. There is a need to dismantle the machinery before delivering it to buyer. Dismantling cost 1.5 lakh. Specialized packaging cost will be 25,000 and legal fee will be 75,000. So these all three will be deducted to find out cost to sell. Means to find out fair value less cost to sale. चलेगा. So it is 1.5 plus 0.25 plus 0.75. It is coming 2.5. So 2,50,000. 2,50,000 is the cost to sale. Correct? So 7 lakh minus 2,50,000, that become the fair value less cost to sale. Up to this, any doubt? Then they have given the inventory has been valued in accordance with Ind AS 2. The recoverable value of CGU is 10 lakh on 31st March 2018. Now they have given recoverable amount of the entire CGU as a whole. That is 10 lakh. In the next year, the company has done the assessment of recoverability of CGU and found that value of such CGU become 11 lakh. That is on 31st March 2019. Means next year the the recoverable amount of CGU become 11 lakh. The recoverable value of machine A is 4,50,000 and combined machinery A and B is 7,60,000. So one thing is clear, that what is the recoverable amount of machinery B? It is 7,60,000 is the combined 7,60,000 minus what, 4,50,000. From this we can find out that recoverable amount of machinery B will be 3,10,000. Compute the impairment loss on CGU and the carrying value of each asset after charging impairment loss. Correct? Then compute the depreciation of next year. Then compute the carrying amount as on 31st March 2019 after reversal wala point. Very good question. Interesting question. But can you see, to understand this question, you have to understand each date, each information carefully, then only you can do correctly. Right now it is quite possible you are understanding with me, but in exam this question will be difficult because there are so many information. They have a proper reading of question, proper analysis of question is required, and therefore I always suggest draw timeline, date wise write down everything. Date wise write down everything. This much you understood, so we can begin. Have you understood question? Question have you understood? First inform me. Have you understood the question? Bolo. I have the solution for this. I'll just take out that solution only. My solution. From that I will explain. First, have you understood the question? Now, in this first, can I say, we should find out the carrying amount of machinery A and B on the date of impairment testing. The impairment testing need to be done on 31st March 2018. Now, machinery A was purchased on 1/4/2013 and machinery B was purchased on 1/4/2015. Means if I am saying 13, so it means depreciation should be calculated for 5 years. If I am saying 1/4/2015, depreciation should be calculated for 3 years. So can I say, in this case, the cost price is 10 lakh and 5 lakh. And for machinery A, there is a residual value of 50,000. So we'll do 10 lakh minus 50,000 divided by total useful life. Useful life is 10 multiplied by 5. This will become depreciation. Same way you can calculate depreciation of B, but for B there is no residual value. Be careful. This become the carrying amount of machinery A and machinery B on the date of impairment testing. Then can you see, because they have given separate information about machinery A, about a recoverable amount, we'll find out the recoverable amount of machinery A. Now recoverable amount means value in use and fair value less cost of disposal, whichever is higher. So we'll find out value in use. So you can see we will calculate present value of future cash flow including disposal cost. Disposal cost will be included at the end of 5th year. Then present value factor at the rate of 10%. Present value we can calculate, this become value in use. Easily you can calculate. Then we'll find out fair value less cost of disposal. That already I have already clarified. 7 lakh minus 2,50,000, that is 4,50,000. We'll take higher one. Higher one is this. So this become value in use and sorry, recoverable amount of machinery A. Recoverable amount of machinery A. Now can you see, if you know the recoverable amount of machinery A, you can find out what can be the maximum impairment loss for machinery A. Means what can be the maximum impairment loss for machinery A. The maximum impairment loss is their carrying amount. Carrying amount was 5,25,000 minus recoverable amount. This will be the maximum impairment loss which can be allocated to machinery A. Means machinery A cannot be written down beyond this. Understood? Yes, sir. Now we'll do impairment testing of CGU. So impairment testing of CGU, there are 4 items: machinery A, B, inventory and goodwill. So you can see machinery A, B, inventory and goodwill. We write down carrying amount of machinery A, carrying amount of machinery B, carrying amount inventory given the question, carrying amount of goodwill. This becomes the total carrying amount, and we'll compare with that recoverable amount of CGU that is given 10 lakh in the question. So recoverable amount is also given the question 10 lakh. So this becomes the total impairment loss, and this will be first allocated to the goodwill to the extent of its carrying amount. You can see out of 2,25,000, 1,50,000 has been allocated to what? Goodwill. Now what is the balance impairment loss? Balance impairment loss is 75,000. Now this 75,000 as per Ind AS 36, it will be allocated to A and B in the ratio of their carrying amount. In the ratio of their carrying amount. Understood? The ratio is what? 5,25,000 is to 3,50,000. If you allocate 75,000 in this ratio, the amount will come 45,000, 30,000. Understood? Just check it. Everyone check it. Understood what I am saying? See, what is the total impairment loss? 2,25,000. Out of 2,25,000, 1,50,000 will be allocated to goodwill. Balance 75,000 will be now allocated to machinery A and B, not to inventory, because inventory is outside the scope of this particular chapter. Got this point? So that will be allocated in the ratio of their carrying amount. So if you allocate in the ratio of carrying amount, this amount is coming or not? Check karo. Where this amount is coming or not? Everyone, respond fast. You need to also calculate. If you only listen, you will not be able to understand. Have you understood this? I'm waiting for your reply. Yes. Very good. 45,000, 30,000. So it means what is the impairment loss allocated to machinery A is 45,000, machinery B 30,000. But the question is that can you reduce 45,000 from machinery A? Because you cannot reduce machinery A below its recoverable amount. If we deduct 45,000, the mere objective of this chapter will be defeated, and the maximum impairment loss which can be allocated to machinery as per its recoverable amount is 35,350. So what Ind AS 36 says that in this particular situation, you can only allocate how much impairment loss to machinery A? 35,350, and balance will be allocated to other asset in the ratio of their carrying amount, because there is only machinery B. The entire balance impairment loss means 75,000 minus 35,350 will be allocated to machinery B. Understood? And then we can calculate revised carrying amount. Revised carrying amount. So revised carrying amount calculated after impairment testing, which is coming, the total revised carrying amount will be equal to 10 lakh. This become impairment testing. Understood? Now look at the second point of this particular question. They have asked you to calculate the depreciation of next year for machinery A and machinery B. So that can be calculated on this amount, on 4,89,650 minus 50,000 divided by, because out of 10 year 5 year has been expired, so divide by 5 will do. Divide by 5, this amount will come. Similarly for this B, 3,10,350 divided by the remaining useful life out of 10 year, I think 3 year has been out of how much? Out of 10 year, how many year has been expired? 3 year has been expired. So divide by 7 you will do. So this amount will come. This will be the carrying amount on the date of reversal. On the date of reversal. Now coming to calculation of carrying amount of CGU as on 31st March 2019. To find out carrying amount, means first calculate reversal, then find out revised carrying amount, or we can use one shortcut. Whenever this type of questions come, use this shortcut. First write down all the asset of CGU, A, B inventory. Goodwill will not come, because once goodwill is impaired, their reversal is not permissible. Chalega. So A, B inventory. Now what is the carrying amount of A and B? as if no impairment loss was ever charged. Can you see this you can calculate as if no impairment loss was ever charged. So it means we'll calculate the carrying amount of machinery A and B on the assumption that no impairment loss has been charged till date. So that we can do 5,25,000. Correct now. 5,25,000 minus F means we have calculated from here. This was the 5,25,000, or we can start from beginning. 5,25,000 remaining useful life is 5, means 5,25,000 minus 50,000 divided by 5 is coming 95,000. So 5,25,000 minus 95,000, this amount will come. Similarly, we can calculate for B. Inventory, if nothing is given, we'll assume that inventory value remain same. This becomes that carrying amount as if no impairment loss was ever charged. Then we'll add on recoverable amount of machinery A and B. That is given in the question. Recoverable amount 4,50,000 given. We have also calculated that combined value of machinery A and B was given. Then from that we deduct 4,50,000. This is also we have derived, and this will remain same. This is a recoverable amount. Now I have just given one shortcut that revised carrying amount after reversal will be lower of recoverable amount and carrying amount as if no impairment loss was ever charged. So revised carrying amount will be lower of these two. So lower will be 4 lakh 30, 3 lakh and 2 lakh. This become revised carrying amount. Now if you compare this with the carrying amount, actual carrying amount as on this date, we have already calculated actual carrying amount. This already we calculated. You can write on this, and the difference between revised carrying amount and the actual carrying amount will be the amount of reversal. Amount of reversal. So this become the amount of reversal which will be transferred to profit and loss account. And so this is a shortcut. So whenever there are more than one asset in a CGU, always do in this way for the reversal wala point. Always do in this way. So first, what you'll do, first step, first find out carrying amount as if carrying amount of all the individual assets as if no impairment loss was ever charged. Then find out recoverable amount of all the assets given in the question. Then find out the lower of that two. That become revised carrying amount. Compare with the current carrying amount. The difference will be the amount of reversal loss. Amount of reversal of impairment loss. Got this point? Yes, sir. Very good question. Already asked in exam, can be asked again. Yes, sir. 29 also done. 30, I think you can do it by your own. 31 also you can do by your own. Come to 33. Sun Limited is an entity with various subsidiaries. The entity closes its books of account at every year ended on 31st March. On 1st July 2001, Sun Limited has acquired 80% interest in Pluto Limited. The details of the acquisition were as follows. Means it is a question of acquisition and then impairment of that CGU. Correct now. Sun Limited acquired 8 lakh shares in Pluto Limited by issuing 2 equity shares for every 5 acquired. The fair value of Sun Limited share on 1st July is 4 and the fair value of Pluto Limited share is 1.4 per share. The cost of issue were 5% per share. Again, the cost of issue is not relevant for calculation of goodwill because that is deducted from equity as per IND AS 32. So this information is not relevant. Correct. Sun Limited incurred further legal and professional cost of 1 lakh that is directly related to acquisition cost as per IND AS 103. This will be also charged to profit and loss account, will not be added to purchase consideration. This information is also not relevant. The fair value of identifiable net asset of Pluto Limited on 1st July 2001 were measured at 1.3 million. The fair value of INA is given. Sun Limited initially measured NCI improvement at fair value. The NCI is measured at fair value means full goodwill will be calculated. In this full goodwill will be calculated. They use market value of Pluto Limited for this purpose. No impairment was done on 31st March 2002 on 31st March 2003. Means up to 2003 there was no impairment. It means impairment testing will be done on 31st March 2004. Pluto Limited comprised 3 CGU ABC. When Pluto was acquired, the directors of Sun Limited estimated the goodwill arising on acquisition could reasonably be allocated on ABC in 2:2:1 basis. Okay, it will be allocated on 2:2:1 basis. The carrying value of asset in this CGU and their recoverable amount given. So you can see carrying amount of CGU before allocation of goodwill and recoverable amount is given. First, find out the carrying amount of goodwill arising on acquisition. Then calculate the impairment loss resulting from impairment review. So we need to find out the goodwill and then impairment loss, which can be allocated to NCI and parent company. So what they have asked, let me explain you. First, we'll calculate PC. So PC will be what? How many shares they have acquired? They have acquired 8 lakh shares. And the shares will be issued in 2:5 ratio. So 8 lakh into 2 by 5 into fair value of shares of Sun Limited 4. So that is the purchase consideration. So 8 lakh in 2 by 5 into 4. Can this become the purchase consideration? You can calculate cost price of investment. Now from this we'll add fair value of NCI. So fair value of NCI. So because they have acquired 80%, so 20% is what NCI. So 8 lakh represent 80%. So 2 lakh will represent 20%. So we need to find out the fair value of 2 lakh shares based on the fair value equity shares of subsidiary company. So fair value of equity shares subsidiary company is given 1.4 in the question. This become fair value of NCI. The total of these two we can do. Then from this will minus fair value of INA, that is given 1.3 million. Means in 1000 it will be 1300. So this will be the goodwill. Goodwill understood. Goodwill calculation is as per Ind AS 103. Very simple. Have you understood this much? Now we'll come to impairment testing. You can see the ABC before allocation, this carrying amount has been given. Goodwill 260 will be allocated in the ratio 2:2:1. So after allocation, this is the carrying amount. After allocation, this is the carrying amount. We'll compare with the recoverable amount. Recoverable amount is given in the question. Now you can see here recoverable amount is more than carrying amount. Nil. Here 650 minus 654 minus 650. The impairment loss is 4. Here the impairment loss is 52. This impairment loss will first allocate goodwill. So this will be entirely allocated goodwill, and this will be allocated 52. Correct now. Understood? What they have done? They have done this some other way. 1 minute. Either it should be 450. Write down 450. They have done in some other way. I am doing in this way. Chalega na? 450 plus 52. This will be 502. 502 minus 400. This is 152. Correct now. 102. Now out of 102, can you say 52 will be allocated goodwill and 50 will be allocated to other asset? 50 will be allocated to other asset. This is the case. I think this much you can do. This much you can do. It means, can is the total impairment loss which has been allocated goodwill is 4 and 52. So means 56. So 260 is what? Goodwill arising on acquisition minus 56. So what is the carrying amount of goodwill? That is 204. Carrying amount of goodwill is 204. Can you see this 56? Because it is full goodwill, this will be allocated both to parent company and NCI. Both to parent company and NCI. And this 50, whatever has been allocated to other asset, that will be also allocated to parent company and NCI. The total impairment loss is 106, which will be allocated 20%, means 20% to NCI, and balance will be allocated to what? The parent company shareholders. Understood? Means the owner of parent company. Chalega. This is the total information. So whenever full goodwill, now question is very easy. Whenever partial goodwill, so it becomes thoda sa interesting. Partial goodwill. In case of partial goodwill, be careful. Full goodwill you have understood, means I will just explain you. Just try to understand. Or I will take one question better. This much have you understood? Have you understood this particular question? Respond fast. Have you understood? Yes, sir. Now let us come to next question. Question 36. This is, from my point of view, 100% expected in your exam. 100%. I am expecting this question 36. On 31st March 2001, Vision Limited acquired 80% of equity shares of Mission Limited for 190 million. So PC is 190 million. The fair value of net asset that were included in the consolidated statement of financial position is 200 million. So fair value of net asset of Mission Limited is 200 million. It is a group policy to value NCI interest in subsidiary at the date of acquisition by using Pasina method, proportionate share of fair value of INA. Okay. Means in this case you will calculate partial goodwill. On 31st March 2004, Vision Limited carried out annual review of goodwill on consolidation of Mission Limited and found evidence of impairment. No impairment had been evident when the review was carried out means in previous year. The review involved allocating the asset of Mission Limited in 3 CGU and computing the value in use of each unit. The carrying value of individual unit, you can see unit A, unit B, unit C. The intangible asset PP current asset has been given and total value in use is also given. Okay. It was not possible to meaningfully allocate a goodwill on consolidation to individual CGU, but all other net asset of Mission Limited are allocated in the tables shown above. Now, whenever goodwill cannot be allocated to individual CGU, so it means goodwill will form part of larger CGU. In that case, we'll do impairment testing in 2 stages, first stage and second stage. I hope you remember. The intangible asset of Mission Limited have no ascertainable market value, but all current assets have a market value that is at least equal to the carrying amount. The value in use of Mission Limited is a single CGU. The value in use of Mission Limited means taking the total company as a whole. The recoverable amount is given, means value is given 350 million. Discuss and compute the accounting treatment as per IND AS 36. Now in this question what need to be done? First we need to calculate goodwill. So PC is 190. Then 20%, 200 is the fair value by INA. 20% is how much? 40. So 190 plus 40 means 230. And 200 is the fair value INA. 30 is goodwill. Goodwill is 30. Goodwill calculated. Understood? Yes, sir. Now, can I say, first we'll do impairment testing for the smaller CGU. So you can see that total carrying amount is 170, 90 and 100. And value in use is given. Value in use is given. So impairment loss we can calculate from this only. So impairment loss for this is nil. For this is 90 minus 66, that is 24. And this is 4. Okay, this will be allocated. This 24 and 4 will be allocated to intangible asset and property, plant and equipment in the ratio of their carrying amount that we can do. That we can do. Yes, sir. Allocation we can do. And we can find a revised carrying amount after first stage impairment testing. After that allocation that we can do. Means, can we say in this way, ki CGU A, the carrying amount will be 170 only. CGU B, the carrying amount will be 66 after allocation. Means that you can do individually also. I am doing on total basis. Correct. And CGU C, the carrying amount will be how much? Achha, in this no impairment loss. My mistake. Nil. In this no impairment loss. Okay, because recoverable amount is more than carrying amount. So it will be 100 only. So what is the revised carrying amount? It is 170 plus 66 plus 100. So 336 is the revised carrying amount. In this we'll add goodwill. Goodwill will be added. So 336 plus 30. But can this 30 is partial goodwill. 30 is partial goodwill. So what our IND AS 36 says that whenever there is a partial goodwill, we need to do grossing up. Means we'll convert that partial goodwill into full goodwill for impairment testing purpose. So 30 is represent 80%. So how much 100%? That we need to find out. So 30 divided by 80 into 100. That become 37.5. So we'll add 7.5 notional amount on goodwill. This will become 336 plus 37.5. So it become 373.5. Now what is the total recoverable amount of the company as a whole? 350. 350. So what is the impairment loss? So 373.5 minus 350, that will come 23.5. 23.5, one thing is clearly understood, this will be entirely allocated to goodwill. But out of that, can I say only 80% will be recognized? only 80% because 20% belong to NCI. That impairment loss cannot be charged to PL account because that represent the unrecognized portion of NCI. Got this point? So out of this only 80% means 80% of this total impairment loss which is allocated to goodwill will be recognized as an impairment loss. That is, I think that has been already done. You can see. So what we have calculated 23.5. You can see they have also calculated 23.5. But out of 23.80% will be only recognized. Therefore, goodwill will be grossed up. This, so you can see only, so that actually recognize 18.80 million, and the closing consolidated goodwill figure means that closing balance of goodwill will be what? 30 minus what? 30 minus 18.80. That will be the closing carrying amount of goodwill. Have you understood this calculation? You want me to present this, or have you understood this entire point? I think you have understood. Means I have just explained with the solution only. I hope you understood. Present it very neatly in exam. Have you understood this particular point? 36 is very important. बोलो. 36 done. Now let us come to this last question, 43. The two questions with what I have not done, that you do by your own, because that is very simple, you can understand. This question have been asked, I think three similar question have been asked 3 times in exam. 3 times or 2 times. Okay, sir. Pacific Ocean Railway Limited has 3 CGU, train, railway station and railway track. So you can see carrying amount has been given, remaining useful life has been given. Whenever remaining useful life is given, so and there are some corporate asset which can be allocated on reasonable basis to each CGU, but a ratio of allocation is not given, then in that case ratio of allocation will be always the product of carrying amount and remaining useful life. So this product will be the ratio of allocation whenever question is silent. This we call relative ratio. Relative ratio means product of carrying amount and remaining useful life. This we can find out. Now Pacific Ocean Railway Limited has 2 corporate assets, land and building. Land, the carrying amount of land can be allocated on reasonable basis, but you can see allocation ratio has not been given. Building, it cannot be allocated. Whenever there are some corporate assets which cannot be allocated, we'll do impairment testing in 2 stages, as we have done in previous question. You can CGU they have given for they have given recoverable amount for each CGU and company as a whole. Calculate impairment loss. Correct. So I'll explain with the solution only what they have done. So first they have given carrying amount of each CGU. Then the useful life has been given. Useful life. So what they have done? They have calculated a weight 1:2:2 based on useful life. And then they multiplied this carrying amount with this weight. Carrying amount with this weight. And this 1500, 4500 and 6600. And this become total. Understood? Then they have calculated the ratio of this weighted carrying amount. Weighted carrying amount means 1500 divided by 12,600. Understood? 4,500 divided by 12,600. But they have done rounding off in percentage. From my point of view, percentage should not be rounding off. If you see ignore decimal, normally when I say ignore decimal, so we ignore decimal only in rupees. The percentage decimal should not be ignored from my point of view. What I have understood, but ICI is doing solution in this way. In exam you can do, means just try to understand 1500 divided by 12,600, it is coming 11.90. Means if I will do 11.90% and if you will take 12%, there will be some difference in our answer. So I think 2 times this question have been asked, sometime the same question has been given RTMTB, but they are doing rounding off in percentage also. From my point of view, that rounding up should not be done in percentage, but I will say use this technique only. So they have done rounding up in percentage. Okay, we can do. Now based on this percentage, the land carrying amount will be allocated. So land carrying amount has been allocated in this percentage. Understood. Now we'll add this carrying amount with the carrying amount of CGU. Means A plus B will do. Understood. Means this will do plus this will be total carrying amount of CGU after allocation of corporate asset. Understood. Now we'll compare with the recoverable amount. You can see this is the after allocation amount. Then we'll compare with the recoverable amount given in the question. Recoverable amount, and this will be the impairment loss. This is nil. This is 198. This is 36. This 198 and 36 will be allocated to CGU and the corporate asset in the ratio of their carrying amount. Means this 198 will be allocated in 2250 and 648 ratio. Are you getting? And this 36 will be allocated in 3300 and 936 ratio. Understood? That allocation we can do, and you can see they have allocated on that basis. So you can see they have allocated first 198 to the land and CGU in that ratio only, and then they allocated 36 to the land and CGU on that basis only. This is the first stage impairment testing. First stage impairment testing, have you understood? बोलना रे, you are not replying. I think you are थोड़ा सा, I think you are slow. Where I am teaching, you have not reached to that point. What is point? Means you become slow. You have taken a lot of breaks. I have not taken break. Just try to understand from morning 9. I am teaching. So if I can teach for 12 hours, you can study for 12 hours also. Normally, from morning 9 I started and I have committed for more till 9. Just try to understand. If you see what I have done. In 9 to 9, 12 hours. In between I have taken 1 hour break. And let us say कि 5 minute break I have taken, that will be another 40 minutes. Means 12 hours में चलो 2 hours minus कर देंगे. 10 hours तो effectively I am teaching. So if I can teach effectively 10 hours, so believe me, you can study effectively for 12 to 13 hours. Because when I am saying I am speaking loudly, so my energy is, I am losing more energy than you. When you will study in a closed room, in a silent room, without saying so, without speaking so much, so you will lose less energy. So if I can teach 10 hours effectively, I can teach after that also. Correct now? If I can teach 10 hours effectively, you can study effectively 15 hours. 15 hours effective for this last whatever days are left, 5 days before exam. Then another, if you are writing group 1 to 3 exams are left. If you are writing both groups to 6 exams are there. Means more, I will say 12 days. You can easily study for 15 hours. If you have an intention to study, this last revision is very important. If you can revise this last day of revision properly, believe me, whatever has been done, leave it. Whatever you have done, not done, that is not important. But last these 15 days, 20 days, whatever left. Understood now? This from today, whatever days are left, 15 hours effective padho yaar. Believe me, if you can study 15 hours, and if that is effective, efficient, you are efficient, you can easily pass. So why not you are doing that? Just think about that. He only 20 days studies, 15 hours per day, you will become CA. What do you require? You require this only. Got this point? If you believe in my words, just mention in the comment box whether you are ready to study for 15 hours or not. Whether you are determined to become CA or not. That determination is very important. Then only your effectiveness will come. If there is no determination, the effectiveness will not come. Got this point? Yes, sir. So I hope you have understood whatever I am saying. This much you have understood? Respond fast. Yes, sir. Now after this we'll do the second stage impairment testing. So we write down the carrying amount before impairment loss of first stage. This we can write down. This is given the question. Then we write down impairment loss as per stage 1 impairment testing. So for land it is 44 plus 8. 44 plus 8 means 54. 44 plus 8, it is 52. You can see 52 is deducted from land. Then 154 from railway to 154 from railway. And 28 from railway track 28 from railway track. For this and for building till now not tested for impairment, that will be nil. This becomes the total impairment loss. You can find a revised carrying amount after first stage impairment testing. This is the total carrying amount of the asset as a company as a total. Company as a total. Now we'll compare the recoverable amount of company as a whole. You can see there is no impairment loss. So there is no further impairment loss. Suppose this is coming 9,200. So this 16 impairment loss will be allocated only to building. Only to building. Because that remain unallocated in the first stage impairment testing. Got this point? Have you understood? So in AS 36 also all the question have been done. Two question I have not done because that was simple. You can do it by your own. Any question you want me to do from your side? Which you think, yes, that type of question also you want me to right now teach? This question also do you by your own. This is estimation of future cash flow. Very easy. Correct now. Expected means not so much expected, but because it was given in RTP till now not asked in exam May 2023, so can be asked. So India 36 done from my side. Okay, sir. Which next Indias you want? So what we have done? But today I started with 41, then I have done 23. Then what I have done? I have also forgotten. I have done Indias 108, Indias 105, 36, 20. Bus. Then what I have done? Only this much I have done. Right? What Indias we have done? Bata. Acha, I have done 7, 21. Apart from this, what I have done? Okay. 22. One more. 12. Sorry. India's 12 also I have done. India's 12. Any more? Which India's you want now? Can I take India's 1 and India's 8 small India's? So India's 1, India's 8. Let me take. Two small India's. Two small India's I will take right now. India's 7 I have written. Bolo. So I will take India's 1 and India's 8. Okay. I'll take 5-minute break. Then we'll start. Now, everyone, come to India's one expected questions. Okay, sir. Come to question number 8 first. Are you ready, everyone? Come to question number 8. B Limited produces aircraft. The length of time between first purchasing raw material to make the aircraft and the date the company complete the production and delivery is 9 months. The company receive payment for the aircraft 7 months after delivery. What is the length of operating cycle? The operating cycle is the time period from the purchase of raw material till the conversion into cash and cash equivalent. So here it will be 9 plus 7, that is 16 months. So 16 months is the operating cycle. Very simple, 2 marks question. How should it trade the inventory and debtor? So in this case, just try to understand, because the operating cycle is 60 months. Operating cycle is 60 months, and you can see they receive payment within 7 months. Within 7 months. So therefore, both inventory will be always classified as current. For inventory, they will be always classified as current. Debtor in this case, because it can be easily realized within 6 months, because they have said the receive payment of for the aircraft in 7 months. So that will be also current. That will be also current. Chalega. Question 15. Entity has taken a loan facility from a bank that has to be repaid within a period of 9 months. Okay. From the end of reporting period. Prior to the end of reporting period, the entity and the bank enter into an arrangement whereby the existing outstanding loan will be unconditionally rolled into a new facility which expire after a period of 5 years. So prior to the end of reporting period. So before reporting period they have done one agreement, and now it is payable after 5 years. So can you say now it will be classified as non-current liability? Yes, sir. So how should such loan will be classified? So that will be non-current. Suppose that agreement has been done after balance sheet date, even though before approval of financial statement, so this will not be classified as non-current, then it will be current. Got this point? So this agreement of refinancing or reloading has been done after balance sheet date, then it will not be classified as non-current, then it will be current only. This point have you understood? Yes, sir. Have you understood this point? Will the answer be different in the new facilities agreed upon after the end of reporting period? That only they have asked. So now, if that agreement has been done after reporting period, it will be classified as current. Very important. Already asked in exam for 5 marks. Will the answer to A be different if the existing facility is from one bank and new facility from another bank? Then can I say existing facility will be current and new facility will be non-current? I think in this to no doubt. So in this case, existing facility will be classified as current liability only. Will the answer to A be different if the new facility is not yet tied up with the existing bank, but the entity has potential to refinance the obligation? Potential to refinance. They just try to understand. I'll explain this point. Whenever, just try to understand. Whenever entity has a discretion to refinance, means suppose we have done one agreement with the bank that any entity can refinance it as per the entity's discretion. So if the entity has a discretion to refinance and the entity is expecting to refinance, then it will be reclassified as non-current. Understood? But if suppose the entity does not have that discretionary power, but they are expecting to refinance, then it will not be classified as non-current, even though they have a potential to refinance. Even though they have potential to refinance. This point have you understood what I am saying? Correct? Understood? So in this case, because they have only potential, they do not have a discretion to refinance, therefore it will be classified as what? Current. Good question. Come to next question, question 16. This is also asked in exam for 5 marks. In December 2001, the entity entered into loan agreement with the bank. The loan is repayable in 3 equal annual installments starting from 30 December 2005. One of the loan covenant is that the amount equivalent to the loan amount should be contributed by promoter by 24th March 2002, failing which the loan become payable on demand. Means if there is a breach of contract, the long term loan will become payable on demand and therefore it will be classified as current liability. As on 24th March, the entity has not been able to get promoter contribution. On 25th March, the entity approached the bank and obtained a grace period up to June 30 to get a promoter contribution. So they have got a grace period up to 30th June to get the promoter contribution. Understood this point? The bank cannot demand immediate repayment during the grace period. The annual reporting period of the entity is 31st March 2002. As on 31st March 2002, how should the entity classify the loan? Just try to understand here the grace period is less than 12 months. Therefore, in this case, the loan will be classified as current liability only. If the grace period is more than 12 months, then it will be classified as what? Non-current liability. So in this case, it will be current liability because the grace period is less than 12 months. Got this point? Assume that in anticipation that it may not be able to get promoter contribution by due date. In Feb 2002, the entity approached the bank and got the compliance date extended up to June 30. Means the compliance date has been extended before 31st March. It means there is no breach of contract only if the compliance date has been extended. If there is no breach of contract, it will not be classified, it will not be repayable on demand and therefore it will not be classified as current liability. In that case, it will be classified as one non-current liability. Understood this point? Good question. Chalega. Next. Come to next point. Company has taken a long-term loan arrangement from Company B. In the month of December 2001, there has been breach of material provision of the arrangement, as a consequence of which loan become payable on demand on 31st March 2002. Similar question, now it will be classified as current liability. In the month of May 2002, the company started negotiation with the Company B for not to demand payment as a consequence of the breach. The financial statement were approved for the issue in the month of June 2002. In the month of July 2002, both the company agreed that a payment will not be demanded. So, can you say the Company B agreed after the approval of financial statement? Because it was approved in June and they agreed after the approval of financial statement. Therefore, in this case, it will be a non-adjusting event. Means I will say because the agreement has been done after approval of financial statement, it will remain current only. It will not be classified as non-current liability. Chalega. You can see the liability will be classified as current. If suppose that agreement has been done, the agreement not agreement to not to agreement has been done for not demanding the payment due to consequences of breach of contract before approval of financial statement, then it will be classified as non-current liability. Chalega? Yes, sir. Question 20. NTDA has undertaken various transactions in the financial year ended 31st March 2001. Identify and present transactions in the financial statement as per Ind AS 1. Remeasurement of defined benefit plan. Can you see it will be transferred to OCI? OCI. And this is not recycling. Means it will not be reclassified to PL. So there are two type of OCI. One is reclassified to PL. One is not reclassified to PL. Is not reclassified to PL. Current service cost PL. Changes in revaluation surplus OCI. And this will be also not reclassified to PL. Gain and loss arising from translating the monetary asset in foreign currency. So gain and loss arising from translating the monetary asset. So this is nothing but foreign currency monetary item. This will be also transferred to PL. Transferred to PL. Gain and loss arising from translating the financial statement of foreign operation. In that case, it will be transferred to OCI. Gain and loss arising from translating the financial statement of foreign operation. This will be OCI, but this will be recycled to PL. Recycled to PL. Gain and loss from investment in equity instrument designated as FBTOCI. This will be also what? OCI, but this will be not recycled to PL. Not recycled to PL because this is equity instrument. Income tax expense PL. Share based payment PL. You can see item impacting the SOPL, current service cost, gain or loss arising from translating the monetary asset, income tax expense, share based payment cost. Item impacting OCI, remeasurement, changes in revaluation surplus, everything is given. Correct? Simple. This type of question can be asked. Already asked in exam. This question have been asked in exam. I think in May 2018 exam it was asked for 5 marks. Question 22. A company present a financial result for 3 years. That is 1 for current year and 2 comparative years. Internally for the purpose of management information every year in addition to general purpose financial statement. The efforts of financial result are presented without furnishing the related notes because these are not required by the management for internal purpose. During current year management thought why not they should present third year SOPL also in the general purpose financial statement. It will save time and will be available easily whenever management need this in the future. Now the question is that whether additional comparative statement can be given. Means the minimum, can you say minimum 1 year comparative financial statement is required. Correct. Means normally we prepare 2 balance sheet, 2 SOPL, 2 cash flow statement, 2 statement of changes in equity. Correct now with related notes. Now the question is that can we prepare additional comparative statement? Correct. So can management prepare the third statement of PL as an additional comparative in general purpose financial statement? Yes, they can prepare unless they are prepared as per the requirement of India. It is allowed. Yes, you can see answer yes. If the management present third statement of PL in general purpose financial statement as comparative, it is necessary this statement should be compliant of India. Yes, it should be compliant with India. Yes. Can management present third statement of PL only as an additional comparative in general purpose financial statement without furnishing other component like balance sheet, statement of cash flow, statement of changes in equity? Yes, it can be done. Means only SOPL can be presented without presenting additional balance sheet, etc. So yes, the answer. However, for SOPL related notes are required. Means related note for that SOPL is required. Chalega. I hope this also you have understood. Come to next question. A company while preparing the financial statement for the financial year 2001-2002 erroneously booked excess revenue of 10 crore. Means there was some error. The total revenue reported in financial year 2001-2002 was 80 crore. However, while preparing the financial statement of 2002-2003, it discovered that excess revenue was booked in the previous financial year, which it now want to correct in the financial statement. Okay, sir. However, management of company is not sure whether it need to present the third balance sheet as additional comparative. Regard to the above background, answer the following. Is it necessary to provide the third balance sheet at the beginning of preceding year? No, because can you say the correction of this error will not affect the opening balance at the beginning of previous year. Therefore, third balance sheet is not required. So, no. An entity shall present third balance sheet as at the beginning of preceding year in addition to minimum comparative financial statement if it applies this to okay, and if it applies uh, it applies an accounting policy retrospectively, makes retrospective restatement and reclassify them. First condition is satisfied, but second condition has a material effect on the information in the balance sheet, because can you say in this case the opening balance of previous year is not affected due to this correction, therefore third balance is not required. Company want to correct the error during financial year 2000-2003 by giving impact in the figure of current year only. Is the correction of management correct? No, because we need to do retrospective restatement of previous year figure in current year financial statement. No, this is also not correct. Chalega? Yes. Next point. Is offsetting permitted under following circumstances? Expenses incurred by a holding company on behalf of subsidiary company, which is reimbursed by the subsidiary company, whether in separate books of holding company, the expenditure and related reimbursement of expenses can be offset. Have you understood this point? So whether we can offset this point? Follow. Now what India says that the offsetting can be done if it is permitted by India or if the offsetting reflect the substance of the transaction. if offsetting reflect the substance of the transaction. Now in this case, what actually happened, if the arrangement is to reimburse the cost incurred by the holding company on behalf of subsidiary company, the same may be presented as a net amount. It should be ensured that substance of the arrangement is that payment are actually in the nature of reimbursement. So in this case, the offsetting is permitted because it reflects the substance of the transaction, because whatever expense incurred by the holding company is to be reimbursed by the subsidiary company, therefore it can be offset. So offsetting is permissible only when it is permitted by Ind AS, or we can say it is permitted only when offsetting reflects the substance of the transaction. Whether profit on sale of asset, again loss on sale of another asset can be offset. Batao, whether it is allowed. Batao. Whether profit on sale of asset against can be offset against the loss on sale of another asset. Just try to understand, if the asset are of similar nature, means if I am saying property, plant and equipment, of course we can offset gain or loss, and we can disclose only the net amount gain or loss. But if the gain or loss are material, then offsetting should not be permitted. What they are saying, Ind AS 1 require entity to present on a net basis gain or loss arising from a group of similar transactions. Accordingly, the gain or loss arising on disposal of various items PP shall be presented on net basis. Same example I have given. However, gain or loss should be presented separately if they are material. If they are material, then it should be presented separately. When the service are rendered in a transaction with the entity and service are received from the same entity in two different arrangements, can receivable and payable be offset? Means this receivable and payable are actually of financial asset and financial liability. Now, what Ind AS 109 says that financial asset and financial liability can be offset when the two conditions are satisfied. First condition is what? Means it can be offset when two conditions are satisfied. First condition is what? There is a legal enforceable right to set up, an entity has a intention to settle on net basis. If these two conditions satisfied, of course we can set up, otherwise we cannot set up. Same thing it is given. You can see financial asset and financial liability should be offset if the entity is a legal enforcer right to set up, an entity intend either to settle on net basis. In accordance with this, receivable payable should be offset and net amount can be presented if both the conditions are satisfied. Chalega. So it means this type of question can be asked, till now not asked in exam. Okay. Then come to question 34. I think this is the last question of Ind AS 1. Yes, sir. This question was asked in exam for 4 marks. Now 4 marks, how much you should write down, that is also important. Now I think this type of question will be asked in MCQs, don't worry. Charm Limited, a company, is a manufacturing company which is into manufacturing of wire and cable and has assets is operating cycle to 15 months. The company has some trade receivable which are receivable within 12 months from reporting date. With respect to the following transaction which took place during the financial year 2021, give your opinion based on relevant Ind AS. The company has received a contract of 10 crore on 31st March 2001. 31st March 2001. The terms of contract require company to make a security deposit of 20% of contract value with the customer. They should make, means this is they have given security deposit. The company made a security deposit of 2 crore on 31st March 2021. This contract will be completed in about 14 months. 70% of deposit will be refundable immediately and the balance 30% deposit will be refundable after 3 months from the completion of the contract. So after 3 months means 14 plus 3, it become what? 17 months. Company want to present the security deposit of 2 crore as non-current. Is the management decision is correct? So can I say 70% is receivable within 14 months on completion of the project? It means within 15 months. So 70% become current and 30% become non-current. Got this one? Let's see what they have given the answer. You can see 70% will be classified as current and 30% will be classified as what? Non-current. Chalega? Yes sir. आगे चलते हैं. The company has some trade receivables that are due after 40 months from the date of the balance sheet. So company has some trade receivables that are due after 40 months from the balance sheet date, means it is receivable after 12 months from reporting date. The management of company expect to receive the amount within the period of operating cycle, but they are expecting it to receive within operating cycle. Despite the fact these are receivable in 40 months, the management would like to present these as current. Is the management decision correct? Yes, it is correct because this is receivable within operating cycle. Correct. So this is correct only. So you can see the answer is given. Yes, it is correct. Company decision of presenting trade is a current asset is correct, but in this case they need to report, yeah, they need to disclose कि out of this amount how much amount is receivable within 12 months and how much amount is receivable after 12 months. That disclosure is required. So at this point always write in exam, the company also need to disclose the amount that are receivable within a period of 12 months and after 12 months from the reporting date. Okay sir, understood? Then in the normal course of business, the company has given 2 contracts and received a total secure deposit of 4 crore. They have received deposit, so now it is a liability. 3 crore is received from X Limited and 1 crore is received from Y Limited on 31st March 2001. These are repayable on completion of the contract. However, if the contract is cancelled within the contract term of 18 months, then the deposit become payable immediately. The company is positive about the contract that the company is positive about the contract with X Limited but is in doubt about the contract received from Y Limited. The company wants to present the amount of 3 crore as non-current and 1 crore as current in the balance sheet. Is the management decision correct? Just try to understand, for liability, expectation is not relevant. Contract is relevant. So because it is given if the contract is cancelled within the contract term of 18 months, then the deposit become payable immediately. Correct now. So whatever deposit has been given, so on cancellation of contract, it will become repayable on demand and therefore it will be classified as what? Current liability. The entire amount will be classified as current liability. Entire amount what they have given. In AS 1 state that entities are classified the liability as current when it does not have an unconditional right to defer the settlement liability for at least 12 months after reporting period. Although it is expected that X Limited will fulfill the contract and deposit will not be refunded, but in case of cancellation within the contract term, refund of second deposit is a condition that is not within the control of entity. So for liability, expectation is not at all relevant. Hence, Charm Limited does not have an unconditional right to defer settlement liability for at least 12 months and therefore entire will be classified as current liability. This is very important. Then company is planning to replace the machinery. It has given an advance of 1 crore for purchase of new machinery, which will be delivered in 6 months. With some advance has been given for purchase of capital equipment. Now, any advance given for purchase of capital equipment is known as capital advance. Now, even though the delivery of machinery is within 6 months, then also entire capital advance will be always classified as non-current. So, any capital advance means advance given for purchase of PP etc. will be always classified as non-current, even though machinery can be delivered within 12 months from the reporting date. So, it will be always classified as non-current. So, you can see they have given capital advance. Yes, the management decision classify as 1 minute. Let me read the entire question. 1 minute. 6 months from the date of balance sheet. It has sold the old machinery of 0.5 crore, the payment of which is due in 10 months from the date of balance sheet. Company want to present both these amount as current since that will be settled. So one is correct. Okay, the amount receivable within 10 months, that will be what? Current. But amount of capital advance, that will not be current, that will be non-current. Let's see. Yes, the management decision to classify the payment of 0.5 crore as current asset is correct since the payment will be released in less than 12 months from the end of reporting period. Capital advance are advance given for the purchase of PP. Typically, company does not expect to realize them in cash. Rather, over a period, this get converted into non-current asset. Hence, capital advance should be treated as other non-current asset irrespective of PP is expected to receive. Understood? That only I have said. So partially it was correct, partially it was not correct. Understood? Okay, sir? Yes, sir. So with this Ind AS 1, all questions I have done. Now let us come to Ind AS 8. Can we come to Ind AS 8? After India seat, any other Indias which you were thinking that I should take, I should consider? But now I am fully tired. We'll take 2 minute break. Just you think about which Indias I should take. Now, can we start once again? Come to India's 8. First question 13. While preparing the annual financial statement for the year ended 31st March 2020, entity discovered that provision for constructive obligation for payment of bonus to the selected employee in corporate office material in amount which were required to be recognized in the annual financial statement for the year ended 31st March 2011 was not recognized due to oversight of fact. So there was some error. There was some error. So error was in which year? 31st March 2011. Means it is which year? 1011. Right now we are into which year? 1213. Understood. The bonus was paid during the financial year ended 31st March 2012 and was recognized as an expense in the annual financial statement of the said year. It was already paid and recognized as an expense of previous year. Would the situation require retrospective restatement of comparative considering that error was material? Yes. Of course, can I say it is an error? So, Ind AS 8 required a retrospective restatement for the correction of error. Means we need to find out the cumulative effect of that error, and that cumulative effect should be adjusted in the opening balance of previous year. And because opening balance of previous year will be adjusted, for that Ind AS 1 requires the preparation of third balance sheet. Third balance sheet. Correct? So what they have written? In the given case, expenses for the year ended 31st March 2011 and liability of 31st March 2011 were understated because for the non-recognition of bonus, because we'll pass one journal entry PL account debit to provision for that year, and next year the journal entry should be provision account to bank. Means for the next year there is an overstatement of expense. Overstatement of expense. So expense for the next year on the other hand was overstated to the same extent because of recognition of bonus as an expense in this year. To correct the above error in the annual financial statement for the year ended, the entity should restate the comparative amount, those for the year ended 31st March 2012 in the statement of PL, and present a third balance sheet at the beginning of previous year where it should recognize provision for bonus and restate the retained earning. Correct only? Yes, sir. This is a good question. I think this question have been given in MCQs also. Good question, can be asked in exam. 17. What they have given? During 2004-2005, Cherry Limited discovered that some of the product which has been sold during 2003-2004 were incorrectly included in the inventory at 31st March 2004 at 6,500. Means the closing stock of previous year were overstated by 6,500. यही मतलब हुआ. Cherry Limited accounting record for 2004-2005 means current year. The sales was 1,04,000, cost of goods sold 86,500 including 6,500 for the error in the opening inventory. So last year closing stock will become opening stock of current year, and opening stock will be also overstated by 6,500, and income tax 5250. In 2003-2004 Cherry Limited reported, so previous year information has been given. 2003-2004 opening retained earning has been given 20,000. Closing retained earning will be 34,000. You can see 20,000 plus this 14,000 is 34,000, means no dividend has been declared. Cherry Limited income tax rate was 30% for both the year. Cherry Limited has 50,000 means 5,000 equity shares or rupees 10 each. So how the above will be treated or accounted in Cherry Limited statement of PL and statement of changes in equity and notes to account. So this error is required to will do retrospective restatement in the comparative figure, because can you see in this case error related to previous year, therefore opening balance of previous year does not require restatement, therefore third balance sheet is not required. So in this case we need to first restate the previous year figure. So previous year sales, no restatement required. But previous year cost of goods sold, you can see cost of goods sold is 53,500. So closing stock need to be decreased by what? 6,500. If closing stock will decrease, if the closing stock will decrease by 6,500, means can you say your expense will increase by 6,500? So you can see what we have done plus 6,500 we have done, that will become 60,000. This is corrected. This will become the profit for the year before income tax, and on this will apply income tax rate at 30%. So this will become profit for the year, and EPS will be also restated. EPS means divide by 5000 will do. So EPS will be also restated. Now current year sales is okay, but current year cost of goods sold also need to be corrected, because they have given opening stock is also overstated. So 86,500 minus 6,500 will do, because if opening stock will decrease, your cost will also decrease. So minus 6,500, 80,000 will come. Then this will become the profit before income tax. Income tax 30% will be applied. This will be profit for the year, and divide by 5000, EPS will be calculated. So you can see these figures are restated. These figures are restated. Now do what? Statement of changes in equity. So of course, can I say share capital? So no changes. Share capital will be opening balance and closing balance will be same. But opening retained earning was given at 20,000. The opening retained earning will not be restated. But can you see in this we'll add this 9450 profit. So this will be restated balance at the beginning of current year. And then in this 16,800 will be added. This will be the balance at the end of current year. Understood? Then we'll do one extract of note, because they have also an extract of notes to account. In that case, we need to just give the effect of each item. We need to just write down that because the product was sold, but then also it was included in the inventory of last year, so that has been corrected by retrospective restatement. Now due to retrospective restatement, the effect is given below. So you can see the effect on 2003 2004 2003 2004. So you can see your cost of goods sold will increase by 6,500, where cost of goods sold will increase by 6,500. You should write down here, negative is increase, correct. Similarly, your income tax expense, income tax, your if your income tax expense, because your profit will decrease, so income tax expense will decrease. Then there is a decrease in profit. You can calculate this. So this effect you need to give in your notes to account. If they ask, because in this question they have asked the extract of notes to account, this effect need to be given. I hope this you can understand by your own. Chalega? Yes sir. Yes sir. One more question. I will say this good question I am doing. This question is newly inserted, until now not asked. From my point of view, if they ask, this is very good, excellent question. In this question, they have given everything: changes in accounting policy, changes in accounting estimate, and error. Correct now. So this is a good question. Let me read this question. In his financial statement for the year ended 31st March 2002, Y Limited reported 73,500 revenue, 53,500 cost of sales, 6,000 income tax expense, 20,000 retained earning, opening balance 34,000, closing balance retained earning. This information is similar to last question. Means if you have understood last question, you can see this particular point is similar. In 2002-2003, after 2001-2002, financial statement were approved for issue. Y Limited discovered that some products sold in the last year were incorrectly included in inventory at rupees 6,500. Similar information, this point I think you can do by your own. In 2002-2003, Y Limited changes its accounting policy for the measurement of investment in associate after initial recognition from cost model to fair value model. So this becomes changes in accounting policy. Now whenever there is changes in accounting policy, then also we apply retrospective application. Understood? It acquires its only investment in associate for 3,000 many year ago. The associate equity is not traded on securities exchange, that is a published price quotation is not available. The fair value of investment was determined reliably using an appropriate equity valuation model on 31st March 2003, 25,000, 2001, 2002, 20,000, and 2000, 2001, 18,000. Got this point? Have you understood? Abhi current year is what? What is the current year? Current year is what? 2000 to 2003. So this is the current year information. This is previous year, and this is year before previous year. Okay. Yes, sir. At 31st March 2003, as a result of usage of improved lubricant, Y Limited reassessed the useful life of machinery from 4 years to 7 years. So useful life has been increased from 4 years to 7 years. Machine A is depreciated on a straight line machine to a nil residual value. It was acquired 6,000 on 1st April 2000. 1st April 2000. Correct. So based on old life, so 6,000 divided by 4, depreciation will be 1500. Correct. And can you see if they have acquired on 1st April 2000, so 1st April 2000, so can you see this current year will be third year, and in the current year there is a changes in accounting estimate. So 2-year depreciation has been charged. Means out of 6,000 minus 3,000 we have done. So 3,000 is left. So 3,000 divided by remaining useful life. So 7 minus 2. 5 years is the remaining useful life. So divide by 5 will do. So divide by 5. So current year depreciation should be 600 as per the new estimation. As per the new estimation. I hope you have understood this point also. Inventory of this type manufactured by machine A were immaterial at the end of each reporting period. Okay, sir. While limited accounting record for the year ended 31st March 2003, before accounting for changes in accounting policy and changes in accounting estimate record, were 1,04,000 revenue, 86,500 cost of sales including 6,500 for the error in the opening inventory, and 1,500 depreciation for machine A. Means this cost of sales include depreciation as per old estimation, and 5250 income tax expense. While limited present financial statement with 1 year comparative information, for simplicity, the tax effect of all the item of income and expense should be assumed to be 30%. Draft an extract showing how correction of prior period error, changes in accounting policy and changes in accounting estimate could be presented in SOPL and statement of changes in equity and disclosed in notes of Y Limited. So you can see we have done first statement of PL. So first do restatement. Sales, no restatement required. Can you say cost of sales? It is similar. It was given how much it was given cost of sales of previous year. It was given how much? 53,500. So 53,500 plus we'll do 6,500. This will be corrected. Correct. Understood. Now there will be even other income also. Other income. Other income will be how much? You can see there was one investment which was purchased many years ago at a cost of rupees how much? At a cost of rupees how much? Is that information? Yeah, 3,000 at a cost of rupees 3,000. Correct. Now means can you say it was acquired at 3,000? Means the means just try to understand. If I draw like this, then only you will be able to understand. This is the current year, this is previous year. So some year they have acquired here. Now their measurement as on this date is 18,000, then 20,000, then 25,000. Correct. So this increase how much? 18 minus 3, that is 15,000 will be adjusted in the opening retained earning. And this 2,000 will be added to the comparative statement because that is a fair value gain. So you can see 18 become 20. This will be adjusted in the comparative figure 2,000. This you have understood. This become profit before tax. Then apply 30%. This become profit for the year because this in this question they have not given share capital information. Therefore, we are not doing restatement of earning per share. This you have understood. Follow. What is 3,000? Giri. 3,000 is what? Chalega. Yes. Now coming to the current year, 1,04,000 sales, no adjustment, but we'll do adjustment in cost of sales. So what is the cost of sales given in the question for the current year? That is 86,500. Can I say 86,500 minus 6,500 will do for that opening stock error? And can I say in this also 1,500 depreciation is included, but now the depreciation should be 600, not 1,500. So how much excess depreciation has been included? 900. So we'll do minus 900. Minus 900. So how much it come in? 80,000 minus 900. That is 79,100. Chalega. Correct. Now current year other income will be how much? You can see 20,000 now become 25,000. The 5,000 is the fair value gain. So that will be also transferred to PL. So you can see 5,000 has been added. So this become profit before tax. On this 30% will be applied and you can calculate profit for the year. Have you understood this particular point? Bolo. Yes, sir. Now coming to statement of changes in equity, this is interesting. So of course, statement of changes in equity, we need to give comparative figure also. You can see the opening balance of the previous year was 20,000. Opening balance of previous year was 20,000. Now in this opening balance, can you see this increase? This 15,000 increase will be added, but net of tax. So 15,000 into 70%, how much it is coming? 10,500. So 10,500 is been added. So this become restated balance at the beginning of previous year. Restated balance at the beginning of previous year. Can you see in this we'll add profit for the year, restated profit for the year, and restated profit for the year is 10,850. So 10,850 has been added, and this will become the restated balance at the end of previous year, means at the beginning of current year, and this will become, we can directly write down here, chalega, we can directly write down like this, but normally we should do that restatement also. We can write down from exam point if you want to write down like this, because restated balance already calculated like this. But if you want to start from the balance given, then correction. So 34,000 is the balance given at the beginning of current year. Now there were two information what we need to understand. Two information. Just try to understand. One will be the effect of error. Correct now. Means just try to understand the effect of error is what? That 6,500, due to 6,500. Can you say previous year profit has been decreased? See, the previous year profit has been decreased by 6,500, but it should be net of tax of 6,500 into 70%. You can see 4,550. So your previous year profit will decrease by 4,550. Understood? Yes, sir. And then what is the changes in accounting policy? So you can see 18 plus 2,000. This is 18 plus 2,000. How much? 20,000. 20,000. 20,000 ka 70% how much? 20,000 into 70%. Sorry, my mistake. This is 15 plus 2. 15. Now 15,000 was for this year and 2,000 for this year. 17,000. 17,000 ka 70% how much? 17,000 ka 70%, that is 11,900. So with that 11,900, the profit will increase. So you can see this is coming 41,350. But I will say from exam point of view, write down this now. Why you are taking tension? Don't take tension so much. Understood? Then add the profit of current year, whatever you have calculated 20,930, that will be calculated, and this will be the restated year balance at the end of current year. Understood? Then you can write on extract, means write down one para for changes in accounting estimate. One para. Don't write down much. Prior period error and changes in accounting policy, that what you have done and the effect of that. I will say don't write much in exam. Understood? This question can be asked in exam. So with this India set, means I have taken only few questions. Balance, I will say if you know the content of India's 8, now you can write down in exam. So better you read the content of India's 8. If you know the content of India's 8, all the questions you can do it. Got this point? Yes, sir. So India's 8 is also completed from my point of view. Now your demand is India's 101 or India's 33, but that will take a lot of time. India's 101, India's 33. If you want to take me, I don't have so much energy. Better we'll do some small chapters. What, Giri? You want India's 33 or can I do some small chapters? Because India's 33 at this point of time, it will take a lot of time. Can we take some small chapters? Better let us take India's 38. Can we take India's 38 and India's 40? Two small India's 38, India's 40, and if there's time left, we'll do India's 16 also. Target will be completed. My target was 16, 38 and 40 only. Can we take that? Give me permission. Yes, we'll take 40, 16 and 38. Is it okay or you want some other Indias? India's 34, I think you can do. India's 34 is very simple. India's 34 is also one small India's from which question can be asked. India's 34. Interim financial reporting. Okay. Let me come to one's index. We can see India's 16 I will do. India's 38 I will do. India's 40 I will do. 23 I have completed. 36 I have completed. 105 I have completed. 41 I have completed. 7 I have completed. 21 I have completed. India's 19 was one in the list, but that I have not done. India's 1 I have done. 8 I have done. 20 I have done. Correct. Now 108 I have done. 12 I have done. Okay, sir. Lease is an important chapter. Don't leave it. It's very simple. I will say just do some the question. It is only calculation based. Or if you do not want to do by your own, listen my revision video on lease. That much will help you. Correct. Now I will say don't leave lease because that is a calculation based chapter. A similar type of question will be asked. If you know the calculation, you can do it. And suppose if you are not able to score full marks, at least out of 8 marks, you can easily score what? 4 marks. That 4 marks is important. Why you are thinking about scoring full marks? 50% marks if you are getting in one question, and in sub question you are getting more than 50% marks. So can I say aggregate will be more than 50%? Correct now. Okay, leaving chapter, what will happen? You will not be able to attempt it only. Okay, sir. Now let us do India's 38. Let us do. Okay. We'll take 2 to 3 minute break, then we will start. Now, everyone, come to India's 38, question number 6. Can we start? Ready? Yes, sir. The Sun Limited acquired a software from Earth Limited in exchange for a telecommunication license. The telecommunication license is carried at 5 lakh in the books of Sun Limited and software is carried at 10,000 in the books of Earth Limited. So it is a purchase of intangible asset in exchange of non-monetary consideration. So what India 38 says that in this case the cost price of intangible asset acquired will be equal to fair value of asset given up plus minus cash adjustment, or fair value of asset received or carrying amount of asset given up plus minus cash adjustment. And the order will be this only, means first preference will be given to the fair value of asset given up, second preference will be given to fair value of asset received, and if both fair value is not given the question, the third preference will be given to the carrying amount of asset given up. Chalega? Yes sir. So advise journal entry in the following situation if fair value of software and fair value of telecommunication license given. Now for Sun Limited, just write down Sun Limited is acquiring what software? So for Sun Limited, what is given? Given up is telecommunication license and they have received what software? For Earth Limited, they are receiving, yeah, they are giving up. Means the asset given up is software and they are receiving what? Telecommunication license. So in this case, in the books of software, if you want to find out cost price of software limited, cost price of software, that will be equal to the fair value of asset given up, and the fair value of asset given up is fair value of telecommunication license, which is equal to 5 lakh. Therefore, software will be debited at 5 lakh. So software will be debited at 5 lakh to telecommunication license, that will be de-recognized at carrying amount. So you can see the carrying amount is also 5 lakh. So at 5 lakh, and therefore there is no gain or loss. Understood? But in case of Earth Limited, if you want to find out a cost price of telecommunication license, that will be equal to the fair value of software, and fair value of software is 5,20,000. Therefore, the cost price will be 5,20,000. So telecommunication license account debit 5,20,000 to software, at to software will be created at carrying amount, and carrying amount of software is what? 10,000. You can 10,000 has been created, and the difference will be gain on exchange, which will be transferred to profit and loss account. First point you have understood? First point have you understood? Correct? Second, fair value of software is not measurable. Well, software का fair value we are not able to measure it, but fair value of telecommunication license can be measured, and that is equal to 4,90,000. So in the first case for Sun Limited, can you say the cost price of software will be equal to fair value of telecommunication license, that it can be measured, that is 4,90,000. Okay, you can see software has been debited at 4,90,000 and telecommunication license has been de-recognized at their carrying amount, and difference will be gain or loss. In this case, loss. But in case of Earth Limited, we need to find out a cost price of telecommunication license, but the fair value of software cannot be measured. Therefore, we'll take the fair value of telecommunication license, that is 4,90,000. You can see it has been debited at 4,90,000 and the carrying amount of software is 10,000, and there is a gain worth 4,80,000. Understood? Last case, neither fair value of software nor telecommunication license could be measured reliably. In this case, the cost price will be equal to carrying amount of asset given up. So in this case, the software will be debited, means the cost price of software will be equal to carrying amount of telecommunication license, that is 5 lakh. And in this case, the cost price of telecommunication license will be equal to the carrying amount of software, that is 10,000. Understood? Chalega? Yes, telecommunication license has been debited and software has been created. Don't be confused. Don't be confused. चलेगा? यस सर. ओके. हर्ष रजनी सर, आपका कितना आवर्स का रिवीजन होगा लीज पे? लीज में आई थिंक इट इज अ रिवीजन ऑफ 3 hours इंक्लूडिंग क्वेश्चंस आल्सो, इंक्लूडिंग मींस कंटेंट एंड क्वेश्चन. इट इज 3 hours रिवीजन इन माय यूट्यूब में. रिवीजन इज आल्सो अवेलेबल इन हिंदी आल्सो. इफ यू वांट यू कैन आल्सो गो फॉर हिंदी रिवीजन क्लासेस. चलेगा? यस सर. Now come to question 28. This is a very common question for MCQs. Very common question for MCQs. This type of question can be asked in MCQs. Expenditure on new production process Up to 31st December, they have given 2,700. From 1st January to 31st March, 900. The production made the intangible asset recognition criteria on 1st Jan. Means can I say this up to 1st Jan, the recognition criteria was not satisfied. So this will be transferred to PL and this will be capitalized as an intangible asset. 900 will be capitalized as an intangible asset. But the amount estimated to be recoverable from the process means recoverable amount on that date on the 31st March was 1000, which is more than the carrying amount of the asset, means 900. Therefore, no impairment loss. No impairment loss. Understood? It means can is 2700 will be charged to PL account and 900 will be capitalized. The first point we have understood. Then again the next year 6000 expenditure was incurred. So 900 plus 6000 it becomes 6900. Now on 31st March 2003 the recoverable amount is given 5000. So can you say now recoverable amount is less than the carrying amount. So this 1900 will be the impairment loss and will be charged to PL account of that year. Understood? This was the question. I think very simple. This type of question can be asked both in descriptive and both in MCQs also. Next point. Question 10. X Limited is engaged in the business of manufacturing fertilizers, enter into a technical collaboration agreement with a foreign company, Y Limited. As a result, Y Limited would provide technical know-how enabling X Limited to manufacture fertilizer in a more efficient way. X Limited paid 10 crore for the use of know-how for a period of 5 years. The 5 year become the useful life. X Limited estimated production of fertilizer. So they have given the estimated number of unit to be produced. It means can I say for amortization will use production unit method. For amortization will use production unit method. At the end of the first year, it achieved the target production. Means this was achieved. But at the end of second year, 65,000 metric ton of fertilizer was being manufactured. Means initially estimation was 70,000, but actual production was 65,000. X Limited considered to revise the estimation for the next 3 years. The revised estimation is 85,000, then 1,05,000 and 1,15,000. 1,15,000. Correct. How X Limited amortize the technical know-how fee? So for first year, I think very simple. What will do 10 crore? 10 crore into 50,000 divided by total. It is 50 plus 70 plus 100 plus 120 plus 110. That is 450. 4,50,000. So amortization will be 1 crore 11 lakh 11,111. For second year, can you will do 10 crore minus this? So 10 crore minus 1 crore 11 lakh 11,111. That will come how much? Array. This is coming how much? 8 crore 88,000, 8 crore 88 lakh 88,889. Now can you see we'll take revise. So revise will be 65,000 actual production. And what is the total? Total of these will be 65 plus 85 plus 105 plus 115. That is coming 3,70,000. So this amount you calculate, this will be second year amortization. Second year amortization. Understood? Have you understood? I think this you can do. Then third year, fourth year you can do it. Okay sir. चलेगा? Okay sir. Then next point. Come to question 21. X Limited acquired Y Limited on 38 April 2001. The purchase consideration was 50 lakh. The fair value of tangible asset was 45 lakh. The company estimated fair value of in-process research project was 10 lakh. No other intangible asset was acquired by X Limited in the transaction. Now just try to understand what Ind AS 103 read with Ind AS 38 say that if there was some in-process research project of acquiring company, that will be recognized as an intangible asset in the books of acquirer if it meet the definition of intangible asset. Even though it was not recognized in the books of acquiring company. Chalega. It means can I say the in-process research project will be recognized as an intangible asset in the books of acquirer at fair value, and fair value is 10 lakh. Means total tangible asset 45 lakh, intangible asset 10 lakh. It become how much? 45 plus 10, 55 lakh. So purchase consideration 50, INA is 55. Therefore, gain on bargain purchase will be 5. So gain on bargain purchase you can calculate. Further costs incurred by X Limited in relation to research project 5 lakh as research expense. So subsequently means on the date of acquisition, so Ind AS 103 has been applied, but subsequently Ind AS 38 will be applicable. So any research expenses will be charged to PL account. 2 lakh to establish technological feasibility. So any expenses incurred till the date when technical feasibility is obtained, all the expenses will be charged to profit and loss account. So this will be also charged to profit and loss account as an expense. After that, 7 lakh for further development cost after technological feasibility is established. So this 7 lakh will be capitalized. So initially it was 10 lakh plus 7 lakh. So 17 lakh will be the carrying amount of intangible asset. This question can be asked for 2 marks in MCQs. Chalega? Yes, sir. 25. This question also have been asked 2-3 times in exam. Correct. X Limited is engaged in developing computer software. The expenditure incurred by X Limited in pursuance of its development of software is given below. Paid 2 lakh towards salary of product 2 lakh towards salary of program designer. Incurred 5 lakh towards other cost of completion of program designing. Incurred 2 lakh towards cost of coding and establishing technical feasibility. Means at point number C, we obtain technical feasibility. This all costs will be charged to profit and loss account as an expense. Chalega. Paid 7 lakh for the other direct costs after establishment of technical feasibility. This will be capitalized. Incurred 2 lakh towards other testing costs. This will be capitalized. Cost of producing product master for training material. So this is cost of producing the master file. Correct. This will be also capitalized. Correct. A focus group of other software developer was invited to a conference and cost of conference aggregated. Any inauguration cost after the asset is available for use will not be capitalized. So only capitalization will be 7 plus 2 plus 3 means how much? 12 lakh. So how much will be capitalized? 12 lakh will be capitalized. Chalega? Yes, sir. This also you have understood. This small question. I hope you are understanding. 28. A Limited intend to open a new retail store in a new location in the next few weeks. It has spent a substantial sum of the series of television advertisement to promote this new store. It has paid for advertisement costing rupees 8 lakh before 31st March 2018. 7 lakh of the sum relate to the advertisement shown before 31st March 2018 and 1 lakh to the advertisement shown in April 2018. Just try to understand any advertisement cost will never be capitalized as an intangible asset. It will be charged to profit and loss account as an expense immediately because it will not meet the definition of intangible asset. This point you know. Now out of 8 lakh, 7 lakh relate to current year. So 7 lakh will be charged to PL as an expense and 1 lakh will be prepaid expense. 1 lakh will be prepaid expense. Since 31st March 2018, A Limited has paid a further advertisement costing rupees 4 lakh. The accountant charged all this cost as an expense in the year 31st March 2018. No, this is not correct. However, CFO of A Limited does not want to charge 12 lakh against 17-18 profit. He believes that this cost can be carried forward as an intangible asset. He is Mahanalayak. Correct. This is to 100% wrong. So can I say 1 lakh plus 4 lakh, 5 lakh will become the expense of the next year. Expense of next year. Understood? Correct. I think you can write down now. 31. This is also a good question. Also a good question have been asked in exam for 10 marks. Recently was given in MTPL. So for November 2022 can be repeated. Super Sound Limited had a following transaction during the financial 1920. On 1st April 2019, Super Sound Limited purchased the net asset of Music Limited for rupees 13,20,000. The fair value of Music Limited identifiable net asset is 10 lakh. So can you say goodwill become 3,20,000? Goodwill become 3,20,000. Super Sound Limited is of the view that due to popularity of Music Limited product, the life of goodwill is 10 years. Okay, this is 100% wrong because goodwill as per Ind AS 103 will not be amortized. Means it will not be amortized. It will be only tested for impairment, that too on annual basis as per Ind AS 36 requirement. Okay. So can you say no amortization of goodwill? Okay, this much you understood. On 4th May 2019, Super Sound Limited purchased a franchisee to organize musical show from Arman TV for 80 lakh. So they purchase one franchisee. So of course it is an intangible asset and cost of acquiring is 80 lakh. At an annual fee of 2% of musical show revenue. At an annual fee means they need to pay an annual fee also, that is 2% of musical fee. The franchisee expires after 5 years. The useful life is 5 years. Musical show revenue were 10 lakh for the financial year and projected future revenue for the financial year 2020-21 is 25 lakh and 30 lakh for the remaining 3 years. Now, if you are doing this question, you might amortize this 80 lakh in the ratio of revenue. But what Ind AS 38 says that intangible asset should not be amortized based on revenue. Based on revenue means uh, amortization based on revenue is not permitted, and therefore don't amortize based on revenue. If nothing is given, always amortize on SLM basis. Always amortize on SLM basis. So this 80 lakh will be amortized on SLM basis, means we'll do divide by 5. Divide by 5 chalega. And case this 2% of first year revenue 10 lakh will be an expense of that year. So 10 lakh into 2%, that will become an expense. Chalega? Yes sir. On 4 July 2019, Super Sound Limited was granted a copyright that had been applied for the Music Limited. During the financial year 1920, Super Sound Limited incurred 2,50,000 legal costs to register the patent. So of course this will be also capitalized because this is a legal cost to register the patent. And 7 lakh additional cost to successfully prosecute a copyright infringement suit against a competitor. Just try to understand any legal expenses to defend any cases will be charged to profit and loss account because that was incurred not to bring the asset in working condition. Correct now. So this 7 lakh will be a expense which will be charged to PL account. The life of the copyright is 10 years. Super Sound Limited follow an accounting policy to amortize all intangible asset on SLM basis or any appropriate basis over the maximum period permitted by relevant Indians. Because just try to understand the maximum period permitted by relevant Indians is there is no such period. So we need to estimate the useful life. Useful life is already given. Taking full year amortization in the year of acquisition. Because of this point, even though it is acquired during the year, will charge depreciation for the entire year. But that is not correct. Normally it should be on proportionate basis, but because ICI is taking full year acquisition, because of this particular point we are also doing full year depreciation or amortization. But from my point of view, it should be on a proportionate basis. Chalega? Yes sir. Now you can do, I just explain the schedule. So 3,20,000 goodwill, in this no amortization. 80 lakh was the franchisee, divided by 5. So 16 lakh is the amortization, this become closing balance. 2,50,000 was the copyright, divided by 10, 25,000, this become the closing balance. This become the intangible asset. This intangible asset will be shown under non-current asset as an intangible asset in the balance sheet extract. Now SOPL, revenue is 10 lakh. Then amortization expense total is coming how much? 16 lakh 25,000. So you can see 16 lakh 25,000. And there are some other expense. One is 7 lakh legal fee expense, and there is one that annual fee expense for that franchisee. 2% of 10 lakh, that is 20,000. So that become other expense 7 lakh 20,000. Chalega. So this become the extract of SOPL. Good question was asked in exam. The balance is what? The working note. Come to the last question. I think this is the last question, not last question. A company is engaged in the provision of information technology product and services incurred. A company engaged in the provision of information technology product and services incurred following expenditure during the development phase of the software product that is to be offered to the customer. The entity also purchased software from the third party for incorporating into its end software product offered to the customer. The company is in the process of launching it in the market for licensing to the customer. The company also takes services of external professional software developer for such software development purpose. Cost incurred in relation to development of its software product for the year ended. Means all this first para is of no use. So, okay. The purchase price of imported software, this will be capitalized. Employment cost will be capitalized. Testing cost will be capitalized. Other costs directly related to customization will be capitalized. Some note is given, we'll read this note. Professional fee will be capitalized. Cost of training provided staff to operate the asset, this will not be capitalized. Any training cost will not be capitalized. Cost of advertising will not be capitalized. Admin and general overhead will not be capitalized. Now note 1. The software was developed in the 9 month ended 31st December 2001 and was capable of operating in the manner intended by entity. It was brought into use on 31st March 2002. The employment costs are for the period of 12 months. 12 months. So can you say it is for 12 months? So we'll do proportionate to 1000. This is what 1200 into 9 by 12 will do. So only 900 will be capitalized. You can see only 900 has been capitalized. Chalega? Yes, sir. Then one note has been given for what? Other costs directly related to customization. Other costs directly related to development include an abnormal cost of 50,000 in respect of repairing. So that will also not be capitalized. So out of these 450, 50 will not be capitalized. So only 400 will be capitalized. Balance you can capitalize. This is the total cost price which will be capitalized. Can I say very simple? This type of question is super easy. You can do it. Ind AS 38 is completed from my point of view. So Ind AS 38 also completed. We'll take another Ind AS 40. Ind AS 40 can we do? 5 minute break. Now, everyone, come to Ind AS 40. Ind AS 40. I think probably this can be our last Ind AS for today. Okay, everyone, is it okay? So I think Only half an hour is left for today's class. So we'll take this as the last Indias for today. Balance, I hope you can do by your own. I think whatever I have done today, you have understood. And if you have understood, do message in the comment box what is your experience of today's class, so that, can I say, of course it will help us to understand that how you are able to understand with our classes. Got this point? So your comment, your feedback is always welcome. Got this point? So we'll be waiting for your message, how you have find these classes, whether it is helpful or not, whether it will give some value addition to your current means to your understanding before these classes. If some value addition we are able to give in this one day, so that will be, can I say, that will be a very good point from our point, means that will actually give us a motivation to give such type of classes in the near future. Understood? Correct. So I just want your feedback about the classes, whether it will help or it will, but of course it will help you. I know, I also know. But what is your experience about these classes? Just write down a message in the comment box, not in this live chat box, because live chat box I am not able to read right now. Once the classes are completed, to do message in the comment box. I'll be waiting for your all messages. Chalega? Yes, sir. Come to investment property. Question number 10. X Limited is engaged in the construction industry and prepares financial statement up to 31st March each year. On 1st April 2013, X Limited purchased a large property consisting of land. Large property consisting of land. So land is not a depreciable asset. For rupees 2 crore, and immediately began to lease the property to Y Limited on an operating lease. So can you say this will be an investment property? I mean, right now we are doing investment property chapter, so of course it will be investment property, but in exam you should think that. Annual rental was 20 lakh. On 31st March 2007, the fair value of property was 2 crore 60 lakh. Again, this fair value is not at all relevant, because as per India's party, subsequent recognition can be done only based on cost model, not based on revaluation model or fair value model. So this information is not at all relevant. Fair value is required only for disclosure purpose as per India's party, but right now we are doing accounting. Disclosure, okay, we can do it. Chalega? Under terms of the lease, Y Limited was able to cancel the lease by giving 6-month notice in writing to X Limited. Y Limited gave the notice on 31st March 2017 and vacated the property on 30th September 2017. On 30th September 2017, the fair value of property is 2 crore 90 lakh. Once again, this is not relevant. Once again, 2 crore 90 lakh is not relevant. So whenever fair value of any investment property is given, accounting, for accounting, that is not relevant. Only that is relevant for disclosure purpose. On 1st October 2017, X Limited immediately began to convert a property into 10 separate flats of equal size, which are held for sale in ordinary course of business. So can you say now it will become inventory, because now that property is held for sale in ordinary course of business. So this is a case of reclassification from investment property to inventory. And as per India's party, reclassification is done at carrying amount. X Limited spent a total of 60 lakh on the conversion project between 30th September to 31st March. The project was incomplete on 31st March 2018. So can I say at year end, this will be a work in progress, and India's 2 will be applicable. Now as per India's 2, for a WIP, we need to find out cost price, and then we need to compare with NRB, and NRB of WIP will be expected selling price minus expected cost of completion. Correct? Of course, minus expected selling expense also. So what they are saying, the directors estimate that they need to spend a further 40 lakh to complete the project, after which each flat can be sold at 50 lakh. For this, you need to give what is the requirement. So can you say, first it was purchased at 2 crore, this is the cost price, and because land is not a depreciable asset, so carrying amount At the beginning of current year, this is the beginning of current year, 31st March means 1/4/2017. On 1/4/2017, the carrying amount is 2 crore. Now on 30th September 2017, the carrying amount will be 2 crore only. So reclassification will be done at 2 crore. At 2 crore. And for the first 6 months, can you see we recognize rental income of 10 lakh because 20 lakh was the full rental income of the entire financial year. So first 6 months it will be 10 lakh. Understood? Yes, sir. Now on 30th September, the reclassification will be done at carrying amount that is 2 crore and they have again spent 60,000. So again is the cost price of that inventory will become 2 crore plus 60 lakh, that is 2 crore 60 lakh. Yes, sir. Now we'll find out NRB. NRB will be 50 lakh into 10 means 5 crore minus 40 lakh cost to complete. So 5 crore minus 40 lakh is equal to 4 crore 60 lakh. The cost price is 2 crore 60 lakh and NRB is 4 crore 60 lakh. Whichever is lower, so of course it will be 2 crore 60 lakh. Therefore it will be reported, it will be recorded in the balance sheet as a current asset means inventory, as inventory at 2 crore 60 lakh. At 2 crore 60 lakh, that is only given in the solution. Just read the answer. Understood? Chalega? Can we proceed? Yes, sir. Then this question number 11 is also very good question. Till now not asked in exam. If these questions come, it will be of I think 8 to 10 marks question. 8 to 10 marks question. Good question. In this only at one point you can do mistake. Only at one point. Soria Limited own a building A which is specifically used for the purpose of earning rental means investment property. The company has not been using building A or any of its facility for its own use for a long time. The company is also exploring the opportunity to sell the building if it get the reasonable amount in consideration means held for capital appreciation, therefore it will be investment property. Following information relevant for building A for the year ended 31st March 2020. Building A was purchased 5 years ago at a cost of 10 crore and building life is estimated to be 20 years. The company follows straight line method of depreciation. Okay. Only here means in this two sentence you can do mistake. Let me first identify whether you are doing that mistake or not. So let me ask you question. What they have given? Following information is relevant for building A for the year ended 31st March 2020. Correct. Now what they have given, just try to understand. This is 31st March 2020 and the year beginning will be 1/4/2019. This is become the current year. For this year we are preparing the financial statement. Correct. What they have given? Following information relevant for building A for the year ended 31st March 2020. Now they have building A was purchased 5 years ago. So building was purchased 5 years ago. So my question to all of you, that 5 year will be calculated from 31st March 2020 from 1/4/2019. In this particular point only you can do mistake. Means one is correct, one is wrong. So from your point of view, this 5 years should be calculated from 31st March 2020 from 1/4/2019. What do you say? Bata. One answer I got 1st April 2019, which is correct, 100% correct. So it will be calculated from this, not from this. If you are taking 31st March 2020, that will be wrong. That will be wrong. So what they have given, they have not given that following information is relevant as on 31st. If they are given as on, so of course we should consider from 31st March 2020. But they are given for the year ended. For the year ended means for the financial year 1920 and 5 year will be from the beginning of that year. Understood? Have you understood? Nitesh, you were saying 31st. It was not correct. Nitesh Mangal. Have you understood your mistake? Okay. Then during the year, the company has invested in another building B with the purpose to hold it for capital appreciation. Means one more building was purchased. That is also investment property. The property was acquired at the beginning of the year at a cost of 2 crore and expected life of the building is 40 years. As usual, the company follows straight line method. Okay, sir. This also done. Chalega. Then they have given further during the year 1920 following information: rental income from building A, rental income from building B. and then some operating expenses has been given for building and building B total. The company does not have any restriction and contractual obligation against building and building B. This point is required for disclosure purpose. Means if you read the disclosure requirement of Ind AS 40, this is the point of disclosure. Then can you say all these points whatever has been given now, these are the disclosure points. Now just try to understand there are two type of disclosure. One disclosure where some reconciliation required or some calculation is required, and one disclosure which is the information disclosure. Can you say any disclosure which is based on information can be disclosed only when such information is given in the question? So if this information are given in the question, disclose point wise, disclosure number 1, 2, 3, 4 like this. So from these to this, I will say only disclose as per the information given in the question. As per the information given in the question, no extra effort is required. No extra effort is required. Chalega. And you can give disclosure as per point wise. There is no need to write down as per the suggested solution. Whatever write down point 1, point 2, point 3 like this, write down give disclosure in notes to account. Chalega. Now what will be the treatment of building A and building B in the balance sheet? So we need to prepare one extract of balance sheet. I will just inform you from the solution. Now just try to understand. If one building A was purchased 5 years ago, the cost price was how much? The cost price was how much? It was 10 crore. So can you say 10 crore and the useful life was 20 years. Into 5, that will be the accumulated depreciation. 10 by 20 into 5 means 2.5 is the accumulated depreciation, and current year depreciation will be 0.5. One building was purchased at the beginning of the year amounting to 2 crore and the useful life is 40. So if you do 2 divided by 40, so the annual depreciation of current year will be 0.05. So total depreciation becomes 0.55. So again, the opening balance, the gross book value, opening balance will be 10 crore. Then purchase done during the year is 2 crore. So you can do as a notes to account. Means in the notes to account, how you should write down that I am saying. The gross book value, opening balance 10 crore. Then purchase during the year 2 crore. This becomes the closing balance of gross book value. Then accumulated depreciation, opening balance 2.5, current year depreciation 0.55. This becomes closing balance of accumulated depreciation, and this minus this will become net book value, which will be shown in the balance sheet as investment property. You can also write down extract of balance sheet. Then extract of SOPL, rental income from investment property. So you should write down SOPL rental income, income from the rental property. So for that one notes to account required. Rental income is given. All the direct operating expense you can do total and write down all the expenses, and depreciation also deduct from this. So this becomes the profit from earning from investment property, which will be shown under other income. Other income, if it is not a revenue, but suppose if this is the ordinary activities of the entity, then it will become a revenue. So that depends upon the other information given the question, but they have not given that this is the main business, so it is not a main business. So you can write on other income ki income या profit from the earning of investment property as an other income in 0.32. Then disclosure, you can say disclosure they have given in para format, you can write them point wise. Understood? Sir, why 0.5? 0.5 for current year na? Current year depreciation, अरे नलायक 10 divided by 20. 0.5 only na? अरे SLM every year depreciation will be same. Every year depreciation will be same nalayak. Understood? Okay. Understood Nitesh? Oh, oh. So in days 40, oh, there's some question left. This 12 is very expected. You can see it has been given RTP, then asked in exam, then again given in MTP May 2023 is important. X Limited owned a land property whose future use was not determined as at 31st March 2001. How should the property be classified in the books of X Limited as on 31st March 2001? So any property for which future use is not determined, it is always deemed to be held for capital appreciation. If it is held for capital appreciation, then it will be investment property. So as on 31st March 2001, it will be investment property. During June 2001, X Limited commenced construction of office building on it for its own use. Presuming that construction of office building will still be in progress as the 31st March 2002, how should the land property be classified by X Limited in its financial statement as on 31st March 2002? So can I say as on 31st March 2002, the it will be reclassified from investment property to property plant equipment, because now it will be used for the own purpose. It will become owner occupied property. It will be reclassified from investment property to owner occupied property on 31st March 2002. First means this first initially it was investment property, then reclassification has been done. Will there be any change in the carrying amount of the property resulting from any change in the use? So carrying amount will remain same. So reclassification is done at carrying amount only. Chalega? Yes, sir. Whether change in classification to or from investment property is change in accounting policy? No, it is not a change in accounting policy. It is only a reclassification from one classification to another classification. Chalega? It is not changes in accounting policy. Okay, sir? Yes, sir. Would your answer to A above will be different if there were to be a management intention to commence construction of an office building for own use? However, no construction activity was planned. Just try to understand, if the no construction activity is planned, then no reclassification will be done. So the reclassification will be done only when the actual happening has been done. Only because of the mere intention of management, reclassification is not possible. Therefore, in point number D, it will not be reclassified. It will remain as investment property only. Good question. Chalega? Nitesh, Jai Sri Shyam. Okay, Baba. I can understand galti se hota hai, but I am here to rectify that mistake only. Okay, sir. So you are in this class to understand where you can do mistake. If you can understand that mistake, you can avoid that mistake in exam. Okay, sir? Yes, sir. Now come to question 13. UK Limited has purchased a new head office property for rupees 10 crore. The new office building has 10 floors and the organization structure of UK Limited is as follow. You can see first, second, third, fourth, fifth, sixth, seventh. It is for office purpose, means business purpose. Therefore, this will be property, plant and equipment. But 8, 9, 10, it is vacant. It is vacant. So can I say this actually the floor is for dual purpose? Whenever there is a one property used for more than one purpose. So what India's 40 says that if the all portion are separable, then apply respective Indias. So respective Indias up to this, it will be property, plant, equipment. Now the doubt will come out of vacant. If it is vacant, then whether it will be PP or it will be investment property, this doubt will come. Since UK Limited did not need the floor 8, 9, 10 for its business need, it has leased out same to a restaurant on a long-term lease basis. Now normally what students think that long-term lease basis means finance lease. No, it is not a finance lease. It can be operating, it can be finance lease depending upon the indicator given under Ind AS 116. Correct? So of course for this question it will be an operating lease, because if it is a finance lease then it will be de-recognized. If it is already de-recognized, the question of classification will not arise. So of course it will be an operating lease. Correct? We need to apply the indicator given under Ind AS 116. Okay, sir? The terms of lease agreement are as follow. Tenure 5 year, non-cancelable period 3 year, lease rental has been given 10 lakh. This information is means we are not doing accounting here. Means we are not doing accounting for lease. We are doing only the measurement of investment property. Understood? Yes, sir. Based on the certificate from the architect, UK Limited estimated cost of the top 3 floor as approximately 3 crore. The remaining cost is 7 crore, which can be allocated as 25% towards land and 75% towards building. As on 31st March 2018, UK Limited obtained a valuation report from the independent valuer who has estimated a fair value of property to be 15 crore. UK Limited wishes to use the cost model for measuring the PP and fair value model for measuring the investment property. You can say, can we use fair value model for investment property? No. So it means we can use only cost model. So here one doubt will come, cost model, cost model. For PP, cost model is correct. For PP, we can use cost model, revalue sum model. You can limit depreciate a building over the estimated useful life of 50 years. From this, we can understand that useful life of the building is 50 years and it has been given for a tenure of 5 years or 8 years. Can you say which is only, which will not cover the major part of the economic life of the asset? So this indicate that this is an operating lease. This indicate it is an